India Today's managing editor to join Mr. Chauhan. I would also like India Today CEO Suparna Kumar to please come on the stage. Anilesh, over to you now.
Ashish bhai, welcome at your own home. Welcome to India Today's Smart Money Financial Summit. 30 years back when anybody used to talk about technology, they used to talk about digitalization of the existing assets. Now we have to deal with an animal called artificial intelligence. The risk management and your trading and to your even your daily dealing has to be dealt with it, and even the normal operations. How is NSE, world's one of the finest stock exchange, is dealing with artificial intelligence?
Broadly, artificial intelligence is a tool, right? Like IT was, when it came, it was a new thing. It's still a new thing for many of us. But the business is adapted and the speed at which it operates vis-a-vis what the human scale was very different. The artificial intelligence is another tool. Till now, the tools have been programmed, or at least in our mind, that they do what we have told them before to do. A digger will dig only and not fly in the sky unless you also program to fly in the sky. And similarly, a trading system will only allow you to trade. But the AI is slightly different, is that what you have not programmed also, it's able to take a leap of faith. And so that is where it differs. It also, because it takes a leap of faith, it hallucinates. Why it does it is because it iterates. It doesn't give you answers. There are no deterministic answers the way we train the current, what we call large language models. What it does is that it actually predicts the next word in your sentence or in your book. So it's basically looking at everything that was written before, all programs, all books, all research papers. It has now imbibed them, and then basis what you ask. It asks you, it gives you the next word and the next word and next word. It doesn't have that much intelligence. It's called artificial intelligence, but it's like pretending to be intelligent. It just defined, it has looked at like trillions and gazillions words and trying to give you that answer, right? So at the same time, it's very effective in many areas. And so what we do at NSE is that we are trying to use it in many ways, but not in trading. Because trading requires deterministic outcomes. So if you want to buy, say, Reliance share at, say, now I don't know what the price is, but suppose 2,000 rupees. An AI, when you create a matching engine, it might tell you that you have matched at 1 rupee. You will be happy, but the seller will be unhappy, right? And so we have to give you a deterministic answer that if it's 2,000 rupees, a buyer wants to buy and seller wants to sell, only at that point in time you can have a trade, right? So we don't use the AI in the matching part of it, but for surveillance, for pattern recognition, for even programming, for vibe coding it is called, for looking at people's wordings or asking, say, new risk factors in a DRHP. Those are the things we use it, so we use it for many things. across, but where you want exact answers without fail, then AI is currently not equipped to do that, because it gives you sometimes answers which are not wrong but very wrong. And I can't afford, like in today's world at NSE, we give you response at nanoseconds. 1 second is a million microseconds, that's 10 lakh microseconds. But a billion nanoseconds, that's 100 crore nanoseconds. So we give you response. Today you place an order on NSE, we give you response at 100 croreth of a second, not 100th of a second, but 100 croreth of a second. So it's a way beyond thing. AI is anyway not acting at that kind of speed. But broadly speaking, our speed, our scale, our risk management are of a different caliber. Today, we on a good day, we do 22 billion, 2200 crore orders. That is like 15 orders per all humans in India, right? So in a 6 hours time. And we service 13 crore unique Indians, 26 crore accounts, 25% of India's households, out of which 25% are women, out of 13 crore, and things like that. So there are no scale that are available there, but within that, what is possible, we try to experiment. If it's successful a little bit, of course, there will be a human oversight always, because it's like a child, you know, it can give you very smart answers, but you need to also see whether that answer is appropriate or not, and things like that. And so that's what we continue to use. We are pretty much one of the larger users of AI in India today.
So Ashish bhai, globally we are seeing that you know, the various regulators, various banks, treasuries, they are debating about the impact of Mythos, the Anthropic's new AI model. And recently they tried to you know, come up with a test case, Fable 5, and immediately we saw that US forced them to withdraw it. So you know, how much impact do you think you know, such advanced level of AI can make on the trading decisions? Right now you are saying that you are shielding you know, the trading from AI, but in times to come, you know, one will have to deal with this animal. So how is you analyzing this, and how far do you think is the scenario, and how much time Indian stock markets will take, you know, to get prepared for this?
No, Mythos is again a myth created by, to some extent, many of us feel it's a marketing myth by Anthropic. But the AI is here, it's going to stay, it's evolving very rapidly compared to human scales. And so the way the Mythos or Fable, what the commercial model came out, it's an evolution from their other models called Opus. Similarly, ChatGPT has other models, and there are open source, open weight model we call it. I mean, we are getting into the technical part of life, but just to give you a perspective, all these models, they build on each other. So, and when you say I have created Mythos, it is actually created on the earlier version, which is called Opus 4.7 or something. And so it was also capable of doing what these people are claiming to be doing better. And so there have been instances where that particular models, older versions of ChatGPT or Anthropic's own, or even other Chinese models, they were able to not only figure out the vulnerability, the bigger part is that they figure out the vulnerability and then they create the attack automatically. Earlier, I mean, last 30, 40 years, we have been trying to figure out where the vulnerability is as IT managers, and then try to basically stop it before anyone figures out a way to attack you. Here, in this case, with AI, it's not only able to do things in terms of thinking about where the problem is, but also attack it so that actually the bad actors end up exploiting the vulnerabilities faster, because then you don't have a chance to repair it. Good thing about life is Mythos was available for at least 2 months to many organizations, and it didn't do anything damaging. So in some ways, why it happens is because all the large organizations, even smaller ones, but large organizations have created layers of security. So it's not dependent on, say, one particular type of security. So it may be able to find a vulnerability in operating system. But then the securities manager, what are called now CISO, Chief Information Security Officer for a large organization, they end up creating a lot of backup in such a way that people to reach that vulnerability will have to go through many hoops and then they get stopped. So that's why on an individual basis that operating system may be hackable, but within a large organization setup, it's not that easy for anyone to do that. At the same time, in next version probably it might be able to do better and better, and so we have to keep on increasing our defenses more and more, and that's how I see that it's a cat and mouse game. Sometimes the sort of bad actors win, but largely speaking, the good actors have to figure out together and also learn from each other how we can protect ourselves and the society from bad actors in this kind of situation, which is evolving really, really fast. Last week itself, we had a conference in this hall itself of all the large stockbrokers and the IT companies, which have also had access to Mythos for last couple of months, explaining what happens, how we need to protect ourselves, what are the measures and things like that. So we do create those exchanges of ideas with people who require that, because today a large number of Indians and across the world, large number of citizens are using these services of stock trading, banking and all, which can be very vulnerable to people hacking out, and especially the bad actors doing it automatically across the world, where you can't even figure out that earlier we are used to crimes which are local, right? Now there is no local crime in cyber world. It's a full international everything. By the time you lost your 100 rupees, it's already gone through a few hoops in India and then Nepal and then Vietnam and then China, right? So that's where we need to be extremely careful. I mean, in many of this information security conferences, I say that when we grew up, especially people my age, we grew up, we knew where the border was. And people who protected borders were called armed forces, the army, navy, and air force. And people who protected the society from within were called police. Today, the border is on your mobile, in your hand. And literally everyone is a spy without their knowledge on themselves as well as the society. And so, of course, they can lose their money, their reputation, using that single mobile, right? So that's where we need to be all aware that it's not something which is esoteric, it's actually happening without our knowledge. And so we need to be extremely careful on all this. We try to do, make even investors aware that their identities can get hacked, their portfolios can be hijacked and things like that. And so we do a lot of television advertisement, print advertisements, social media, hybrid advertisements and all, just to make people aware that don't take these things as something which happens to other people. It can happen to us. And so I think I saw some video a few days back that the lady said that I told a joke to my husband in the night, and he said that don't do this. The Alexa is listening. And then Alexa laughed. And then the Tesla laughed. And so on and so forth. So that's where basically everyone is listening to everything, everyone is watching everything, and be very careful.
Ashish bhai, AI is developing very, very quickly, and so is middle class penetration into Indian stock markets, thanks to technology and a lot of digitalization which happened in 5-6 years. But we also saw that how a sophisticated company called Jane Street, they came up with a very sophisticated algorithm. How do stock exchanges like NSE, which is facing this very peculiar situation because nowhere in the Western world they are witnessing this. So how are you making your stock exchange more robust to deal with many of these situations?
Broadly, when anything new comes up, we think why it was not caught. Because as an authority, we cannot stop anyone from doing what is legal. There are codes, literally thousands of pages of laws and regulations written that this is what you do, then it is illegal. Everything else is legal. Only when an authority says this is illegal later on, that is the time we can figure out that pattern, that this is now illegal, and we can stop it from happening. Till the time, we have to just, we can't say that it's illegal because it's not written in codified word, right? So that's where this dilemma will continue to happen, that somewhere something happens, the authorities figure out that this is not correct. They create codification for that, regulations for that. After that, the exchanges have the tools to sort of ensure that things don't happen if the regulators don't want. For example, there are people who do trade between themselves only. 2 people or 3 people or 5 people will continue to trade, say one stock, 100 rupees, next moment 105, next moment 110 among themselves, and the prices will reach astronomical level in, say, few days' time. That is a pattern which is well recognized in regulations. Now what happens is that as soon as you do this on exchange, NSE will take that out in its surveillance, figure out and then cancel the second trade which you do. So that it basically stops the crime from happening. But provided what is crime is well defined, because if computer starts defining what is crime, then what is allowed to you may not be allowed to other person, right? So that's where we need to be very careful on what we don't allow, what we allow. But once something is defined by the regulator as a sure shot, something they don't want, the exchanges have the tools to stop it from happening.
And what about the derivatives? You know, a lot of speculation happened in the past. Government also changing the rules. But I believe still a lot of speculation happened. This war stalled some of the progress. But now, the peace is returning, and we will may see, another surge happening. So how are you preparing yourself that, speculation doesn't come in and people don't use technology to get into this speculative market and then start robbing, maybe the smaller investors?
Broadly speaking, the speculation is basically something which is defined by person's own characteristics. So what could be speculation for you might be hedging for another person. That is trying to reduce his risk, while as you are trying to increase the risk. And so what is appropriate for you as a risk to be taken, because speculation is risky, but what is appropriate for you to take that risk? So if you are worth $1 billion, you can take a small risk, which for you small might be very large for me. And if you are a really small person with a 1 lakh rupee net worth or 2 lakh rupees net worth, you should not be allowed to take more than few rupees of sort of that type of risk. And that's where the modern technologies allow, again, once the regulations are built, saying who should be allowed what kind of sort of instruments to trade in, including the derivatives and all. That's easy to do. In the meantime, because there are no regulations which specify who can trade what, we try to go through again the investor education framework, saying if you are not an expert, don't trade in derivatives, because derivatives are risky. SEBI has come out with research reports for 3 consecutive years saying that more than 90% people lose money in derivatives. And that's where we try to tell the people that if you are not an expert in derivatives, please don't come into that market, because it's for experts. It's like that thumbs up advertisement, where Salman Khan, without any need, rides a bike and through the mountains and takes that thumbs up sort of bottle and drinks. He could have done it with a shop also, right? Why is taking that risk? And so it's for me, and then they write in a small word that it's for it may not be Salman Khan, but they say that it's done by expert people and you should not do it at home. And we are also telling people that derivatives markets are useful in many ways for passing risks and hedging and all, but it's amongst experts. It's not for retail people. And so please, if you do not understand that markets, please don't come into this market.
Ashish bhai, you are one of the veterans in stock markets. You were earlier with BSE, now you are dealing with NSE. You are one of the founders of NSE. You have seen the growth trajectory of the digitalization. Now we are already talking about blockchains, stablecoin, and those type of things also coming into fore. AI, you have already explained. Can you foresee for us that maybe next decade, which way the stock exchanges in India would go? Will that same be, the physical structures like this, or will they become digital platforms? Or, you could trade from anywhere in the world. You have already set up, exchange in Gift City. Foreign trading could be much easier. How do you see technology, policy, and, the trajectory of scaling up, taking the stock markets forward?
Broadly, finance is a very interesting subject that there is no physicality. Your money is in bits and bytes, except sometimes they are also in physical notes, which again mean nothing to nobody outside that country, right? And so it's about regulations, that if regulations allow, you will be able to do what you think should be able to do. But then there are newer technologies come which claim to help you. There are newer technologies come which say that they are doing it better than earlier technologies, and that remains to be seen which technologies actually go and do better than what you do. Like crypto you mentioned about stablecoin. Both are the same part. Stablecoin is just using the digital ledger, distributed ledger technology, and cryptos also use something called distributed ledger technology. So both are in similar ways, but how they are implemented also are very different. Like we are currently experimenting in India with a cryptocurrency called CBDC. That is central bank issued digital currency, and that is a not pure play DLT in a blockchain basis, because at the center still they know who is owning what. If you don't know, it's basically very difficult. Like in 1994 or 95 when I was setting up NSE, I was also working with some of my professors at IIT Bombay, and we were trying to work with a digital wallet where everyone gets a card within IIT, and you can buy small little transactions using that. And so everyone got a digital card, like your hair salon guy and your vegetable vendor and everyone in canteen and all. And the boys and girls would go and buy things, and that it will get cut from their wallet into that other guy's wallet. It will go there. And so that was like from your pocket, money goes to that guy's pocket. At some point in time, people figured that the boys will be able, some of the boys who were smart were able to add few more bucks to their wallet without anyone knowing. And that can happen to what we call digital blockchain and all. So there is a need for a centralized record keeping in a broad sense. And people say that it can get hacked. But what we do is we also keep a backup of yesterday's or day before yesterday's or 3 minutes back's information. So even if the current thing gets hacked, I can go back to unhacked version at some point and restart the entire thing, right? While as in, once you have no centralized framework, like the blockchain and all, you don't, once it gets contaminated, as we call it now in newer world, then you don't know what will happen. So with quantum computer, which you did not talk about, it will be able to break, currently there is prediction that by 2030, probably earlier, it will be able to break all the encryption or cryptology, we call it, available in Bitcoin easily. So what happens is your Bitcoin, somebody will be able to transfer to his name. Even today, you know many people hacking the Bitcoin wallets and all. And so all these things are happening so fast, so rapidly, that what is today considered a sure shot thing may not remain sure shot. What remains sure shot is basically human ingenuity to create the newer technology for good, bad, and start using. And of course, what is positive will finally be accepted by the society. What is negative will not be accepted by the society.
So maybe, we have time for last questions, and take them away from a bit of technology and stock markets. Ashish bhai, you were also one of the founders of founder CEO of Mumbai Indians. So we want to know what went wrong with Mumbai Indians in this year's IPL session.
Again, it's good to be a commentator, right? When players are playing, they face balls at 150 kilometers per hour. And they look like us, they behave like us outside. But try facing a ball 150 kilometers per hour, you can't see that. Right? So they are superhumans who look like us, you know. You see these American movies with superpowered people. These are the super people, the modern sportsmen and all, who are able to see and actually act within that short time frame, right? None of us are. And so it's very easy to, even the best of the cricketers who are now sitting out into the commentary box or somewhere else and making comments are as good as basically the judges who have retired and giving opinions, right? And so it's always good to have opinions, but people who work as a team, how they come about, what happens to the chemistry, what happens to the situations, all those things matter a lot for any team. And I've played cricket myself at a, not that level, but reasonable level. So it's not that you will always win, right? And so Mumbai Indians has been the champion team, 5 times champion out of last.
So whom do you want to see the next captain there?
Again, captains do matter. Leadership has a role to play. Rohit was a great captain. He gave that what I call stability and had ability to also sort of come out with newer ideas. And hopefully they will find somebody who is also able to play that game along with being a great captain, right? Because you can be a great captain like Mike Brearley. I don't know whether you remember England captain Mike Brearley. He was a very bad player. So his place in the 11 itself was always in doubt. But he was so great that he still remained as a captain. But in India, in tennis, we used to have non-playing captain. If you recall, Indian teams used to have non-playing captain. And so if the cricket figures out a non-playing captain side, who knows, you might have much smarter AI becoming the captain at some point.
Thank you Ashish Bhai. Thanks for your time, and you are a wonderful host. Thank you very much.
Thank you.
Thank you, Mr. Chauhan, for sharing your insights on the evolving role of technology. I really liked your point about how technology has blurred borders and also about how we are being watched and tracked all the time. It's something that it's better to live in denial about, but that is the reality, of course. May I now request Suparna Kumar, COO of India Today, to please come on stage to present a token of appreciation to our esteemed speaker. Ladies and gentlemen, just so you would like to know that this volume in Mr. Chauhan's hand is actually a special edition, as India Today completed its 50 years last year. Real estate has long been a preferred investment avenue for Indian families. To discuss why real estate is increasingly being viewed as a powerful wealth creation asset, please welcome Mr. Niranjan Hiranandani, founder and chairman, Hiranandani Group. Everyone, let's give him a warm round of applause. Steering this session is MG Arun, managing editor at India Today. Over to you, MG.
Good morning, everyone. And it's a great pleasure for us to have Mr. Niranjan Hiranandani here on stage to discuss what's happening in the real estate sector And I think, Mr. Hirandani, we are meeting at a day where there is a lot of, at least some positivism after a very, very long and turbulent war. There is some sign, I mean, there are definite signs that finally we are going to have more peaceful times. And also it's a great day because the NSE is planning to list, and I think it's a big cheer for the markets overall. My question to you is, now that we are slightly coming out of, the big rut that we have seen in real estate, in the geopolitics, how does the real estate look like? Because not long ago, we were in a phase where we could see very, very tough times. We saw how in the Middle East, especially in Dubai, which is one of the hottest real estate sectors, we have seen, how things have tumbled there. Now, is it everything looking up right now? What is your view?
Thank you for inviting me over here today. It's always a pleasure to be here with India today. Geopolitics has been really shaking everybody up. One thing which is positive, in spite of the shake-up, was the fact that in the last quarter, we still had a growth of 7.4% GDP growth. So that was in spite of the contrarian winds which were there. So I think that's a positive. The second part is that in the last 2 years, real estate has grown 10% and 12% growth in terms of numbers, also in terms of values. So both these aspects of it have moved forward. The third important factor is urbanization. Urbanization is moving faster and faster. In the next 15 years, 50% of the population will be urbanized, where today we are close to 42%, which also is a growth from 34, 35 to 15 years ago. So I think that urbanization is taking place. Fourth aspect of it is the fact that infrastructure is developing. So let's look at the country. We have 35 kilometers of national highway being added every day. In the next 4 years, we'll double the number of airports that is taking place. We are improving number of ports. Look at Mumbai region. In the next 2 years, we will add 300 kilometers of metro. In contradiction, we had 190 kilometers of suburban rail for the last 65 years. And in next 2 years, we add 300 kilometers. We also will get a new connectivity. We have a second airport. We have the coastal road, which is up till now up to Bandra, which is going to Warsaw, Kandivali, and going up to Bhinder. On the other side, we have the Cross Harbour Bridge, which opens up land equivalent to half the land of Mumbai. We have the second airport, and we are planning the third airport in the Mumbai region. So overall, if you see, there is a development which is taking place, which is high. Whenever development takes place, whether it's in Dubai, whether it's in Singapore, whether it's in any country of the world, China at that time, the growth of real estate will take place at a faster pace than the growth of GDP. My reading is that if we continue to invest into infrastructure, if we continue to invest into various manufacturing, which we are planning to do, in the direction of Atmanirbhar Bharat, real estate from next year onwards will grow at a compound of 15 to 17%. That's the rate of growth that we anticipate for real estate to take over. And definitely there is one aberration. So with all the positive stories that I put in, there is one negative story which worries me tremendously. And that worry is the fact that in the last 2 years, affordable housing numbers have come down by 20%. Unbelievable. I mean, I would have always believed, and my 45 years of experience indicates to me that affordable housing should have also grown at least by 10%. It's a contradiction. We have 20% dropped in affordable housing, and I think worry for the government, for the industry, because you can't not provide for affordable housing in the country, and that is a challenge we have. Of course, we have the PMAY scheme, we have the regulator, all these other factors are there to try and match up for that. but it's still not working. So we will have to, as government, as Naredco, as CRIDAI, all the bodies have to sit together, find a solution for this and do it. So lots of positive in the real estate market in the next 2 years. Fantastic, in fact. I think the opportunity is not, I mean, I can't think of any other sector going better than the real estate sector in the next 2 years. So positive in terms of the sector, but एक जरा खटकता है दिमाग में.
Absolutely right. I mean, the affordable segment is something that a lot of people are looking forward to. We have had policies in the past, but they haven't really worked they wanted. What is the big stumbling block, according to you, that is creating this kind of situation in the affordable segment?
I wish we all had the answers. I think the government would have had the answers ready. There are multiple factors as we see it. The first is land prices. The land prices have gone up much faster than what they should have. I'm not complaining, but the point is it has. So I think that's a challenge in the case of affordable housing. So we have to provide for land price subsidies, which will take care where you provide for affordable housing. Second, the PMAY scheme that has come up has addressed more than 1 crore houses in the urban areas. There's a second round of PMAY 2, but I don't think it's adequate enough to nurture this segment. We need to actually enhance that aspect of it. And the third, we need to see that there is some sort of subsidy which is given. I'll give you an example. During COVID, the government of Maharashtra gave a discount of 50% of stamp duty. They also reduced development charges by 50%. And in that period of time, affordable housing as far as Maharashtra and neighborhood grew quite substantially. So I think there are answers to it, but how do we go about it and do it? Because the government also wants to have money. I'll give you one example. In the case of high-priced housing, which we have in Mumbai today, and this is a question I'm always asked, 50% of the price of the apartment that I'm selling, the apartment I've sold for 60,000 rupees, 30,000 rupees goes to government. Whether it's in stamp duty, development charge, land under construction, cess, GST, etc., etc. You put all this together and I'm paying to government 30,000. I'm not worried about the paying of 30,000. I'm only worried that if you continue to do so, you get a segment of housing which is going to be not affordable to the affordable segment. So that's the challenge. But the markets are lapping up those products. So government says, overall collections are going up, number of apartments are being sold, but that doesn't satisfy me. I think we need to take and pay attention to all this. Luckily, redevelopment, slum redevelopment is taking care of a part of this issue, but not adequate enough across the country. So, fantastic market for real estate. Companies will continue to do tremendously well. Corporate entities will, I think, grow. At least 15% growth of all the larger companies' growth will take place in this current year. And the forward looking at this moment is actually doing it in spite of headwinds. So when the headwinds get out, it could be anything. Of course, there are challenges, but that's another story.
So you are saying that it's a real estate is a good asset for investors to be invested in, as always, because at least in major cities like us, real estate is something that has given good returns. Is this a trend you are seeing across the country, in metros as well as in non-metros, in smaller cities? How do you view, the kind of shake-up that is happening in the hinterland, in other centers, and also both in the residential as well as commercial, because the data center is a big business that has come in. You yourself have a data center. GCC is a equally big business coming in. So give us a picture of that, please.
So real estate now has a broad picture. So we have residential, we have commercial, we have retail, we have hotels. Hotel segment is going to grow at least at 50% compounded per year for the next 3 years. So hotel sector is certainly doing it. The IT sector growth is still continuing to grow in terms of the GCCs and other things. We are going to see tourism in the totality together are going to give differences. Now, earlier you had to buy your house in order to invest into it. Now there is a different route. You can have an IPO, so you go to the stock market. You can go to a REIT, so that's the second market that is going to take place. Fractionalization will take place over a period of time. It's not yet really done. We're talking to SEBI. Hopefully we'll be able to get that also done. So I think all these segments of investments in the next couple of years is definitely going to do there. Also, the data center is going to grow. I think the growth of data center will be about 200% growth per annum for the next 3 years, at least. We expect from whatever the situation today, and that's not going to meet the adequately the growth in this segment, because look at it today. India produces more data than the United States and China put together today. And we store only 20 to 25% of the data in India. So obviously we have an opportunity to work this way and service not only India but also overseas. So that's an opportunity which is there. And of course, with AI coming in, the requirements of data center will still grow exponentially. The rollout of 5G is still not fully rolled out. I think that's going to take place. So a lot of these centers are there. There is tourism of different kinds. We have the sun and sea in terms of the coast. We have religious tourism which is taking place. We have commercial units which are taking place. New centers are going to come up. For example, in Navi Mumbai, you'll have an Aero City kind of a thing. Alibag is going to turn into a tourism destination that we see. So all that is real estate packaged in different ways. Only the investment and the investor can now choose different routes to invest into the same thing, whether through 1, 2, or 3 or 4 methodologies in which you can invest, which was not there before. So I think that part of it is certainly going to grow in the next couple of years as we see it now. And most important, which I should have mentioned, is the fact that we now have a regulator. The Real Estate Regulatory and Development Act has actually brought about a regulator, so the kind of problems that we face for projects which are come subsequent to RERA are much, much lower. So where you would get multiple complaints for all the projects, we still have problems with projects, but it's just diminishing over a period of time as the regulator is done. And you have to remember, it's not like SEBI that you have one regulator in the country. Every state has regulators. So you have regulators who are excellent, like Maharashtra, and you may have certain states where the regulator is not as strong or forward-looking or thoughtful process. So again, regulation as far as real estate is concerned will be different in different states depending on how the regulator is empowered and being able to do it. But the positive angle is that you're more secure today than you used to be. That's the answer.
Great. In fact, you mentioned that the real estate sector always grows a little ahead of the GDP. And I know that you are a great commentator of the economy also, not just about real estate. And whenever we have met, I mean, that is one area where you have focused on. You would like to always talk about more about the country as well, just like the real estate. How do you see, the country's growth happening? We saw the Prime Minister raising some alarm, especially when the Middle East war was going on, that Indians need to be a little more austere. Of course, we are in better times probably now with the peace accord, but there is definitely a need to be cautious on the front because we import a lot, not just oil, but also fertilizers, etc., etc. So given all this, how do you see India's potential, the growth potential, also the consumption story holding up, in the coming days or months? How do you view that?
First and foremost, we have to congratulate the Prime Minister that he talked about Atmanirbhar Bharat. Only when Trump came in that we realized how important Atmanirbhar Bharat is. And thanks to Trump, we are now going to be faster being Atmanirbhar. Number two, energy is going to be a focal point. We will have to go into green energy, whether it is solar, whether it is hydrogen, or it is nuclear power. All these three factors will take place. The use of electric cars, vehicles, will in the next 2 years become compulsory. You will have to stop producing any diesel and petrol cars. Vehicles will be zero.
You already drive a EV.
So I'm just saying that, irrespective of who drives what, we have to do it. There is no question about it. Energy will have to be green energy, and it will be self-sufficient in the next 5 years. We have no alternative. Earlier we thought it was 15, 20 years. Now I think we have to talk about 5 years, and we have to do it here and now. Whether it is nuclear, whether it is solar, whether it is etc., 1, 2 or 3, it doesn't matter. We cannot afford to rely on any external sources of energy in terms of it. It has to come. How we do it? Like we prepare for war, we have to prepare for this war also, because we cannot afford. India has to be Atmanirbhar in terms of energy. There is no choice. You can't do it. This is the second aspect of it which I think we have to do. Education. Today, education in the normal sense is fantastic. National education policy, everything is very, very good. But do you know, in skilling, we are horrible. Let's take the construction industry. Today, in construction industry, we are 2 million skilled construction workers short. 2 million today. So on one side you have unemployment, on the side we have 2 million workers short. A company called L&T CEO mentioned 6 months ago that L&T is 25,000 skilled construction workers short. 6 months ago. In the next 4 years, we will be 5 million construction workers short if we don't skill these workers. And you'll produce graduates who are not going to get employed. And on the other hand, we are short of skilled workers. So we have to follow what Germany has done, what Japan has done in terms of various things, where we have to get into skilling in a much stronger way in order to do it. Otherwise, you'll become like Nepal, where you did a lot of education, didn't give them jobs, and you had to move the government out of the day. So it is very, very, very important for Bharat, for India to do skilling in a much bigger way than just the regular age. I have 45,000 students in my own colleges in Mumbai alone, the 14 colleges that I run.
But and you just got an approval for a skilled university.
Yeah, so we're now working on the skill university. Hopefully we'll do it in the next couple of months. The point is, we have to identify gaps. We have to identify the gaps of energy. We have to identify the gaps of skill education. We have to identify the gaps of mobility, which we are doing. Planning, ridiculous. Look at this place, BKC, the place of the world. Last week when I came here, it took me 45 minutes to go to the Western Express Highway. 45 minutes from the most expensive real estate in the country. Cannot be like that. We have to make those changes. So those gaps, see, we are growing beautifully. The country and the leadership is second to none in the world. I admire the Prime Minister doing. Now what we have to do is pick up these gaps and focus on the gaps. You can't have poverty of people who don't. If tomorrow my unskilled worker comes, I pay him 100, 150 rupees. If he gets skilled, I pay him 3, 4, 5 times the money. And I'm not getting him. it doesn't make sense. So what we need as far as India is concerned, real estate is concerned, all the development that we talk about and all the top line of the stock market and $5 trillion economy, we now need to focus on the gaps which are there and fill those gaps. If we fill the gaps, we will not only get prosperity at the top end, which is the country's poverty, but you will be able to get the per capita income also growing, not only wealth at the top end. We need to have wealth which is across the board, which is there, and we need to do that quickly. So one is the important factor of education, of energy. All these gaps have to be filled. And at the same time, how can you have Delhi having the kind of atmosphere where I get down from the car and I'm coughing because the atmosphere is there. So these are the couple of gaps. So while the leadership of India is beautiful, the growth is fantastic, we are working on defense, we are working on manufacturing, everything is going so beautifully. These 5 or 6 gaps which are there, if we fulfill it, it will be a happiness index which will grow up along with the financial index of India. So we need to do that part of it very quickly, because that focus is there, but it's not adequate enough. So we need to highlight those focuses and gaps that are there to make everybody, not the Desh Atmanirbhar, but a happiness index and the possibility of a prosperity down the line, which is second to none in the world. And the best part is, we can do it. See, bolne mein kuch, it's okay to keep talking. We are very good at talking. I'm also very good at talking. But this is one of those things which we can do. So my worry is not about the fact of something we cannot do. Can you create petrol? Answer is no. So we need to work on the alternatives faster, quicker, better. But I can promise you that the country is growing great. Real estate is fantastic next couple of years. You don't have to worry because I'm speaking on it, but I can tell you, just watch it. It's going to grow beyond what you think it will go.
That is a great, point of optimism. One final word from you, Dr. Hirandani. We have so many people who are looking to invest, maybe already investing in real estate, in the markets as well as in REITs. Could you share a couple of key things that a person who is stepping in new, a new investor, a retail investor, should keep in mind? Maybe a few words of wisdom from your side would be helpful for us.
Well, it depends what you are. If you're so wealthy, then you can build an Antilla. So that's one part of the whole thing. But having said that, I think in India, because we don't have social security yet, everybody has to invest into a house, physical house also. Fortunately, we have tax benefits. The interest rates on home loans is the lowest in India as compared to any other loan that you get. You get 20-year loans which are there, possibility to do it, and you're able to create an asset. If there is inflation, which it has happened in the past, recent past over there, the house is a great inflation assurance. Rentals in important areas are going to go up over a period of years. So if you're living in rental alone, after 5 years you may not be able to afford the rents that you are paying today, may go up in those areas. Alternative places will be there, but you really need to do. So one, I think you need to do it. The second, it depends also on the type of investment you want to do. So let's say, for instance, my in-laws are staying in Chembur, so obviously I'll buy in Chembur. But the growth in Chembur may not be at the same pace as you would get in outlying areas. So let's say Mumbai 3.0 or Panvel or Alibag, the prices are likely to double in the next 3, 4, 5 years. But if you buy in Chembur, you're close to your families, you got to education, you have been brought up there, you're comfortable, so you're going to be buying in Chembur. So depending on where you are, and do it. Number 3, many people are buying a house in a place, but actually working in some other place. So they go and do a rental in the 3rd place. So over a period of time, you're going to see serviced apartments coming up in all the segments of it. So the next target really is going to be co-living, serviced apartments which are going to take place, campuses where a lot of these there, and also you're going to see serviced residential apartments which are going to come up, branded service apartments are going to come up. So different investments, you can invest into serviced apartments like you have invested in Dubai. Many of them have done, you can do that investment. So the outlying areas of cities like Mumbai, like Delhi, like this, the outlying areas prices are more likely to go because infrastructure is growing very fast there. So the price lines are going to do much better than they would do in the city. But of course the city prices are also high. They are not likely to become double because you have invested in the city because they are already high. So you can't possibly. So investor would move in the outlying areas while this is there. But everyone should buy a house. I'm in that business too.
Wonderful. It's great to hear from a person who has redefined the real estate in this country and especially in the city. And a big round of applause to Dr. Niranjan Hiranandani. Thank you so much, sir.
Thank you, Mr. Hiranandani, for sharing your perspectives on the India's real estate sector, but also giving us a reality check on economy, education, and skills. I would now like to invite Anilesh Mahajan, Senior Deputy Editor at India Today, to please come to the stage and present token of appreciation to our esteemed guest. India's mutual fund industry has emerged as one of the strongest pillars of household financialization as investor expectations evolve and market participation broadens. Asset managers are adapting strategies, products, and investment philosophies to meet the changing needs. To discuss the future of investing and evolving asset management landscape, please welcome our distinguished panelists, Nimesh Shah, MD and CEO, ICICI Prudential Mutual Fund. May I request you, sir, to please come to the stage. Mr. Vetri Subramaniam, MD and CEO, UTI Asset Management. Mr. Rishi Kohli, Chief Investment Officer, Jio BlackRock Mutual Fund, and Mr. Kailash Kulkarni, CEO, HSBC Mutual Fund. Welcome everyone. And to moderate this session, I would like to invite India Today's Managing Editor, MG Arun, back to the stage.
So we just heard from one of the icons of the real estate sector as to what portends for the real estate segment as a asset class. Now we have something that is extremely crucial in today's world, and that is mutual funds. And as investors, a lot of us know that things keep changing at a very dynamic pace. Now, most of the questions that I had prepared yesterday are not going to work today because things have changed on the geopolitics stage within our country, etc., etc. So it's a very, very dynamic world that we live in. And here are these gentlemen who really keep a tab on what's happening and take decisions on the spot and how, according to the changes that are happening in the industry, and decide what is best for investors. And that's a very, very daring job, I should say. So let me take my first question to Mr. Nimesh Shah, who is CEO of ICICI Prudential Mutual Funds. We have seen how on the geopolitical stage there has been a pause on the war. I mean, it looks like a peace accord. It could be a lasting peace accord if things go well, and nobody can predict, what's going to happen. India has always been an outlier in the world stage. How do you see India's fundamentals at this point? Is that going to keep the markets steady for some time? I mean, what would you advise an investor who is coming into the market at this point?
You asked many broad questions. So I would say fundamentals are one thing, markets are one thing, right? In the long term. So fundamentals wise, we have always been very good. I think this government since last 10 years, 12 years, we have seen fiscal discipline has never been an issue. So today we have, in last 2-3 years, the markets have not done well, but fundamentally there have been no issues. The fiscal discipline has always been there. Current account was never a problem in the last 2-3 years. The banking balance sheets are clean. The corporate balance sheets are clean. So fundamental macro wise, India had absolutely no issues. What we went through in the last 2 years, we had a very overvalued capital market. In September 2024, and we have been saying it since last 2.5 years, that our markets were way expensive than the rest of the world, and that the rest of the world was also seeing it. So we had good fundamentals always. The markets were a lot expensive. 2 years of time correction has happened. And another thing, why the time correction happened, or we see a lot of negativity when we go to the West or when we go outside India, we see a lot of negativity, but that is primarily due to the valuations that we had. Now the rest of the world has caught up with us, or now the valuation premium of India is not as high as it used to be. It is from say 110%, we have come down to 10%. And at that time, and in March, we had a geopolitical situation, because of which oil, etc., was supposed to be, and it was negative for India. So today, macro-wise, we are okay. Fundamentals-wise, we are okay. Markets-wise, also, we are okay. We are not got a very expensive market. I'm not saying the market is cheap, but the market is not a super expensive market also. The issue right now is, are the foreigners tremendously positive about India? The answer is no. When you talk to them, there is a lot of negativity in India. But what has happened, forget what happened yesterday in terms of peace accord, but what the government of India has announced. See, after 24, when there was a slowdown, because earning per share of the companies did not grow, the government took all the right steps in 25. We had government releasing a huge amount of money because of direct taxes. We had government releasing a huge amount of money to the common man in indirect taxes. So all the right things, RBI was giving liquidity into the system. So everything was right, and war happened. Now what the government has done, to ensure that there is not a fright on rupee, whatever they have announced for the FCNR is going to infuse tremendous amount of liquidity in the country. Okay. So whatever was the gap has been brilliantly done. I think our macros have been managed well, and this is doing well.
Yeah, great point. I mean, we'll come to more of that in a while. Mr. Vetri Subramaniam, I wanted to understand from you something from which Mr. Nimesha was talking about, the flight of the FPIs. And that has something to do with the fact that, of course, the US markets are more attractive than most of the other markets. But all on a sudden, India came to a level where Indian markets came to a level where everybody was exiting. I mean, in the sense that it became one of the worst performers, from where it was. Now that shows that, there is, I mean, people began to talk about the current account deficit, etc., and some fundamental issues regarding foreign investment, the repatriation happening more from the country. So how much of that holds? And are there some kind of cautionary things that you're seeing on this front?
Hello. Yeah. So first, just thinking through the issue of capital and the availability of capital from global investors. It's always going to be a competitive market. But I think the biggest challenge for actually any country, it's not just India specific, in terms of attracting capital has been that the biggest market in the world, which is the US, is literally sucking all the oxygen out of the room, right? So this country, which was at some point maybe just about 40% of the total weightage of global indices, is now close to almost 65 to 70% of the total market cap of all global equity markets put together. So the challenge has actually been that when you have one large market which is growing so well, it's got some of the leading edge companies, it is literally sucking the oxygen out of that room, and then every other country is struggling to figure out where it can get capital from. So it's not something which is unique only to India. I would submit that many countries around the world are having the same problem. We went through what I would say a very sweet spot all the way till about 2000 and maybe 21 or 22, where over a 15-year period, we saw foreign inflows come into our market, maybe 13 out of those 15 years. So it's not that foreign capital does not come to India, but I think Nimesh made the point very well. It's a competitive market, right? When you as a buyer go to buy something, you're looking for where am I getting my best value for money. And maybe in the last 2-3 years, people have come to the conclusion that there is better value for money to be had in some other emerging markets or in some developed markets, and maybe some amount of money has rotated there. But that's a cyclical phenomenon, so I'm not so worried about that. These are self-correcting in nature. They self-correct because market prices correct, and from a foreign perspective, they also correct because the currency corrects. So that's also taken care of. You spoke about FDI. I think India has done a lot over the last few years, and we should certainly, commend the policymakers for opening up so many of our sectors more dramatically towards FDI. I think what we didn't expect was that because domestic market valuations were so high relative to other parts of the world, the same secondary market, which is a magnet for bringing in money, actually became a route through which foreigners could list their entities here at much higher valuations that they were getting in their home geographies and start to take out capital. So I would say very unusual circumstances over the last 2 years where net FDI actually went negative. But if you look at the gross FDI number, it continues to trend in the right direction. So I think again, it's merely a cyclical factor. And because of the pressures on the currency, because of concerns about what might happen going ahead, government and RBI have already rolled out a fairly large armory to take care of that on a tactical basis. Again, to the point Nimesh said, I think the fiscal house, the monetary house, all of it is in good shape. In fact, I would say this is the best shape I have seen in 25 years, of being an active investor. So I think I take a lot of comfort in that. And as far as competing for global capital is concerned, our time will come. This too shall pass.
Okay, this too shall pass. That's a very optimistic note. I come to Mr. Rishi Kohli of Geo BlackRock Mutual Fund. We talked about the fact that the markets have been overvalued. I mean, this is something that one keeps hearing, and that has been cited as one of the disadvantages as far as the Indian context is concerned. What is your view on this, and how do you see things panning out? I mean, now that a few measures have been taken from the RBI side, from the government side, and also we have seen a stoppage to the war that was disturbing the economies. So how do you see things going on from here?
Sure, thanks. I think, Nimesh and Vetri before me have laid out all the broad macro reasons, and completely agree with, whatever they said in terms of the overall stability and India being in one of the best shapes ever. But to, answer the question fully the way you asked it, again going back to from when the correction and the tough part of the Indian equity market started from September 2024 onwards, right? So you had a few years before that which were, amazingly smooth in terms of returns, very high returns for a rolling 3-4 year period. You had a lot of young people coming into the market, right, post-COVID, driven by the fintech platforms. And virtually, if you were to speak to many of them, in that August-September 2024 period, and, I had several interactions with people like that at that time, virtually nobody would, sort of agree that markets can have a 10% correction, right? So that was because no one had seen that kind of a decline for those 4 years. Now, as we know, I mean, 10%, 15% declines in equity market can happen anytime for any small reason. And therefore, there was sort of a lot of unrealistic expectations built into, people's sentiment. Along with that, of course, the valuations had gone a little higher. These things were overstretched, both on a fundamental, technical, whatever kind of analysis you can do. So I think a halt was warranted. And that is what ended up happening, and now it's almost coming up to just under 2 years. So obviously, patience gets affected. Markets is all about patience and discipline, and rewards those with these characteristics. And because the earlier 4 years had been so good, obviously 1.5 to 2 years of such a market is what is troubling people more. In fact, globally there's a lot of data that actually dull returns or loss-making duration. So the duration matters more than the magnitude, right? So COVID, 30-35% sharp crash, quick recovery, people just forgot about it in a few months. Here, the magnitude of the fall has not been so drastic. And the reasons obviously were you are starting from an overstretched position. But just the duration is what is, I think, affecting everyone's sentiment. Having said that, of course, the war, I mean, the overall reason for the market decline coincided with earnings growth not really coming through. Finally, as we know, market long-term rewards earnings, and consistently you saw 5-6 quarters of poor earnings coming through, much lower than expectations, not much growth happening. And that, interestingly, in the last 2 quarters, 3 quarters, we've seen small upticks start happening. March quarter was even better. Of course, when the war started, I think the fear all of us had was that this earnings growth recovery would get a bit derailed, or at least delayed by 1 or 2 quarters. But interestingly, the March quarterly results that have come show that that is not the case. It has still come slightly better than what was being expected by the street. And so that shows that even with the war disruption, actually we have been on a stronger wicket. And therefore, it getting pushed out by 1 or 2 quarters is not necessarily a fear you need to have now.
Okay.
And that with the recent measures, of course, means that you're broadly back on track.
Okay, wonderful. Now, I would like to hear from Mr. Kailash Kulkarni, the CEO of HSBC Mutual Fund. What is your view regarding the fundamentals the macro picture that we discussed here, and also how investors can deal with, the volatility, that happens? I mean, that is something that comes to the mind of every retail investor, right?
Sure. I think my co-panelists have covered a lot of it on the macro, but I agree with them that possibly this is the best macro situation that we have been in after a very, very long time. So when we look at investors, there are 2 kinds of investors, the HNI oriented investors and the retail investors. And I think today, with a good track record of more than 10 years where a large portion of these investors have been with us, I think they have understood volatility. So if you look at a situation today where as Rishi said, you know, it's been a long time. The markets nearly haven't performed, so returns have not been seen. But the retail investors have been extremely patient. They have not been pressing the redemption button unless they really need the money. They have weathered the storm, and they also have seen, there is enough data points today to talk about, wherein we know for a fact that, you know, once the markets recover, I think all this money which has been accumulated, especially through the SIPs at a lower NAV, really will give the bump up to them. So we are seeing a very interesting, very knowledgeable behavior of retail investors as compared to what I would have seen, say, pre-COVID, where there used to be far more panic with the investors. On slight correction, they would press the redemption. And I think there are two reasons why people are so comfortable with asset management mutual funds to say. I think thanks to COVID, the retail investor actually realized the cost of liquidity. So you didn't have the money because your business shut down and you couldn't sell the house which you had. So you had liquidity issues. Whereas a mutual fund, you could just give the redemption and the money would come back, right? So the cost of liquidity is what people realized, and people shift from the traditional assets of real estate and gold towards the mutual fund industry started really becoming extremely prominent from 21 onwards when COVID started to recede. And let me tell you, 2025 wasn't a great year for the industry, but in 2025 we added nearly 7 to 8 lakh new to industry clients in the mutual fund industry. That just goes to show the testimony of how the investors at large are looking at the mutual fund industry. So there's a lot of optimism as we go ahead.
Great. Now let us hear from Mr. Nimish Shah. Mr. Shah, there are so many sectors that are now being talked about, which are supposed to be extremely growth sectors. We talked about, Mr. Hirandani talked about the renewable energy, which is a very important segment, the data centers, semiconductors. I mean, these are new age businesses that are being talked about. When it comes to stocks, what are the sort of very interesting areas that one should, watch out for? And in the sense, where do you see a lot of growth coming in, something that is exciting and maybe, in the long term, because we always say that you should always be invested in the long term. So maybe some tips from you on that.
So on a regular basis, I track 4 numbers if I want to see how the economy is doing. One is power consumption in the country, cement consumption in the country, real estate offtake in the country, and auto sales in the country. Right? This 4 number indicates a lot of things, and all the 4 numbers are in good place. With whatever has happened in the last 1 week, whatever the government, as I alluded to that, the FCNR deposits, plus the banks borrowing, the RBI will support the rate, etc. So I believe a lot of liquidity can come into the country, and I believe it can be upwards of $75 billion, which will come over a period of time. So I think the liquidity with the banks is going to increase big time, and that itself, that banking sector overall, if you see today, somebody asked me where is value, I feel that the private sector banking is trading at a much lower value than what was trading earlier, and I find that is a good investment opportunity, the private sector banks. With that, what is the scenario that we are having? We might have higher interest rates, and we might have inflation. All this helps manufacturing. Maybe in the initial phase the consumption is triggered or whatever in the initial, but ultimately when the rupee depreciates, the depreciation that we have had will help manufacturing in the country. Instead of importing, we should be manufacturing at the price that we are. So manufacturing overall as a theme looks very interesting. Metals mining looks very interesting. So I think this whole India manufacturing, banking, NBFCs will also look good. So banking and NBFC, because if the banks have surplus liquidity, it will go to NBFCs also, it will go to real estate also. So I feel that the whole country, with this 2 years of time correction that has happened, more or less, I think we are in a good wicket right now for the growth to come back. So anything which is with higher inflation, I think manufacturing in India as well as anything where I would rather get into more of the growth projections in consumption plays. I would rather go for hardcore value buys today in say energy sector. Energy is another sector where people have, so asset heavy businesses is what I would like in this kind of environment that we are in. So rather than consumption led, which because of the rupee depreciation can get affected, I would rather go for manufacturing, heavy industries which requires a lot of investments. So that's the kind of sectors that I believe will do well.
That's a very interesting take. Let us have some views from Mr. Subramaniam and on some of the key sectors that one should look at in the current context and how positive the country as a whole looks at this point.
Sure. So one is, first of all, I'll say I sort of agree with what Nimesh said in terms of banking and finance being one of my sort of favored areas, also because I think the valuations are right and the growth opportunity is still significant. But I want to just sort of elevate the argument one level above that. I know a lot of the conversations we have in these kind of forums are about, what sectors are good, what sectors are bad. But because we are at a Smart Money Financial Summit, I would just say on behalf of the mutual fund industry, better you let the smartest decision you can do is let your fund manager take those decisions for you, right? We've seen this data where investors end up chasing all kinds of fads and themes. I've seen it in my career for 35 years. People who have burnt money on technology funds back in 2000, infrastructure funds back in 2007. So my sanest advice to any investor would be that if you are investing for the long term, please look at diversified funds. That is the route to secure your financial goals over the medium to long term. And just on the other point, because you talked about volatility, Arun, what I would actually say is volatility is not a bug of the markets. Volatility is a feature of the market. Sharp drawdowns and corrections are a feature of the market. They are not a bug. Extended time periods during which equities give you zero return are also not a bug. They are a feature of the markets. So what we have to do is prepare investors to say we can't predict when these things will happen in terms of sharp drawdowns, extended periods of markets going nowhere, but can we help you prepare yourself to be able to navigate these situations, because in your 10, 20, 30-year journey as an investor, you are going to experience it. So, I would say that to my mind would be the two smartest pieces of advice I would like to give people. Rather than sectors, leave the sector decisions to your fund manager. They will take it and they reserve their right to change their mind when required.
Wonderful. Mr. Rishi Kohli, what is your view on some of the hottest
Yeah, so I agree with a few things both the earlier speakers, Nimesh and Vetri, have spoken about. At a high level, again, personal view, banks, metals, infra look very interesting. Having said that, important for me to highlight and update everyone. Many of you would be aware, but some of you may not, that at Geo BlackRock we follow a very systematic data-driven approach to even active funds, and therefore we do have a sector rotation fund actually. And but in that we use data. Obviously, it's largely fundamental data kind of things that everyone in this room looks at. But we use it along with other things like flows and analyst sentiment and other things to take decisions. And we go to level 2 of the GICS classification of sectors, which is around 25 subsectors in India. And GICS level 2 means that, let's say, financials, you'll break it down into banks, NBFCs, insurance, etc. Right? And therefore, we have around 17 to 18 of those 25 always in the portfolio. But the weightages can drastically vary from what is there in the benchmark. And we do have a monthly rebalancing process. So some of these sectors I mentioned, have been slightly overweight in recent months. But having said that, it could easily change, by the end of the month. So very different, very interesting approach. And as Vetri was saying that, the funds and fund managers and diversification, let the funds and fund managers do their job, and diversification is really what helps all investors. So I think even a very different approach like what we use is something that investors need to view from that light, because you can also diversify across different styles of investing as well. So that is one takeaway I would say. And lastly, relating to the markets, one very interesting thing in the last 2 years, that I observed was that while markets have been overall tough, and sentiment, as I mentioned earlier, because of the time period has been affecting people. But a good thing has been that there's been very healthy sector rotation happening, right? So you had a few months of almost each sector doing well at different points in time. And if I go back 25 years and look at these kind of phases in my entire career, then what I find is that these are very healthy signs of an underlying long-term secular bull market. There are periods for 3-5 years when that doesn't happen, which is when we should be worried about. But that has not been happening in the last 2 years. So I take that as a very strong indication going forward.
Okay. And Mr. Kulkarni, what according to you would be some of the big bets that, somebody would take in India's current context? Which are the sectors that are sort of shining according to you?
So, the advantage of going last is most of the panelists have spoken about most of the sectors. But I just want to add one of the things what Nimesh said in talk of manufacturing. Within that, if you look at exports as a sector, right? I think that's something till 5 years back, we just had one major trading partner where there was, some big business. Today, thanks to the change of government in the largest economy, we have now managed to sign up multiple FTAs across the length and breadth across the geography. So we are today covering more than 72, 73% of the overall trade is now being covered under the FTAs. And then when you look at it from that perspective, just assume that the disturbances in West Asia come to an end and the economy across the world takes off. With these FTAs, you will see action across multiple sectors. And when you talk of exports, you're talking of fisheries, you're talking of textiles, you're talking of manufacturing, you're talking of defense, pharma, IT, etc., etc. So it's not a single sector.
Textile is also interesting. Textile you mentioned?
Yeah. So, it's across board that you can see.
Because of the FTAs? Because that's
And we didn't have an FTA with EU, we didn't have an FTA with UK. We have signed so many other FTAs across board. I think that's an area. So when you look at sectors, and what we like is there are sectors which are like a single sector fund, very narrow. We don't like those sectors. What we like is a broad sector, say infrastructure. Within infrastructure, there are multiple sub-sectors which are there. I think that's what we really play for at HSBC Mutual Fund. And even like I said, exports, there are multiple sectors within that. And that's what we really like to play as compared to a very narrow fund that is there. But just to put it into context, like I said, the macro has been very good overall. I think we are very confident. Vetri summed it up that volatility is a part of our life, drawdowns are a part of our life. But if you look at the future, if you look at the next 3 to 5 years, we will continue to be the single largest growing economy in the world. Whether it's 6, 6.5, 7, that's a matter of conjecture. Okay. But I think that's what one should look forward to.
Okay, great. So finally, just from each of you, maybe 2 things that one needs to watch out for, 2 trends that you feel, is going to be important when it comes to investing. Maybe it could be macro, it could be something to do with the markets, it could be geopolitical, but 2 things that will influence your decisions, as you look at the world closely. Quickly, if you can.
Inflation and interest rates.
I think for me it would be essentially whether we continue to see a rupturing of the global economy, both in terms of trade as well as the mirror image of that, which is capital flows, because I think that's a rupturing which has serious long-term consequences, and therefore we'll need to watch that.
Yeah, I agree with both the speakers again, so not much to add there. I would say just from an investor perspective, I think, patience, discipline, sticking to asset allocation, sticking to whatever risk management, whatever things you've outlined is super important, because as we know, in the best fund, retail ends up making, poor returns. So that discipline, despite all of us repeating it everywhere, I think still needs to come up the curve quite a lot. So I think, that is something to remember. And the other is the diversification angle, which some of the speakers already talked about, but I think diversification also in terms of the type of exposures one is having. So we had done some global research which showed that stock specific alpha, which is idiosyncratic alpha, sector driven alpha and style alpha, these are three very distinct sources which can also be combined to give diversification. I think in India we don't really think of it like that. We'll think of large cap versus small cap versus mid cap, but not in terms of these three kinds of alpha being very different and we can combine it. So I think things like this, we as an industry can spread more awareness about, which can be very useful.
Mr. Kulkarni?
I'd look at the entrepreneurial spirit of India. I think that's going to be a big change that I see. We are very entrepreneurial and we'll continue to be innovative as we go ahead. That's number one. On the other side, I think client expectation management is going to be a big thing. Because if the expectations run too far ahead of reality, I think that can be a lot of speed breakers. So expectation management also is something which I believe will be a big theme to play. We need to manage those expectations very well.
Okay, one small follow-up question to Mr. Shah, because his answer was very, very precise. Yeah. You said the interest rates as well as inflation. Where do you see both going from here? I mean, things have just changed overnight from maybe last week.
As I said earlier, macro-wise, we are quite steady. There is, within the interest rate, I don't expect it to increase big time. I don't expect it to decrease big time. It's a very steady phase. Macros were always okay. We had a 3-month blip. I think with whatever I said, I'll stick to what I said earlier, that whatever RBI has done over the last 1 week, I think we are in for good times. I think they have done the right step. It will create a lot of positive energy within the country, and that has to be seen. Ultimately, it has to be seen in the earning per shares of the company. While we complain about last 2 years market, but have we seen whether earning per share has grown over the last 2 years? So ultimately, liquidity will lead to more money in the hands of the people, and if it leads to more earnings of the corporates, then we can have a meaningful investment experience.
And inflation?
Inflation, I'll have to watch oil prices, right? So oil prices has corrected. So if oil prices are getting corrected, then inflation has always been benign. And this government has always been, if you see the last 10 years, right? I always started saying that now in this country, nominal growth expectations are lesser, right? Because if you say 6 to 7% is the growth and inflation is lower, right? Then the nominal growth of the country is that much lower. So the expectations from the market also has to be that much lower. I was never able to explain my father also, because he has been investing since 50 years and he was always saying that my money doubles in every 5 years. I make 15% by investing. And I used to try to reduce expectations that nominal growth of the country is not the same as earlier, because inflation in this country is not the same as earlier. Inflation is much more controlled today than what we had 10 years back.
Okay, wonderful. So it was great to listen to all these gentlemen who actually, handle a lot of money for a lot of us. And thank you so much for this interesting conversation, and a big round of applause to the gentlemen out here.
Thank you, gentlemen, for sharing the importance to keep an eye on macroeconomics, trends on inflation, geopolitics, and of course, letting the fund manager do the decision making. I now invite Sahaya Ranjit, Managing Editor at India Today, to present token of appreciation to our panelists.
Look, this investment guru's tips will double your money. Just claim the offer.
एक चम्मच मसालों को अच्छे से मिलाना।
पापा, लेट्स स्पाइसी।
लाइफ हो या इन्वेस्टिंग, अपने गोल्स को पूरा करने के लिए डिसिप्लिन और फोकस जरूरी है। इन्वेस्ट इन म्यूचुअल फंड्स टू अचीव योर फाइनेंशियल गोल्स। Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.
Look, this investment guru's tips will double your money. Just claim the offer.
Double your money from any random group. Pay attention. Promising double returns, they'll lure you in tight. Unverified groups will send fake tips overnight, emptying your pockets before you can fight.
Well said! Well said! Well said!
SEBI and NSE advise consult only SEBI registered advisors and make payments only to verified accounts or UPI ID.
सोच कर, समझ कर, इन्वेस्ट कर।
NSE द्वारा निवेशकों के हित में जारी।
फर्स्ट स्टेप मिस किया? चलिए कोई बात नहीं, लेकिन इसके फ्यूचर के हर बड़े कदम के लिए जरूर तैयार रहिएगा चिल्ड्रन ओरिएंटेड म्यूचुअल फंड्स के साथ।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Of course, he needs no introduction. Mr. Shah, requesting you to please come to the stage, and moderating this conversation again is India Today's managing editor, MG Arun. Welcome everyone.
Good afternoon, everyone. When it comes to the markets, I don't think there is anyone better to explain to us the nuances of what's happening. Something that much of us cannot follow than Mr. Nilesh Shah, who is the MD of Kotak. For several years, he has been the eyes and ears of the markets, and it's a pleasure to have you, sir, here today. In fact, when we were having the sessions earlier during the day, we were saying how things have just changed from what it was till yesterday to what it is today. I mean, we are living in a world of extreme dynamism. So at this point, the markets seem to have liked the fact that the war has sort of ended. We have seen the news of NSE getting listed, etc., etc. From your perch, how do you see what's happening around? And how is it going to influence the decision of investors going forward?
First, thank you India Today for having me over here. Second, there was probably underinvestment in market and shorting in the market that resulted into pullback thanks to the announcement on war. But I think there will be worries ahead in terms of monsoon, in terms of deep technology. So as Nimesh mentioned, the returns will be moderate, volatility will be high, and one will have to manage volatility.
Hello. Yes, we will have to manage volatility, and one of the gentlemen in the earlier session said that volatility is a given. I mean, that is what the market is all about. But for the Indian investors, it has been extremely a kind of a volatile phase. And all of a sudden, things began to be talked about, the fundamentals of the country, and also the fact that on the FDI front, we are losing a lot of money to expatriation, etc. The balance of payment situation came into discussion after several years, I mean, after 91, for instance. What is the actual picture on the macro front?
So one, always go by data, don't go by commentary. The fourth quarter FY26 was surplus. April 26 was surplus. And if we read the commentary in March and April, it was almost as if the world was going to come to an end. So never go by commentary, always go by the data. If we look at the past data, things are all looking too good. GDP growth 7.8%. Corporate results, mid-cap up 36% year-on-year profit growth. Small cap 19%, large cap 12%. Private capex up 10%. Inflation rising but still below 5% handle. So overall past looks very good. It is the future where there is uncertainty. And as I mentioned, we still have to figure out what happens to monsoon. While agriculture is a small percentage of our GDP, water is a substantial portion of our economy. And we also need to figure out what happens on deep tech. Undoubtedly, India has very limited presence in AI trade. And if that trade doesn't reverse, it could have consequences for us. So my limited point, there will be volatility. Yesterday it was oil, today it will be monsoon, tomorrow it will be something else. We need to focus on our asset allocation. We need to focus on our portfolio and keep return expectation moderate.
There has been this concern that the markets are very overvalued. In fact, this is something that has cropped up in some of our discussions earlier also. What is your take on this at this point?
So with the benefit of hindsight, market was overvalued in September 24. Earnings didn't come and valuation was in the 22, 23, 24 band as earnings kept on dropping. Today, earnings growth is assumed quite moderately, about 12-15%. Based on the fourth quarter run rate, it looks like it's achievable, provided monsoon comes fine. And if that earnings growth come through, then 18 times market is fairly valued. It is not as expensive as it was in September 24 with the benefit of hindsight. And it is not as cheap as it was in COVID-20 at 10 times forward. It is fairly valued, neither expensive nor cheap.
So what are the things that one should be cautious of going forward? The oil prices, of course, the war has sort of ended. At the same time, there are experts who say that the kind of issues we have seen, the prices will remain high for quite some time. The disruptions will not sort of get eased overnight. Inflation has already started to creep up in the economy. I think the RBI has also warned to that extent. So what are some of the warning signals that are coming that you would be taking cognizance of?
So Arun, when you go to play cricket, you have already observed pitch, you have already understood the bowler, you have already kind of taken idea of what the fielding is. You don't really care for all those things. When you are there to bet, you will focus on the ball and play the ball on its merit. If it is half volley, swing the bat, go for a 6. If it is Yorker, wicket bachalo. So please don't get too much focused on so many things which are happening around us. Inflation, interest rate, oil prices, policies, they will all change. But the business doesn't change that frequently. It's the price which is changing. Value doesn't change that frequently. Focus on value. Price is what you pay, value is what you get. Are all those noise impacting the value or not? Actually, when you do that calculation, you realize 80-90% of the noise has zero impact on the value. They move needle by a very, very small margin. So focus on playing the ball on its merit.
Have you been concerned as a person who has been an evangelist, I would say, for mutual funds in the industry, by the kind of disappointment a lot of retail investors have had? And we have seen so many of them join the investor force during the COVID period. So how do you tackle that? What would be your kind of advice to them?
So one, Arun, I don't agree that investors are disappointed. If they were disappointed, it should result into flows getting reduced. Flows are nearly all-time high. It should result into complaints that 2-year SIP returns are negative. We are not hearing that. In fact, when we go out, people are saying, Nilesh bhai, 3 saal ka return abhi bhi double digit hai. So I think there are people who are bothered about investors rather than investors themselves. And investors have matured. By and large, over last 3 years, they have put money SIP plus lump sum whenever markets are cheap. And they have taken out money whenever markets are in momentum, where it is SIP minus redemption. And by and large, that pattern has continued. So overall, I don't think so investors have bothered about 2 years return being negative or low. And they have continued taking advantage of those cheaper valuation to build their portfolio. Now, maturity of investors is all courtesy the financial awareness campaign which media has carried out, SEBI, MFI has carried out, distributors have carried out. So hopefully, I think investors have matured a lot, and that will give them advantage in managing volatility.
The government and the RBI has recently taken up a slew of measures to attract FPIs, because that has been a big concern, the outflow of FPIs. So how much of an impact do you think that is going to have? We have seen some of it happening, but on the long term, is that sufficient?
So Arun, what RBI has done is very positive. But please remember, we are borrowing. We are not getting money for free. We'll have to pay higher interest rates and we'll have to repay that. Now think about other options. There's this small country called El Salvador. वो मैप में कहाँ पे होगा बहुत कम लोग ढूंढ पाएंगे. There is a company called Tether from El Salvador. They launched a stable coin backed by gold. And their AUM is $20 billion. Now if people keep gold in El Salvador, no one will trust them. They recognize that and they put gold in Switzerland. Gold Switzerland में El Salvador जैसा brand, and yet they raised $20 billion. Who's the largest holder of gold in the world? Indians. Why don't we allow Indians to launch Tether kind of stable coin backed by gold? Will people trust us? Undoubtedly. Gold भी यहाँ रहेगा और dollar पैसा भी आएगा. And you don't have to pay any interest on it. थोड़ा financial innovation सोचना चाहिए. पुराना playbook बहुत खेल लिया. Time has come to play with new rules. Can we launch tokenization? Can we launch stable coin backed by Indian gold? You will get money and still keep the gold.
That is very interesting. When it comes to the interest that a lot of women investors have, particularly in the markets, that is a phenomenon that we have seen lately. And even several governments are of the view that if you give subsidies, you have to give it to women, because if you give it to men, it never reaches them. So how do you view this big step of more women coming into investing?
So undoubtedly, if we want an equal society, it should start with financial backing. In our society, we have male dominance. And there is this beautiful book by Kundanika Kapadia called Saat Pagla Akashma. It's available in Gujarati, Hindi, English, and many other languages. I'll strongly recommend you to read that book. And I keep on reading that book every third, fourth year whenever I get a chance, so that मैं जमीन पे रहूं. And one example there, कि हमारी संस्कृति में जब हम बहू को आशीर्वाद देते हैं तो क्या बोलते हैं? अखंड सौभाग्यवती भवो. वो आशीर्वाद भी बहू को नहीं देते, अपने बेटे को देते हैं. ये माइंडसेट बदलना पड़ेगा. And how will that mindset change? It can only change if women have financial power. Hence, I'll strongly recommend people, please ensure that you are financially independent. Today, in most women's case, their husband, their sons, their father, their male relatives manage their money. I'm saying all these things, but in my house, my mother's money is managed by me. My wife's money is managed by me. My daughter's money is managed by me. They are also not willing to take responsibility.
Or the risk.
No, it is responsibility, it is not risk.
They think you are the best person to manage the money, like a lot of people.
I'll still recommend all of them from this public domain. You take my advice, but keep control with you. Today I stay with my mother and hopefully I am taking good care of her. But if she was financially independent, she'll have more freedom. I think every woman should take financial destiny in her hand. Do take advice from your male relatives, but keep control with you. And government and industry should encourage that.
So that's a great message for the women in this beautiful hall, as well as those who are listening to us digitally. We are seeing a lot of flux happening in the way the industries are being shaped. There are a lot of buzz around new age industries, semiconductor business, renewable energy. In fact, some of the earlier panelists were mentioning the manufacturing sector, which could come into prominence because of the thrust on self-reliance that the Prime Minister has talked about. He had been talking about earlier, but not many people got the meaning until we faced a situation in the Middle East. So what, according to you, would be some of those interesting segments one should be looking at as an investor?
So I'll just share one incident which kind of shows how easy it is or how difficult it could be. There's this one company in which we have invested. They are making particular kind of machine, but the heart of the machine comes from Germany. And there are only two countries which make this heart, Japan and Germany. And Japan is a global leader in this machine with 50% market share. Now, when this company wants to sell, they have to take permission from Germany whether they can sell it to that counterparty or not. So logical is, can you make controller in India? Obviously it requires money. The government of India and the state government has provided almost 65% by way of capital subsidy. So money problem is sorted out. Then you require technology. Now to make this controller, you require 7 kind of different technology: laser, alloys, precision engineering, molding. They are all available in India, but they are scattered in 7 places. Some public institute, some educational research institute, some public-private partnership. He needs to get technology from the 7 places so that he can make controller. The government is willing to give money, government is willing to provide support. Every week there is a follow-up to check if there is any hurdle. But to get this knowledge from 7 different institutes is not as smooth as it should be. The other advantage which this company is now having is AI. Thanks to AI, knowledge which was restricted in MIT laboratory or a Bell lab is now available in public domain. All of you would have heard about that Australian who was neither a computer scientist nor a medical person. And when his dog got cancer and every doctor lifted his hand, he put the tumor report on AI, find out drug discovery, and cured the dog. So knowledge gap is now getting bridged quite significantly. Now, manufacturing exports will take off provided such entrepreneurs are supported on technology side. There are positives, there are negatives. My bet is that eventually we will pull it off. Thanks to AI, the knowledge gap has reduced significantly. So on engineering exports, on manufactured exports, India will see emergence of small, mid companies which will eventually become large. In the last 30 years, we had one Motherson Sumi. Over next 30 years, we'll have multiple of that.
Wonderful to hear that. And what are some of the other segments that you feel would be interesting other than manufacturing?
So in the medium term, we think banking and financial services should do well. The CD ratios were all-time high, so growth was constrained. With FCNRB, ECB and bank borrowing liberalization, this year's deposit growth should be taken care of. That means their growth will be better than expected and hopefully margins will be accretive with FCNRB deposits. The NPA levels are still under control. The second will be related to hospitals and healthcare. Consolidation is happening on hospital sector. People are spending more money on healthcare and hospitals should continue to do well. The third one is hotel and tourism. We think Middle Eastern tourism will shift towards India. Not foreigners visiting Middle East, but Indians going to Middle East. So domestic tourism should take off and hotels should have high occupancy. So hotels and hospitals should do well. Cement is one sector where there is consolidation and government's capex should continue. Put together, if monsoon is good, then cement also could be a good bet.
It was interesting to note that you talked about tourism and you stressed the fact of domestic tourism because the PM had warned us against international travel. He also warned about gold, usage of gold. How do you see that? Because gold is something that is almost like a parallel investment economy which thrives on gold.
So, in a very simple word, we are like Kasturi Mrug. Kasturi नाभि में है और जंगल जंगल घूम रहे हैं. In last 8 years, our current account deficit was $251 billion. Gold import on a gross basis was $353 billion. Silver, diamond, pearl, they are all additional. We are told we are current account deficit country. We are actually current account surplus country if the gold import was not there. Now, we have imported gold. It's now 125% of our GDP. How do we monetize? One idea I gave Tether, allow Indian startups to launch gold-backed stable coins and market it all over the world. The second could be gold monetization scheme. World over, recycling of gold provides supply to the gold. In India, recycling is far less. We have seen now Titan and other jewelers coming and saying that you can sell your old gold and buy jewelry. We need to push recycling of gold. A lot of gold is in Tijori. That's in black economy. We need to figure out an innovative way to bring that gold out. And finally, gold loan financing. It's now almost 6 lakh crore industry. It's growing at a rapid pace. We need to figure out how to encourage that. Look at the irony. A home loan is a 20 to 30 year product. and it is secured and given to retail investor at 7 to 9%. वही बंदा गोल्ड लेके जाता है शॉर्ट टेन्योर लोन लेने के लिए 3 महीने का, उसको देते हैं 24% पे। मतलब हाउसिंग लोन और गोल्ड लोन में फर्क क्या है? गोल्ड लोन इज शॉर्टर, more liquid, more secured, and yet it doesn't happen. So we need to figure out way to monetize the gold which we are holding.
I think this question was about the NSE, gold monetization. So why don't you ask it? Can you have a mic?
Yeah. So Sailesh bhai, that's a beautiful concept.
Just wanted to ask about whether electronic gold receipts launched by the National Stock Exchange will contribute to gold monetization.
Undoubtedly, Sailesh bhai, it is a beautiful concept. The gold lying with people, if it can be brought via EGR into market, and then jewelers and others can borrow, like the stock lending borrowing mechanism, gold lending borrowing mechanism. And there's no better brand than National Stock Exchange to do it. You have ability to collect gold probably all over the country. Your brand is synonymous with trust. People will be happy to give money or gold to NSC rather than XYZ jeweler. And the jeweler can borrow money with appropriate margin and security. So like stock borrowing and lending mechanism, this EGR is a fantastic step, and I wish we would have launched it 25 years back.
Wonderful. All of us would know that Mr. Shah is not just mastermind when it comes to the markets, but he is also a singer who can, in the sense, you can come up with some very interesting lines according to what's happening in the mood of the country or the markets. What is a song that is coming to you? Last year when you came to us, you did sing. But what is a song that's come to you at this point? Is it a jubilant one or a...
So Arun, this time I have upgraded myself. Now I'm into dialogues rather than songs. So 3 Hindi film dialogues you should remember. First one is Nana Patekar Yashwant. एक मच्छर आदमी को हिजड़ा बना देता है. ट्रम्प साहब ने इन्वेस्टर की हालत ऐसी ही कुछ कर दी थी और आगे भी करते रहेंगे. सेकंड, डॉन को समझना मुश्किल ही नहीं, नामुमकिन भी है. And finally, Trump घायल है, इसीलिए घातक है. So keep watching what happens on the global side.
Thank you. As always, it was wonderful talking to you. Thank you so much.
Thank you, Mr. Shah, for this very interesting conversation and for dissecting the markets for us so simply. I would like to now call Anilesh Mahajan, Senior Deputy Editor at India Today, up on stage to present token of appreciation to Mr. Shah. MG, may I request you to do the honors, please?
फर्स्ट स्टेप मिस किया? चलिए कोई बात नहीं, लेकिन इसके फ्यूचर के हर बड़े कदम के लिए जरूर तैयार रहिएगा चिल्ड्रन ओरिएंटेड म्यूचुअल फंड्स के साथ।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Investing among retail investors than our next speaker. For this session, investing through uncertainty, winning in a volatile market. Please join me in welcoming Ms. Radhika Gupta, Managing Director and CEO, Edelweiss Mutual Fund. Radhika, please. Would like to welcome you to the event. Under her leadership, the company has seen a meteoric rise in assets under management, growing from 6,500 crore in 2017 to 1.7 lakh crore by March 2026. She also wears many hats. She's a hedge fund manager, an entrepreneur, and author of 2 books, Limitless, which is a guide to investing, and Mango Millionaire, which is an effort to simplify money for the Aam Janta. And many of you also know her as a judge on Shark Tank, and I will also be moderating this conversation. Radhika, thank you for joining us today.
I do have a request. Please don't ask me to sing. I sing like a frog. So whatever you do with me for the next, I'm very scared of media. Do not ask me to sing at the end of these 30 minutes.
No, but we'll do a quick rapid fire.
You can do all the rapid fires. I think Karan Johar, I want to sue Karan Johar because he's popularized these rapid fires. And Karan Johar, when he does a rapid fire, he gives people these nice hampers. I mean, if you're answering all these questions, everyone is giving rapid fires with no hampers. But anyway, you can do it.
But we do have a token.
Achha, you have a token.
Okay. We do. So, but let's start with the big picture here. So, given the volatility we have I mean, it is now from a VUCA world, we have moved very seamlessly into a Bani world, right? The brittle, anxious, incomprehensible. So, and now there is a ceasefire announcement, so to say. But how do you believe the market is going to perform from here, and what does investor sentiment look like to you?
So, there is a old Urdu saying that हर किसी को मुकम्मल जहां नहीं मिलता, कभी ज़मीन नहीं मिलती, कभी आसमान नहीं मिलता. And I think in investing, conditions are never optimal, right? And we have a tendency as investors to look at the market as a collection of events. And the reality is, one event has happened. Trump is calm for now. A ceasefire has been announced. And so the immediate risk and negativity around oil prices, in particular, that impact India, is out of the way. But I would just caution you to say that doesn't mean that there is another event down the line. So I think investors, before coming to the current event, have to get used to the fact that investing is a series of short-term volatility and events, but hopefully a long-term journey. I always say that investing in India is a little bit like walking down a road where there is a pot of gold at the end of the road, right? So 5 years later, 10 years later, if you look at Indian equities, they have made money. 5 years later, 10 years later, if I look at the Indian economy, I think you will make money. But unfortunately or fortunately, like the roads of Mumbai, that road to the pot of gold is always under construction and full of potholes, and some flyover is broken and some accident is there. So yes, I think the immediate risk that came out of the event, with oil prices being below now or near 80, at least bodes well for India's macro. But I think geopolitical turbulence is increasingly becoming the reality of what we are going through. What my hope is that if you look at the current year, going into this year, pre the crisis, we actually thought that India would be a relative outperformer relative to the rest of the world, because earnings revival was starting to happen. In fact, if you look at February, FII flows had started to turn positive, and then this whole thing happened. So we think Q1 probably will be a tough quarter, but the market has sort of priced that in. And hopefully in the second half of the year, nothing else impending, you'll come back to an earnings recovery momentum.
But having said that, given mutual fund inflows in our country are still strong, still crossing the 30,000 crore mark. So, I mean, there has been some moderation, but given the macroeconomic events that we are seeing, how do you see this disconnect?
So I actually don't see it as a disconnect. I see it as something structurally very positive, and I must say in the last 6 months, because returns have been more muted, it has become a little fashionable to make fun of SIPs. But the fact is, I joined the industry in 2017 when the national SIP book was a little over 3,000 crores. We are 10x from that level. So that means, and for most of my tenure, I have always heard that market correct hoga, SIP book will be vulnerable and fragile. And actually, despite some amount of stoppages that you're seeing, the SIP book seems to be in good shape. So I think domestic capital conditions continue to be strong. What gives me most heart is the behavior of retail. So if you look at the month of March, where markets fell by 12.5%, actually you got 60,000 crores of net money into equities, 40,000 came into long-only equities. This is very, very heartening. So retail investors, instead of panicking at a time when the world was in crisis, entered at that time, and so far they've been proven right. So there is tremendous maturity in investor behavior and stability around that. Now, could 30 become 28 and 29? Perhaps. Is there always some element of froth in this? Perhaps. But will 30 become 15 overnight? I don't think so.
But having said that, like the maturity of the Indian investor, but we also see a lot of funds are going into small cap funds.
Yeah.
And usually in times of war, I mean, it's usually the large cap funds that are considered to be more stable. So how do you see this trend?
So I have a slightly contra perspective on this whole large, mid, small debate that happens in India. And we conveniently believe that large cap means safe and mid and small means volatile. Incidentally, in March and April, broader markets, which is your mid and small, fell less than large caps because earnings growth in the mid cap space has actually been better than large caps. Now, let's just break it down. India has a very, very unique way to classify market capitalization. Our market capitalization is rank based. So large cap company means 1 to 100 by market cap. The next 250 or the next 150 are mid caps. The balance is small caps. In most parts of the world, and I spent about half my career abroad, there is a market cap based definition. So large caps account for 95% of market capitalization. In India, large caps account for 65-70% of market capitalization, and that number is falling. Actually, if you look at the large cap index in India, it is a largely three sector index, that is banks, tech and energy and metals. If you look at most themes that were to define the next 10 years of India, whether it is capital markets, whether it is hospitals, whether it is clean energy, whether it is premium consumption, most of these are present in the mid and small cap space. India's largest wealth manager is a mid cap company. India's largest pizza delivery chain is a mid cap company. One of India's largest listed exchanges was a mid cap company. So I think mid and small caps are a bit of a misnomer. And I don't think you can say large cap hai, to kam risky hai. Finally, you will be rewarded for earnings growth. And if mid and small caps, by the way, continue to deliver at a better pace on earnings growth, you will see that. By the way, FII capital has also shifted towards mid and small caps.
So where should investors then allocate their fresh capital?
So if I were to build a portfolio for the next 10 years, I would not build a pure large cap biased portfolio. I would build ideally a multi-cap portfolio that has some component of large, mid and small. At the minimum, large and mid. If some want to avoid small caps, then one can avoid small caps. But I would not build a top 100 portfolio. I would at least broaden the universe to top 50. Now, depending on who you are, that could be 60 large and 40 mid and small. My personal portfolio, by the way, is 30% large cap and 70% mid and small.
But you also have a 10 to 15% of your portfolio as international portfolio.
I do.
So, how much of international exposure should Indian investors ideally have? I mean, considering now, with like Korea and Taiwan, they just, with the outperformance in the markets, and India has now moved a little below in the top, being the top economies.
So again, I'll give you some context here, because today, everybody that you talk to is talking about international exposure. And I have a little bit of a long history here, and so just a personal story. So, as I said, I started investing when I was in the US, and the base assumption that I was taught when I started investing is no matter how good an individual market is, even if it is a market like the US, you don't put all your money in that market because different markets do well at different points in time. So I remember moving back to India in 2009. and starting to invest in 2011 when I was a poor entrepreneur doing small SIPs, and I had nothing to do with Edelweiss or the mutual fund industry. One of the first things I did in 2011 outside of doing my basic Indian equity SIPs was go look for an international fund, was go look for a way to invest abroad. Now at that point, I think there were 4 mutual funds that were available that had any kind of international investing involved. So there was a fund by Birla Mutual Fund called International Equity Fund, and I put 10% of my capital there. So fundamentally, the premise of having 10 to 15% of your portfolio abroad, I think is a strong premise. And I think there are 3 reasons for it. One, as I said, different countries do well at different points in times. If you look at 2 major emerging markets, India and China, they are almost uncorrelated in when they do well, because people either allocate capital to India or they allocate to China. So very often with my China fund, I get the criticism कि आपका China fund अच्छा नहीं कर रहा है, India बहुत अच्छा कर रहा है, and then I get the reverse criticism. The second is that I think if you look at India as an economy, while we are a very diversified economy, there are just many themes that are not reflected in the Indian economy today. Today we are talking about the AI play or the semiconductor play not being reflected in Indian markets. But even a theme like deep healthcare research is just not reflected in our, our largest stock exchange till now is not a listed company, right? So many sectors are just not reflected. And third, and very few people like when I talk about this, there is an element of currency depreciation that you benefit from when you invest overseas. So I think overseas investing should be part of the portfolio. My only caution is you shouldn't do it because Korea and Taiwan made a lot of money in the last 1 year. I think when people tend to invest, and the mistake they make in global investing is they tend to be very tactical about it. So when India is doing well, we say home market bias, why do we need to go anywhere else? When the world is doing well, we say, why isn't India doing well? Why can't I access Korea and Taiwan? It's a principle of asset allocation. It should be 10 to 15% of your portfolio at all points in time.
But RBI has a certain threshold for international mutual fund investments, and that is consistently being breached over the last few years. So what avenues does that leave investors here then?
I have to say, I think we are today of course we've hit the RBI limits, but we have a little bit of space. So we allow 5,000 rupees a day in all the Edelweiss international funds. If I tell you the number of consumers that invest in those international funds a month, despite the 5,000 rupee limit, and try to do this clever jugaad of doing a monthly SIP every day. I mean, it's a story for another day. It's absolutely hilarious. So that's the kind of demand. So I think GIFT will become a platform to invest abroad. We are very bullish about GIFT City as a platform. Today we've offered one fund here, which is the Edelweiss Greater China Fund. So we allow people to invest in the Greater China market. I foresee by the end of the year, as Edelweiss itself, we will be able to offer you access to 6-7 funds out of GIFT, most of the major geographies. And I think our greatest challenge is when you invest locally, pre-RBI limits, the experience is very seamless. You know, you can do it like this. We now want to make the digital experience very seamless. We've already started with China, but by the end of the year, I think you will have a lot more options available out of GIFT.
Can you talk to us about these funds from GIFT City, and what are the problems that these funds are trying to address or solve rather for Indian investors?
So I think GIFT as a platform can solve 2 problems for investors. One is for inbound investors and one is for outbound investors. For outbound investors, as I said, access to global markets is a problem. The RBI limits are closed. Of course, you have the option to buy stocks or ETFs directly through some platforms that are enabling you to do global investing. But it's hard enough to do research on Indian equities that I have to sit and decide which companies to buy in China and which companies to buy in Taiwan. So I think with us, for instance, we partner with JP Morgan. We don't manage global money ourselves because we don't have the expertise to do it. But we are providing you access to some of the best managers overseas and giving you that. The second problem that I think GIFT will solve, which I hope is a big one, is the NRI opportunity. I think we as a country need a lot more foreign capital to come. NRIs have had the option to invest in India via the mutual fund route, but then they have to have the whole setup in India. I think inbound via GIFT So we've set up one fund that is a multi-manager fund that allows people to access a basket of Indian funds. So I think GIFT solves problems for the NRI, it solves problems for the resident Indian also.
And there's also this newly introduced SIFs, Specialized Investment Fund. Edelweiss also has one, and I do believe they're performing exceptionally well. So, I mean, what do you think is driving investor interest in specialized investment funds?
So I have to say, I think the SIF asset class was introduced by SEBI. I would say sometime in August, and we were one of the first launches in October. Our SIF platform today, which is the largest in India, is already 5,500 crores when hardly any distribution for this platform has been created. So I am positively amazed by the speed and scale at which investors are looking at new investment options. And I really must thank the regulators and also folks like NSE for having this vibrant derivatives market that has enabled all of this. So I think go back to a year ago and you had investment management divided into two distinct options for investors. There were mutual funds, where fundamentally you were a long-only investor. You could benefit only if markets did well. If markets did poorly, if a stock did poorly, there wasn't any way to benefit. And then you had things like AIF and PMS, which were for the 50 lakh, 1 crore investor. And to be honest, not the most tax efficient platforms. And I started my career on the AIF and PMS platform. Now you've created SIF, which is a platform which has the flexibility of AIF and PMS, particularly around derivative usage, but it has the operational infrastructure, tax infrastructure of mutual fund, and lo and behold, the ticket size is 10 lakhs. So sophisticated investment strategies that were available to the ultra high net worth are now available to the mass affluent. Now, I think again, going back to investor need, one very common need is fixed income. For all the investment we do in equity, everyone wants stable return portfolios. In the current tax regime, if you see mutual fund flows into fixed income, if I ask this audience, how many of you invest outright into fixed income? Most people will not raise their hand because they will say taxation is a huge problem. Can you now, using arbitrage, fixed income and some smart derivative strategies, create products that can deliver you maybe 9 to 10% pre-tax and 8% post-tax, and suddenly a whole asset class gets created for consumers and you see the scale. So I'm very, very bullish on the SIF platform. I think it could be a very, very large business for us going forward.
Even bond yields have been moving higher. So, I mean, if you have to give some advice, what should be investors' fixed income strategy then?
So I think it's a very uncertain time for the bond market. If I had to advise investors, given that you have global yields at 5% and likely, if you look at the spread between US bond yields and India bond yields today, it is at historic lows. So if I have to reckon a guess, India bonds are likely to move up. So I would tell investors not to take too much bond risk, sit at the short end of the curve and look for tax efficient fixed income options. If an arbitrage fund solves your problem, then an arbitrage fund. Otherwise, if a hybrid SIF solves your problem, hybrid SIF. But I don't think this is the time to take duration risk.
Okay, so if I was an investor who's extremely risk averse and I'm building my portfolio today, what should I look at?
If you're an investor who's extremely risk averse, I would buy a combination of hybrid funds. I think hybrid funds are kind of like the khichdi of Indian mutual funds, and I say khichdi in a good way. They incorporate multiple dietary elements into a single meal that is efficient to cook, and it's like a one-pot meal. So I would buy a hybrid specialized investment fund, I would buy an equity savings fund, I would buy a multi-asset fund, I would buy a balanced advantage fund. No matter how conservative you are, you still want some element of absolute return. You also want it in a tax efficient way, but you don't want to see your portfolio down 20%. So I would build a portfolio where the core is anchored around hybrid funds.
And what about a person who starts building the portfolio from scratch but has a good risk appetite?
So again, if you're building something from scratch, I'm a big believer in the thali concept, and as you can see, I'm obsessed with food because everything I talk about is food. So I would build your thali. A dominant portion of your thali will be multi-cap equities. And as I said, I'm a strong believer that mid and small cap needs to be a meaningful part of that. I would keep some space for fixed income and gold because I'm a big believer in diversification. And I would add some exposure to international markets, probably 10 to 15%.
And you have spoken briefly earlier about India as a market, but can you, I would still want to ask you this question about your view on India as a global investment, long-term investment destination.
Look, I am the greatest advocate for long India. And I always tell people my greatest advocacy is that I left the US in 2009 to move back, and till date I rate that as the best investment call of my life. So I'm the greatest advocate for long India. I think my point of view on India hasn't changed, but I think our point of view changes. So in 2024, when markets were where they were, I think there was a lot of optimism. 2 years later, because Korea and Taiwan have done well, and suddenly we've discovered TSMC and Japan has done well, we're starting to question the India thesis. And I don't think we should question the thesis so much. I think if I objectively look at us as a country, we continue to grow at 6 to 7%. We could grow at 8%, but we continue to grow at 6 to 7%. And I think that makes us one of the fastest growing major economies in the world. Growing at, early double-digit nominal growth, when you are valued at 35, 40 PE is not great. But when multiples have corrected and earnings can grow, it's not so bad. So I think we continue to be that. I would go back to a quote Mike Milken had, where he said that every time I see a US company and an American CEO is replaced by an Indian CEO, I feel optimistic about that country. And by the way, someone actually backtested that thesis and realized that if you replace an American CEO with an Indian CEO, you actually have meaningful alpha over the S&P 500. So I think Indian entrepreneurship is unquestionably outstanding. So I continue to be a bull on Indian entrepreneurship. And I continue to be a bull on demographics for the next 20 years. So we have the ingredients. There are things we have to get right. I think we still are not a product nation. We have a lot more to do in terms of R&D spend. Ease of doing business has to get better. So there are a lot of things that we have to get right. But we continue to be one of the fastest growing major economies in the world. That thesis has not changed.
In that context, which sectors, okay, that's a very cliched question, but it is a must ask.
It's a very cliched question.
Yes, but I have to ask, which sectors do you think will drive earnings in the next few years?
So for all the criticisms leveled, I think the best thing about the structure of the Indian economy and the structure of the Indian market, it is that it is a multi-sector economy, which is why I find it's a very cliched question. How much of Taiwan is driven by TSMC? How much of Korea is driven by Samsung? Here in our indices, I think the largest weight is 10% in a single company. And when I meet promoters, when I meet entrepreneurs, if you talk to, I was in a meeting with a group of entrepreneurs. Someone came yesterday from the shoe business and they told me shoe penetration in India is 2 versus 6 globally. I was with someone in the services business and they said 70% of the market is unorganized. I was with someone in the chemical business and they were optimistic, and I am in the capital markets business and I can tell you I'm optimistic. Now, if you are to ask me for sectors that we are currently excited about, I would start by saying capital markets and financials. We do see credit growth coming back. And so we see the banking side of the business doing well. And we continue to be very optimistic about our own business, that is capital markets. I'm sitting with one of the largest potential listed capital markets companies. So that's one. I think India's power needs. We have a serious power deficit. So I think power and defense are ones that we continue to be optimistic about. And if this crisis has taught anyone anything, it is that you have to keep investing in your defense capabilities and in your energy capabilities. And I think the whole element of premiumization of consumption even today, for instance, if you look at a sector like hotels, our bed capacity per 1,000 people is 1/5 of China. The same thing is true of hospitals. So the whole element of premium consumption.
There's this one trend about how women are actually now coming up and investing, and from 2 to 3% of demat accounts, they now own up to 30%.
Yeah.
I mean, while the numbers are phenomenal, of course, but how do you see this trend? Because a lot of times we also hear that all these accounts are managed by their husbands and fathers and brothers.
So I'll tell you the more optimistic statistic. And before I was doing this,
Give me a realistic.
No, I'll give you realistic numbers, right? If you look at mutual fund folios, 25% of them belong to women. But if you look at new additions, 35% are by women. If you look at a brand like ours, and we haven't done too many Women's Day campaigns, 35% of our consumers are women.
Wow.
And it's probably one of the highest in the industry. And I agree, some of these accounts will be managed by fathers, husbands, etc. But if you look at a younger generation of women, women under 35, and Amphi releases this data, they are one of the fastest growing cohorts of investors. So a younger generation of women has more access, is more enabled, wants to be more independent. And I'll tell you something very interesting. I was doing a session for a bunch of women at Kotak right before this. In the last 18 months, every day I get a session from a random group of 10 women, could be economically very well off, saying, just teach us something about financial literacy. So I think the movement is here, it has started, and we should stop this narrative that women can't invest. For decades and decades and centuries, mothers, mother-in-laws, nannies, dadis have been the CFOs of the homes. And we have done that without any press releases and Excel spreadsheets. So we've been damn good CFOs and savers. Translation to investments is happening. So give us a break and make a few movies, man, where women in finance are lead characters, not men.
I mean, after this Titan movie now, I think that's something we need to really think about. Give me top 3 or 4 most important things investors now need to keep in mind while building portfolios.
So I think investors should, I have a small framework that I think works, and it's called BAT. BAT. So B stands for beta, which is just participation in the market. So I think it's important for investors to participate in the market. But I think we're also transitioning from a slightly high return environment to a more volatile and low return environment. The 2 other elements in this framework are A, alpha, and B, T, which is tax efficiency. In a high return environment, all that matters is you're participating in markets. Whether you're doing it tax efficiently, whether you're rebalancing, whether you're getting alpha, doesn't matter when market returns are 30-40% in a year. When you start to move into a 10-12% return environment, I think participation has to be supplemented with precision. So you have to be a lot more precise in building portfolios. Are you doing things in an efficient way? Are you investing in things that are getting alpha? Instead of earning 10% by directly investing in equities, can you do it through a hybrid fund where the cost of that beta is a lot lower? So I think the theme is participation should give way to a little more precision in portfolios.
So since I promised we have a quick rapid fire, so tea or coffee?
Only coffee.
Old or new movies?
Old.
Any dialogue you remember from your favorite Bollywood movie?
Oh, I have thousands of them.
Your favorite one?
I think it's very applicable to markets. So please don't judge me, but my favorite actor has and always will be Shah Rukh Khan, and I like the Shah Rukh Khan old movies, I don't like the new ones. But I think the most iconic one for markets, which is true, is कि बड़े-बड़े देशों में छोटी-छोटी बातें होती रहती हैं. So बड़े-बड़े निवेशों में भी छोटे-छोटे इवेंट होते रहते हैं. कभी ट्रम्प, कभी कुछ और.
And women in boardroom in western sari or in a western wear or a sari?
But do you need to ask me?
I mean, by the way, you are wearing a fabulous sari. It's not embroidery, it's hand painted.
It's actually painted. Nari in a sari, sab pe bhari. And by the way, I must tell you, this is a tribute to Indian artistry. Some lady has actually painted every piece of this cloth by hand. She's an artist who paints saris. This is the kind of talent and craft we have in this country.
I'm sure. I mean, it would have come in video. I was looking at it and smiling. While
Someone's actually painted it.
Yeah, it's gorgeous. And mountains or beaches?
Both here.
Okay, so sari from a designer.
And India has both, by the way. I think if I had to quit financial services, I would either run a sari business or run tourism for the country.
Okay, startups in India or US?
Actually, both. But I think, I don't invest in US startups. I'm an investor in Indian startups, and it's one of the most exhilarating things to do.
Okay, so thank you. So that will be all, and we did exceed our time. But it was a wonderful conversation. I really enjoyed this chat, and I hope you did too.
Thank you so much.
And may I now request MG Arun, India Today's managing editor, to please come onto the stage and present token of appreciation to Radhika.
Look, this investment guru's tips will double your money. Just claim the offer.
Double your money from any random group. Pay attention. Promising double returns, they'll lure you in tight. Unverified groups will send fake tips overnight, emptying your pockets before you can fight.
Well said! Well said! Well said!
SEBI and NSE advise consult only SEBI registered advisors and make payments only to verified accounts or UPI ID.
सोच कर, समझ कर, इन्वेस्ट कर।
NSE द्वारा निवेशकों के हित में जारी।
Wow, so you use this trading app too?
Yes, because it promises guaranteed returns.
Guaranteed returns. Your trading app is authentic, right? Here's the catch. First, they promise guaranteed high returns with a grin. Then trick you to download a fake app and pull you in.
Well said! Well said!
SEBI and NSE advice. Download apps only from the verified apps list on SEBI's investor site.
सोच कर, समझ कर, इन्वेस्ट कर।
NSE द्वारा निवेशकों के हित में जारी।
Wow, so you use this trading app too?
Yes, because it promises guaranteed returns.
Guaranteed returns. Your trading app is authentic, right? Here's the catch. First, they promise guaranteed high returns with a grin. Then trick you to download a fake app and pull you in.
Well said! Well said!
SEBI and NSE advice. Download apps only from the verified apps list on SEBI's investor site.
सोच कर, समझ कर, इन्वेस्ट कर।
NSE द्वारा निवेशकों के हित में जारी।
Look, This investment guru's tips will double your money. Just claim the offer.
Double your money from any random group. Pay attention. Promising double returns, they'll lure you in tight. Unverified groups will send fake tips overnight, emptying your pockets before you can fight.
Well said, well said, well said.
SEBI and NSE advise consult only SEBI registered advisors and make payments only to verified accounts or UPI ID.
समझकर इन्वेस्ट कर
एनएसई द्वारा निवेशकों के हित में जारी।
एक चम्मच मसालों को अच्छे से मिलाना।
पापा लेस स्पाइसी।
लाइफ हो या इन्वेस्टिंग, अपने गोल्स को पूरा करने के लिए डिसिप्लिन और फोकस जरूरी है। इन्वेस्ट इन म्यूचुअल फंड्स टू अचीव योर फाइनेंशियल गोल्स। Mutual fund investments are subject to market risk. Read all scheme related documents carefully.
फर्स्ट स्टेप मिस किया? चलिए कोई बात नहीं, लेकिन इसके फ्यूचर के हर बड़े कदम के लिए जरूर तैयार रहिएगा चिल्ड्रन ओरिएंटेड म्यूचुअल फंड्स के साथ।
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
एक चम्मच मसालों को अच्छे से मिलाना।
स्पाइसी।
लाइफ हो या इन्वेस्टिंग, अपने गोल्स को पूरा करने के लिए डिसिप्लिन और फोकस जरूरी है। इन्वेस्ट इन म्यूचुअल फंड्स टू अचीव योर फाइनेंशियल गोल्स। Mutual fund investments are subject to market risk. Read all scheme related documents carefully.
Gill, and Mr. Madan Sabnavis, Chief Economist at Bank of Baroda. Moderating this session is Anilesh Mahajan, Senior Deputy Editor at India Today. Welcome everyone.
Good afternoon, ladies and gentlemen. I know this is very difficult to, conduct a session just after lunch. Some of you would be yawning. Thankfully, we will be having a very interesting conversation which would hold your yawn for a bit. The session is on the hot money. We have already witnessed in last 48 hours some of very interesting development happening across the world. US is agreeing to have a deal with Iran that might be signed very soon on June 19th. Then we also saw that Fed yesterday, they took a status quo which is giving little bit of relief to many of the investors who were looking at putting their money or taking their money out so they can have little more time to decide. Then we also saw Japan, increasing the rates a bit, and perhaps they are on their 3-decade high now. And all of this would certainly play in the mind of the investors. These are complex situations, and we have with us 3 of the best minds in the country. Madan Sabnavis ji, may I start with you? And D.K. Joshi ji is from CRISIL. Ila Patnaik ji now is part of Aditya Birla Group. Prior to that, she was also part of NIPFP, and before that, she was Principal Economic Advisor to Government of India. Ma'am, I will not, limit my conversation only on your group, but I know that you have an expanded view. All 3 of you have an expanded view. Talk more about the state of the economy. The country needs more dollars. RBI has already done, a lot of, they have taken initiatives. Government of India has taken some of the initiatives. But Sabnavis ji, if I can start with you, how do you assess, the geoeconomics, especially when, we need dollars, and we were battling with the, the outflow of foreign institutional fund. Will many of these factors help in curtailing some of those things? Or we will see only the leverage part coming through the window which RBI has opened up?
Yeah, thanks. See, I do feel that the measures which the RBI has announced are going to be positive for a balance of payments, because all this while I think the contention was that our current account deficit was not too much of a problem. The issue was more with the capital account. We saw FPIs in a negative mood. We saw FDI an anemic number, single-digit number. ECBs had actually moderated last year. So I think even though in the credit policy, quite interestingly, the RBI had mentioned before they announced these steps that India's forex reserves were very high, resilient, covering 11 months of imports. But I think they used this particular opportunity to try and shore up the forex reserves, and therefore we had these announcements in these 3 particular areas. Now, whether these are going to work, the answer is definitely yes. The quantum, of course, is something which is debatable, because we should remember that for something like FCNRB deposits, the kind of allowances which are being made to banks are definitely going to work, and we can expect large amounts to come in. It's going to be a call taken by individual banks as to what kind of interest rate has to be offered, because I think the biggest problem about FCNR deposits is that there is a currency risk which has to be borne. Now today we're saying the currency risk is being taken on by the Reserve Bank of India. So therefore I think this is a happy situation for everyone. If you're looking at ECBs, again I would say it came quite as a surprise that it has been restricted only to PSUs. Ideally it should have been kept open for all companies. That would have been a big bang kind of an announcement to ensure that the ECBs, which probably were around $40 billion last year, prior to that we were in the range of around 60, we could have probably gone well beyond that. But I think in the current environment where we are actually talking of interest rates going up in other countries, especially United States, it would be interesting to see as to how much would be the incremental benefit we're getting, because we should remember that interest rates will be the deciding factor. Currency risk has been partly taken care of by the 1.5% rate which RBI is charging. But there would definitely be a delta in this particular thing, but it may not be a very large number is what I feel. Now, the last thing in terms of FPIs, I think what was done is something which was a long-standing demand from the point of view of foreign investors on a taxation front. So that has been opened up, giving higher facility for higher allowance when it comes to the FAR quota. I think that's also been positive. So I think on the debt side, we can see lots of things happening in a positive direction. But when it comes to equity, I think it's something which was mentioned, whether equity will actually turn positive. I think we'll have to wait for some time, because currently if we look at the Indian markets, I would tend to believe that there's a bit of overvaluation which is there in the equity segment. And FPIs have a variety of markets to choose where to invest. See, one, we should keep in mind that the factor that the overall quantity of investable resources themselves have come down compared to what they were, say, 15 years back. And there are more markets which are available, including China. So I think there will be a reallocation of portfolio, and it will again be interesting to see whether the FPI and equity would turn even marginally positive. Debt, of course, definitely will, because the fact that we are connected to the global indices is something which will help out, which will play out fairly well. So on the whole, I think it's very positive for the Indian economy, for the balance of payments. We were looking at something on a more conservative basis of something around $50 billion with all these three measures. I know there are some market estimates which talk of 100 billion, 120 billion. It could be any of these numbers, but I think definitely as far as we are concerned, it will shore up our forex reserves and do well for the currency too.
Thank you, Madanji. DKG, if I can ask you, sticking to the window which India has opened up. I want to understand whether a global investor can trust government, seeing the flow which we all are expecting to come in, that government will continue and adhere to the commitments they have made. Second, is it a very expensive proposition which we have explored? And third, obviously, is it worth it to have expensive dollars to be there in the Indian system? What is your take?
Well, I think as Madan was pointing out, this is not a current account deficit problem, was not a current account deficit problem until now. I think last year we saw 0.6%, but in India's standout growth performance, I think this was the only wrinkle, that capital was not coming. So even financing a small amount of current account deficit was becoming a problem. Now you have a situation where current account deficit is going to go up because oil prices have shot up. And I think we expect it around 2% of GDP from 0.6. So the requirement of funds is going to rise. And we've already seen that I think even small amounts of CAD were not being financed. So it became very important and currency was taking a beating because of that. So I think this is reminiscent of what happened in 2013 to some extent. I think but this is a larger version of that. And I think this was needed at this juncture, I believe. And this scheme looks like will allow you to tide over this situation of shortage of dollars, because India is not a part of the AI story, so it's not attracting capital on that front. And the valuations being high in India, I think that people always talked about high valuations, but now I think they have come down, but still many believe they are still high. So it became important to press some other lever, I mean, apart from drawing down on your forex reserves. And I think at this juncture, this will give you a window of, one can say, smoothing out, or whatever you might like to say. And I think this was needed at this juncture. So I don't think in the overall scheme of things, this is an expensive proposition. This is what was needed at this juncture.
Pilaji, you were part of New Delhi's circles in 2013, and if I'm not wrong, you were part of the ministry as well. So, as Joshiji also, mentioned that this is almost a situation which is parallel to what was there in 2013. Do you have some caution notes that government needs to follow? Because situation is changing, and with things panning out, in times to come, situation will improve further, which this is what we all are expecting. So do you think there are some caution notes which government needs to follow?
Thank you, and thank you for having me here. I have a two-part answer. The first part is this a change in India's framework for capital controls? For the last few decades, after 91, India has had a very clear framework for capital control and capital flows, and we've had a hierarchy of capital flows. What was that hierarchy? That we prefer investment to debt, equity to debt. Within equity, we prefer FDI to portfolio flows and hot money flows. And within debt, we prefer rupee-denominated bonds. We don't really want debt. That was the framework, and certainly not dollar-denominated. And the whole framework was discouraging those. So one of the things that has been done is rationalization, like the withholding tax, which have been in the works, and people were saying you're going too far when you are discouraging debt flows. So you come to neutrality where you don't have things like the withholding tax. But have we swung in the other direction where we are actually saying, no, we want debt flows. We want dollar-denominated debt flows. And the place where that framework had come from was the large number of countries that have got into trouble, especially developing countries who don't have the exorbitant privilege like the US has, and who got into trouble by borrowing in dollars from all over the world for consumption. I mean, so the borrowing that we're doing, that banks are doing, is effectively so that we can continue to consume more, so prices remain low by the rupee remaining low, the consumer price index remains low, and our consumption remains high, despite the fact that terms of trade have moved against us, and despite the fact that we are not getting the desired capital flows as per the framework of the government and the RBI. So that's my first question. Is that a change that we are seeing? Is the government now saying it's okay to borrow short term? We don't have to, Modi ji's speech about shrinking in caused a lot of fear that we need to control the consumption that we are doing. But after that, has there been a shift that we are not now going to? A current account deficit, if estimated at $100 billion, will now be happily funded by NRIs who will get nearly 10% returns after they've done all the leveraging, which is all what my bank colleagues call me. So that's really one thing that has happened. And I worry and I wonder, and that's my note of caution. If you have changed that framework, please discuss more about it. Before changing this very, very well discussed, and you'll find hundreds of RBI reports that talk about it. My second part answer is what happened in 2013 and how is this different, and what's my note of caution. In 2013, India was part of the Fragile Five. The understanding within the government was that what really had happened was a spillover of the fiscal deficit onto the current account, and how the government achieved macro stabilization after that. In fact, right from 2014, and I had the privilege to be part of many meetings where the PM and the FM would all say we have to stick to fiscal consolidation and to the path of fiscal consolidation, because we don't want India to be fragile. After all, if a country consumes more, consumes plus invests, spends more than it produces, it's going to be seen on the current account, and you'll need capital flows for that. So macro stability was ensured by low fiscal deficits, which meant low current account deficits, low inflation, and the way to having a strong currency was macro stability. We keep our inflation low, we keep our fiscal deficits low, our current account deficits will remain low, and that is what is going to give us a stable currency. Yes, we'll do some intervention, but intervention was not going to be that for 2 years you're on one side only. You're selling dollars. So sale of dollars was not the way through which we were going to have a stable currency. Borrowing, and especially borrowing in dollars, subsidized by the Reserve Bank of India, which is effectively sale of dollars, forward sale of dollars, right? So it is effectively you're impacting your reserves down the road because money has to be returned if you're borrowing it. That for me is a very big change. Now, whether the change is good, whether the change is bad, we're not here to discuss that. It's a very big topic. But all I would say is let government and policy makers please discuss that much more.
Thank you. Your points are taken. DK Joshi ji, she talked about the stability in the domestic markets and all. But we are seeing that geoeconomically things are, moving around. I'm again going back to the Fed. We were all expecting, some positioning at least from the Fed. Although Fed Reserve Chief is a new one, and we all were also expecting or factoring in that he may not change the rates. But, the position he has changed, that no longer, there will be changes in the rates. That has surprised many, and that has led to some behavioral change in the US markets as well. Do you think India needs to watch this very, very carefully? Secondly, Japan also increased rates. We are now looking at how will China, react to these two developments. What sort of caution notes, you are seeing that Indian stock markets need to watch for, and what all India needs to do to stabilize the dollar inflows?
Well, I think to the first part of your question, I think the Fed behavior, I'm not surprised. I think inflation is going up. They have an inflation mandate of 2%. So I think they have to be concerned about inflation. So he's just new, and there is a pivot happening in the Iran-US war. So it's better to wait and watch in this environment. And I think the message from the Fed dot plots, etc., is that there might be a rate hike. I mean, nobody's talking of a rate cut right now. So I think that's an expected stance. European Central Bank has already raised rates, although the growth is near stagnancy there and inflation is high. So I think they have proactively raised. And within other parts of the world also, central banks are acting differently. I mean, within Asia, some central banks are resorting to raising rates to get the capital inflows, like Indonesia, Philippines, etc. Others are not doing that. So it is not the same behavior, and I think India is quite uniquely positioned there, I would say. Our consumer inflation is still under control, and I would say that the forecasts of consumer inflation are also not that high. 5.1% inflation, which RBI has, over 2.1. I think there's a very strong base effect, and despite that, your inflation is not projected to be too high. And now with the truce, I think you will have less pressure on the output side. The WPI is already at 9.7, and it's not surprising. There are several episodes in the past when WPI shoots up, and CPI doesn't shoot up to that level because it's measuring inflation for the consumer. I mean, not everything gets passed on. So I think the issue there is that so far I don't see inflation as a big worry in inflation forecasts. So central bank can choose to stay where they are and wait and watch. Although we have a call of one rate hike sometimes this year, and the positive surprises to inflation or rather the upside to inflation is going to come down because of the war ending. So I would say that central bank is now, as the governor had pointed out, data driven. So whatever the way the information comes, I think they'll react to that, which essentially means that there is a lot of fog right now around the global economy. So in this environment, I think interest rate differentials do matter, and I think this is not 2013. Another point is that in 2013, the US interest rates were extremely low. The gap was wider. Now the gap is very narrow. So you will have to watch that space also. So in that context, taking the measures that they have taken to get capital inflows, I think I would see it as a right measure at this juncture, because you have to create some incentive for capital to come in. And I think this provides that incentive, and I think it will allow you to smoothly address your current account deficit problem, which is on the rise. So overall, I would say that you'll have to keep watching the geopolitical environment, which is quite volatile, fragile, whatever you might like to say. The tariff thing is not over as yet. I think it keeps coming back. So in this environment, I would say I think our policy mix has been broadly supportive, and central bank is just waiting and watching how things play out. And interest rate differentials matter. I think that is the reason why they had to do all this. I mean, so.
Madanji, if I can take the conversation towards you, especially, I want to understand that in last 2 years, a lot of domestic institutional investors, they started replacing many of the foreign investors. And the big narrative in Delhi, it had become that, now domestic players have become, more strong, and they are quickly replacing the foreign investor space. Do you think this is a right scenario, or, the more hype was created, and now when things have gone actually worse, and this spotlight has exposed?
No, I don't think there's anything right or wrong about having more domestic institutional investors vis-a-vis FPI. I think that's the way in which the system moves. But when we're talking of, say, domestic institutional investors, we should remember that who are these institutions we're talking of? We're talking of mutual funds, we're talking of pension funds. Now, it's finally, at the end of the day, it's individuals like you and I who are putting our money out here. So we are the ones who feel that we want to enter the market. So I think if you're looking at the last 2 years, the problem which especially the banking sector faced was on account of the low interest rates being offered. There was a tendency for savers to move away from deposits and move to the capital market. The market, of course, is giving very good returns. It's a different thing that they went into the F&O segment, burned their hands, and then SEBI comes in. So we had all that kind of a story. But I think we should just remember that in the market, when anybody is selling, somebody is buying. So but we normally tend to say that, look, FPIs are selling, so therefore the market is falling. But every time there's a sell, somebody is buying. And here it was a case of the domestic institutional investors who were buying. So I think this is a kind of a game which will be played again and again. That's a normal thing. To the extent that we have more DIIs, purely from the point of view of an economist, I would say it's better for the economy because I don't have this threat of FPIs withdrawing, and I have a problem on the forex market. If it's the DIIs, it's only restricted to the Indian market. The moment I have FPIs who are buying or selling, it also affects my currency market. So I think that's the basic difference which is there. Now, the questions which you raised earlier, I wanted to just give my thing. When we're talking of what the RBI has done today, it must be fairly unique. I think DK and Neela, you can probably correct me if I'm wrong, where you're actually paying the full cost, the full forward cost is being borne by the RBI. Because in 2013, the RBI did it at 3 or 3.5%. You were able to swap your dollars. So this is the first time we have seen that the central bank is saying, I'm taking the full thing. So therefore, it's the more dollars I get, the merrier as far as the banks are concerned, because there's no forex risk which is there. So when you're talking about the caution which is there, that this should not become a habit. You can do it once. Just think of a situation if all central banks all across the world say that we will keep swapping dollars for you all to make sure that situation is going to be comfortable, there could be an issue which is there. The second thing is, well, we are very happy that we're getting in $100 billion or whatever the number is. The important part is it has to be repaid after 5 years or 7 years, whatever the tenure is. So I would just draw the analogy to what's happening to a FDI. Why is it that we're getting $100 billion, 90 to $100 billion gross terms? Repatriations are very high. Now, for example, we had the Korean automobile company which had a IPO. It was an OFS, so you're selling off. So you had a thing of 30,000 crores. I don't know how much of it actually went up in the form of dollars. So all the FDI benefits we got in the past, the person is going to encash. You put in 100 million, you're probably taking 1 billion out. So the number is going to multiply. So we're going to have a similar kind of problem if there is too much of inflow of forex today, because at some point of time we will have to repay it. So the system has to generate those many dollars. So I think these are the two cautionary notes which one should...
Actually, I need an answer from you on this. You are now doing many of these calculations for your living. What should be, the currency's depreciation that in 5 years, the repatriation of, the money should not hurt, the currency's outflow or should not impact the current account deficits, or it should not impact the money management of the government, because we all are expecting that 50 to $100 billion will come in this window, and RBI is taking a hit, not a hit but haircut at least, but still we have to repay the loan, and the repatriation is in dollar to dollar, but people who are taking the money, they will have to pay in rupees, right? So how much do you think that country needs to pay for this, and whether this you should answer, Ila. Yeah, you do many of these calculations for your living now.
So I think good businesses like ours, we hedge fully, and in fact across the group, and I can say that we would go and support policies where companies are incentivized to hedge rather than push the cost of hedging, be our mothers take care of us, that you go take risks, you try to make money and we'll bear the cost of hedging. So we don't support that. Personally, I've done research which shows that even within India, when you've had periods of low currency volatility, businesses don't hedge. When there are periods of high currency volatility, businesses hedge. They are the ones who are taking the risk, they are the ones who are getting the returns. And a policy that encourages them to grow, to mature, because India is becoming globalized. We can't be that infant economy where, we have all taken care of, don't worry, you can take the risk. So, to answer your question, we would support that allow individuals, businesses, everybody to hedge. Make those markets, and I'm sitting in the right place for saying that, okay? Make derivatives markets, hedging instruments, more and more available. Stop putting restrictions on those. Stop saying, oh, ye speculative hai, ye hai, wo hai, and preventing people from hedging their risks is the wrong thing.
DK, my question is about now currency, that government took a lot of efforts, and I know Ilaji was not supportive of many of the moves in holding the currency and selling dollars to hold rupees. So what was your view? Is it a war-like situation where government had to do many of those things, or do you think this was the time when government should have showcased that they will not intervene in managing the rupees value?
Well, I think the central bank has allowed the rupee to depreciate. Previously also they did allow, during 2013 it just went shot through the roof. So I think right now I'm seeing more tolerance to movements on the either side. But if it becomes too intense, I think then the central bank has to intervene. So the macro situation is pretty good, I would say. It is not, the fiscal deficit broadly is under control, not like 2013. You're not fragile five, let me put it that way. I think your inflation is low, and your current account deficit is under control. And still, I think so the problem was very different than in the past. I think when the financing issue is there, how will you correct that? I think you can either announce a lot of reforms, etc., but they also take time to pay off. So in this window of opportunity, I think it was best to encourage and also do some of the things which are going to be useful in the long run, like getting rid of the withholding tax, capital gains tax. I think that will put money into passive instruments. I think it will bring India into maybe the Bloomberg aggregate index. So you will have capital flow in. So that is that's going to be a continuous flow, passive money there. So I think you've done a few things to bring more capital, and few things which were in demand for a long time. This is not, I think, so it's a mix of some sort of reforms, I would say, and also I think and also some sort of incentive to bring money into India, and it will allow you to tide over the situation. You can't become an AI story immediately. You can't correct your valuations immediately. They are correcting slowly. So I think at this juncture, this dose was required because I think there was a lot of pressure on currency.
So Madanji, if you can get a complimentary question of what DKG was replying to. We have taken a lot of decisions to hold the currency, but those steps also will have some ramification. To hold the CPI rate, we decided not to increase the petrol and diesel prices. Then we also decided that corporates will not do the hedging, which Ilaji was also mentioning about. And there were other steps which may have ramification. We decided not to import LNG and decided to cut down on domestic production and import a lot of and produce. So do you think economy will have ramification of many of these things in times to come?
Probably not, because if you see the way in which the government has approached it, it's been a very, very calibrated manner. So even the steps which are taken by the government, I think they initially tried to protect the consumer. Then at some point of time, he said, okay, we will have to increase the prices because the OMCs are running into losses. So I think everything has been done in a calibrated manner. And even in terms of the Forex, so I think it was a good opportunity which was used by the Reserve Bank to get into Forex flows. Not to say that we really require it, because the situation is very much different from what we had in 2013. So I think the things have been handled very, very well to make sure that the economic stability is maintained, both in terms of the domestic economy as well as in terms of the external economy.
Thank you. I think, we are running out of the time now. So, Sonal, back to you. Thank you, ladies and gentlemen, for, giving us time. Ila, Dr. Joshi, Madanji, thank you very much.
Thank you. Thank you for unpacking such critical questions for us. May I now request MG Arun, Managing Editor at India Today, to please come to the stage and felicitate the guests.
Look, this investment Guru's tips will double your money. Just claim the offer.
Double your money from any random group. Pay attention. Promising double returns, they'll lure you in tight. Unverified groups will send fake tips overnight, emptying your pockets before you can fight.
Well said! Well said! Well said!
SEBI and NSE advise consult only SEBI registered advisors and make payments only to verified accounts or UPI ID.
NSE द्वारा निवेशकों के हित में जारी।
एक चम्मच मसालों को अच्छे से मिलाना।
पापा लेट्स स्पाइसी।
लाइफ हो या इन्वेस्टिंग, अपने गोल्स को पूरा करने के लिए डिसिप्लिन और फोकस जरूरी है। इन्वेस्ट इन म्यूचुअल फंड्स टू अचीव योर फाइनेंशियल गोल्स। Mutual fund investments are subject to market risk. Read all scheme related documents carefully.
फर्स्ट स्टेप मिस किया? चलिए कोई बात नहीं, लेकिन इसके फ्यूचर के हर बड़े कदम के लिए जरूर तैयार रहिएगा चिल्ड्रन ओरिएंटेड म्यूचुअल फंड्स के साथ।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
From the world of finance and investing that we have been talking about. So why AI at a financial summit, you may ask? Because artificial intelligence is not only transforming the way we do business, the way we work, but also now how markets operate. The recent launch of Mythos by Anthropic has led to intense debate globally. Even our finance minister, Nirmala Sitharaman, has said that the threat from Mythos is substantial and the stakes are high. To help us understand what Mythos means and whether the concerns are justified or they are being overhyped, please join me in welcoming Mr. Shrikant Velakamakani. Shrikant, sir, request. So Shrikant is the co-founder of Fractal. It's one of the India's leading AI companies. He's also the chairperson of NASSCOM. He's regarded as one of the country's foremost voices on artificial intelligence and emerging tech. So welcome, Shrikant. I'll also be moderating this conversation. But before I go and take the seat there, I would like to understand how many of you have heard what Mythos is? And so, I mean, how many of you really understand what it means and how does it impact us and how we invest? So that gives us a good peg on how to start the conversation. So I guess you have your first question already. What is Mythos and why we should know about it and why should we be concerned about it?
So most of you have probably heard of what foundation models are. Can I have a raise of hands? How many of you have heard of what are foundation models? Okay, you've heard of AI models like ChatGPT. Yes, all of you are using ChatGPT, I suppose. Okay, so ChatGPT and other models like those are called foundation models. And these models have been getting smarter by the day, right? Every day you have a new model being released, and these models are just, the previous versions are smarter, the newer versions are smarter than the previous versions by a lot. And models have moved from what are knowledge models, which could summarize something. You ask a question, you get the answer quickly, or you have a 200-page document, you want a quick summary. These are things that AI was doing very well even back in 2023 and 2024. But between 24 and 25, models became better at reasoning, at being able to do step-by-step thinking, and even being able to give you how they are thinking and therefore get much better answers, make fewer mistakes, and so on. That is 2024-25. And in 25 to 26, the duration of tasks they can perform has dramatically accelerated. So they can take multiple steps. They are called agentic now, in the sense that like a human being, they can take a complex problem, divide into sub-problems, and keep working at it till they find an answer, try multiple methods to get to the final answer, even use tools like web search or logging into a database and getting information, summarizing, doing calculations, maybe even booking flight tickets, all those things it can do, which is called agentic. So between 24 and 26, models have become more reasoning oriented, more agentic. Now what does that mean? It means that models can now even launch cyber attacks. They're getting really good at understanding, let's say, a piece of software, finding vulnerabilities, and also then exploiting those vulnerabilities to get something, like for example, exfiltrating a database or getting privileged user access and therefore shutting the systems down and things like that. So these are all possible today. So what is Mythos? Mythos is the latest model that Anthropic released. It did not actually release. Here's what happened. A researcher at Anthropic. Anthropic is the company that makes Claude, the software called Claude, which has become extraordinarily popular in the last 6 months. So it makes a software Claude. So the researcher who was building Claude, one day he built this new system called Mythos, and as part of testing Mythos, he said, he gave it a task to perform. This task was an impossible task. It could not have been performed by Mythos because it did not have the privileges to perform the task. Right? It had to go and do something. It needed administrative privileges. It did not have access to the internet. So to get access to the internet, it had to go and modify its own system configuration, which it did not have access to, etc. So he gave this in order to test how capable these AI models are, and to also check the governance of these models, which is very critical. Now here's what happened. He gave that test, and then he went to grab lunch, sitting in the garden having lunch, and suddenly he gets an email from the new system called Mythos that says, "Hey, I accomplished the task, all done." And he's thinking, what the heck happened? How did this happen? Because A, it should not have accomplished the task, and B, it did not have access to the internet, so how did it send an email? So they all rush back to check what's going on. Meanwhile, here's what happened actually. The software was, this AI model was able to first look at the system configuration file, realize that it did not have privilege access, writes a malicious piece of code, gets system privileges, then goes and does all the work it needed to do because now it has access to the internet, etc. And then after everything, it cleans up all the files, so cleans up the crime scene in such a way that no one knows what it did. And then it tells everyone that, look, I was just doing my job. You asked me to do this work, I did the work. I did not do anything that you did not permit me to do. So it was also lying about that. So this spooked the world at large, and certainly Anthropic. So Anthropic said, this Mythos model cannot be released to the world. Instead, we'll create what is called as Project Glasswing, because this is so capable, it can find vulnerabilities in every piece of software known to man. So let's just stop it from releasing, give it to a bunch of big companies who have critical systems like JP Morgan Chase or Apple, and these are running some of the most important pieces of software in the world that we have access to. So they said, let's give access to this Mythos so that they can use it to find vulnerabilities and fix vulnerabilities before Mythos is released to the world. So this created a huge havoc around the world, because firstly people were like, what is this Mythos thing and why is it so dangerous, and is it just a marketing ploy by Anthropic, etc. Then came the panic that, hey, why do I not have access? Only 50 companies have access to it. Why doesn't any Indian company have access to it? So India got very excited, and I think across the country and even at the highest levels of the government and banks and everyone got excited that what if somebody uses Mythos-like system to then penetrate the Indian banking system or other systems which are of importance to us, maybe shut down a power grid and things like that. All of these things are possible. So we need access too. This whole thing has played out from April of this year, April 7th when it started, to now June 3rd week. Meanwhile, Anthropic said, okay, we have a Mythos-like system, equally capable, but not as lethal, because we put some safety guardrails around it. They called it Fable 5. They released it 2 weeks ago, and literally 2 days or 3 days, whatever, few days after that release, the US government said, no, you can't release Fable 5. No one who's a foreign national, whether it's an employee of Anthropic and living in the US or living outside the US, no foreign national should have access to Fable 5. And then Fable 5 was shut down as of 3 or 4 days ago, and now we are in that place where Mythos is not released, Fable 5 is not released, and the world is kind of panicking that AI models are getting so good that all our systems are vulnerable. So that's a quick, I know it was a very long winded answer, but I needed to give you this perspective because this is what's going on in the world of AI and cybersecurity.
So Shrikant, now we are concerned about something that we do not have access to, right? So number one, it has been well established with the agency that now these softwares have, that there's a lot to be concerned about, and it's not in hype. But how do we as a country prepare for something that we don't know what it entails, number one? And number two, what does it also tell us about now, is tech the new geopolitical tool that can be used to dictate terms?
To answer your second question bluntly, yes, absolutely. You can see that because we don't have access to the latest tech. And I mean, if you go historically and 500 years, how did countries colonize other countries? Because they had superior technology. So technology has always, whether it is ships or it is about arms or it is about other nuclear technology, there are, throughout the history of humankind, the country that had better technology of the day controlled the other countries that did not have the technology of the day. So this is not something new. It's just the newest version of the same old philosophy. So yes, the answer is to that. Now, what is a threat? Now, one way to think about this is look at a benchmark called meter. It's published by, it's called METR, it's called meter. It looks at what is the duration of a task that an AI can easily match and exceed human performance on. So when ChatGPT was released in 2022 and GPT-4 in 2023, if a human being could take 5 minutes to do a task, AI could match and exceed on that. But if it was a long duration task, involve multiple steps, AI would almost always fail vis-a-vis human performance. That 5 minutes became 1 hour, 2 hours, and with Mythos, it has reached 20 hours. So a 20-hour task AI can do and match and exceed human performance. Example, let's say if you give a smart penetration tester or cybersecurity researcher a very difficult problem, you have to log in, you have to find the vulnerability in a system, you have to log in, you have to move laterally, get access to system, exfiltrate some data, etc. Given this kind of a very complex task, a very, very good penetration researcher would probably take 16 to 20 hours to get that done. Not always going to be successful, but it will involve something like 30 to 40 steps. Now AI is able to take the 30 and 40 steps and do it in faster time than the researcher. So this means that now with more compute and more data thrown into it, these AI models can create a real havoc across all the systems in the world. So I think what we have to think of to answer your first question is that AI systems are going to get more powerful. They will be used for cyber offense, and therefore they must also be used for cyber defense. I think the first thing, that's what we have to do. Second, all the systems that we are currently using are flawed, because over the last 50 years, all software has been built with this whole patching mentality. I will write a kind of a working software, it will have a bunch of holes in it, but over time I will keep patching those holes by writing security patches. Now this was working fine when you found a patch or a hole or a security vulnerability. Then typically you would get 90 days to fix that vulnerability. Then at a certain day you announce that yes, this vulnerability has been found, I fixed it, here's a patch, everybody should implement that patch. And then people would take roughly median time is 20 days to fix the patch. A company, let's say NSE is using Microsoft Windows, and we found a Microsoft Windows flaw by which somebody user can take control of Microsoft Windows and sort of get access to a system. Now you have 20 days, roughly 20 days NSE will take to figure out and apply the patch, all the users being informed and all the, creating all the necessary mechanisms to implement the patch. Now that gap has reduced so that once a vulnerability is disclosed, within an hour, there's already an attack using that vulnerability. So by the time you patch your system, you're already gone. So you have to build system. You cannot be in that patching mentality. You have to fundamentally rebuild software to be more secure.
So essentially, what you're saying, this whole discovery and exploitation. So if you could maybe through an example, you did speak briefly about it. Can you tell us through some examples on what it really means for a software company or for any company rather which works on digital tech?
The implications for a software company is you have to design security, you have to include security by design. It cannot be an afterthought.
Okay, so it can't be that patch mentality.
Yes, you have to fundamentally bring down security into your architecture of your product. You have this new concept called zero trust technology. Again, these are various new things that have come up in the last 5 years, which is a zero trust architecture means that you fundamentally do not trust anyone, even if an access or a request is coming from locally inside your firewall, you still don't trust it till you know exactly who it is and why it is doing it. So there is a whole new way of building software which is fundamentally safer. Companies have to do that, number one. Number two, I think that there has to be someone who's mandating that every piece of software, that any critical piece of software people are using must be tested, rigorously tested by the latest AI models, so that all the flaws are already found and fixed before it is generally deployed at any mission critical situation. So these are the kinds of things that you can do in terms of what the software companies or the companies building these kinds of tech products can do. But I think the biggest problem is all the companies that are not tech companies, who are users of these softwares. Because fundamentally tech companies don't take responsibilities for what happens when a flaw is exploited and somebody takes away data. No one is taking that responsibility. It's asymmetrical. If you make a car and somebody has an accident because of the car company could be liable. But in software it doesn't work like that. So fundamentally we have got to fix that asymmetric incentive that exists, because users have the real problem here, who are actually users of these software, and companies that are using this software.
So do we have any precedents on how it can be solved around the world or in India?
It is a new problem across the world, in the sense that the risks of cybersecurity have really accelerated in the last 2 to 3 years, especially in the last 12 months, massively so. So just to give you some context, like in 2018, 8 years ago, if a piece of vulnerability was disclosed, it would take about 700 days. There was a 700-day gap between a piece of vulnerability being disclosed and somebody using a way to exploit it.
So that's almost like 2 years.
2 years. You had 2 years to fix it. Right? Now that's gone down to 1 day. So that is the change that's happened. So therefore the problem is much more critical and urgent today, and it's right that India and every other country in the world should panic that if they don't have access to the latest AI, neither can they find their vulnerabilities, nor can they have a AI-based cyber defense strategy. That gives them a disadvantage overall.
Usually, like at least in the startup ecosystem, there's always this ethos that you work fast, fail fast, and then you keep iterating for a better product later on. So does that also mean that this mantra is not going to work anymore, especially when it comes to digital technologies?
See, it depends on the users, right? The buyers. If the buyers are willing to buy the software because it is feature rich, there is a software being feature rich versus being secure are completely orthogonal, meaning you can have one without the other. So companies usually make decisions based on the feature richness of a software. So the build quickly, fail fast might work because they can still sell that software. But from the point of view of somebody buying it, they should buy something that is
secure. Okay. So now tell me, where does that leave us, India as a country? Because we have some of the world's largest digital public infrastructure, Aadhaar, and everything now is tech driven. And we have financial markets that are deepening, that are being democratized. So what is the threat that India really has now?
India, like every other major country in the world, runs on software. There's no doubt that we are not going to decrease our reliance on software. We're going to increase our reliance on software. It's just that we have to make them more secure by design. So how do you do that? Have access to the latest AI models,
which we don't have now.
I think that yes, we don't have the latest one. For example, we have access to GPT 5.5, which is almost as good as Mythos. So in terms of testing, people have run these cybersecurity tests. GPT 5.5 is almost as good at finding security flaws as Mythos. Yes, Mythos has been well marketed and so on, but GPT 5.5 is also pretty good. So we don't need to necessarily wait for the US administration to release Fable 5 or Mythos to India, but use a 5.5 like technology, the Kimi K2.7, which is also pretty good. Kimi, which is a Chinese model, pretty good as well. It can also be used in a similar way. So we use the latest models that we have access to, then make sure that all our critical systems that the most important companies in India are running, whether it could be our electricity utilities, or it could be our our stock exchanges and so on, which are the most critical infrastructure. All those pieces of software have to be tested with the latest AI models that we have access to, find the bugs, fix the bugs, and in future make them more secure by design, and have a way by which every major critical company is buying software only that is tested with AI in the first place.
So if you have to give advice to investors, so when we are investing, when investors are they're putting money in softwares, because now a lot of trading, everything happens through digital platforms. So what is it that we should keep in mind? Or is there something that we can keep in mind? Do we have an option?
As individuals?
Yes, as individuals.
Look, as individuals, we just have to, I think the general hygiene of keeping your data and not sort of disclosing your data too quickly, or not putting your credit card information on various sites, however secure they might call themselves to be. These are some of the basic things you can do to make sure that your money, your data, your documents are protected in the best possible way. And if you have an option where to put your money or where to bank your money, etc., find the one which is the most secure of the lot. So you have to exercise some judgment in making sure that this doesn't percolate into financial loss for you.
And from your perspective, because a lot of our systems, financial institution, all the systems are built on some legacy infrastructure software. So what is it that now these institutions need to do to manage the new AI-driven cyber risk that has come up?
First, I think is that we have a very human-based approach to finding and fixing software vulnerabilities, right? So having a much more AI-driven way. See, AI, fundamentally, the war between AI and humans is asymmetric. In the US, there's a popular saying that don't take a knife to a gunfight, right? You don't take a knife to a gunfight, there's no chance of surviving with a knife. In a similar way, there's no chance of surviving the AI onslaught. Almost every cyber attacker is going to use AI to attack. So unless you use a very sophisticated AI-based system to defend yourself, there's no chance. And many of the things that we have done actually with the right intentions, which is human in the loop intentions that we have, may actually be hurting us rather than helping us, because the speed at which an AI moves versus the speed at which a human moves, there's no comparison. So the human in the loop was supposed to review before that action. Let's say he is having dinner or is on vacation or it's a weekend, you're basically exposing because of that. Therefore, you have to have a fully AI-driven system of cyber defense.
But do you think Indian companies, and you talk to them, a lot of them through NASSCOM, so in your perspective, how cyber ready are we? And where do we need to go from here?
The good news is that at NASSCOM, we created Data Security Council of India back in 2008 or 9, I think. And DSCI is now doing some amazing work, and Ashish is on the board of DSCI as well. And luckily the understanding of cybersecurity issues, as well as having access to these AI tools and having these kinds of, let's say, sandbox environments to test everything, exists now thanks to DSCI. So we just have to further strengthen such institutions and make sure that we are listening to their advice and building systems that are secure. So I think this is really, it's an important, very important dimension. It has become even more important in the last 12 months, and the speed at which it is changing, it's going to become inevitable that we address this issue sooner than later.
Yeah, I've been hearing CISO is now as important as a CIO in companies, and the importance is going to gradually increase over
Absolutely.
time. Okay. And there's a lot of conversation about till now we were still talking about that India can still work with small language models, and since and do we really need sovereign language models? But I think, what do you think about that? Does that conversation still hold?
I think it's not an either or. We must access the latest models, and whether they are Indian or Chinese or American, it doesn't matter. The fact that we are able to access these models for our own security purposes is important. At the same time, this also shows the need for India to create its own frontier models. If access to technology cannot be guaranteed, as has happened in the last 1 week, then it means that at some point of time, India faces a threat that the most critical technology, which might have the capability to offensively damage India, is not, or used to defend India, is not in the hands of India. So that is not something you want. So even though we are late to the party, it's an important thing, it's an important lesson for us to build a sovereign AI model, which may or may not be at the frontier level, which may not be at the best, as good as the best model in the world today, but has a path towards that, while still relying on partnerships for the global models, whether it is open source or whether it is models from closed source frontier models.
And where do you think we are in that journey? I mean, we are still talking about it. There is a India AI mission, but how do you see the way forward from here?
No, we have a few promising leads. For example, Sarvam has built a model which is looking promising. We have Bharat Gen building some models which are looking promising. Fractal has built a model for healthcare called Vaidya, which is promising. So we have a few promising leads in the direction, and it shows that with much less capital, we can build a near frontier model or frontier model in India. So I think we should take this as a very encouraging sign and go fully after it. I would say 1.3 billion is the total size of the India AI Mission Fund. It needs to be 10x of that or more, and not on a 3 or 5 year basis, but an annually $10 billion investment would be the right kind of investment. So $50 billion, it's a small amount, because India is a $4 trillion economy. So $50 billion to secure a $4 trillion economy is not a large amount.
So that's food for thought. So thanks a lot for that, and I will end the conversation here. And really appreciate your time. We all, I think, learned a lot. So ladies and gentlemen, let's give him a warm round of applause for teaching us so much about our own security. May I request Ranjit Sahai, Managing Editor at India Today, to please come to the stage and give a token of appreciation to Shrikant.
एक चम्मच
मसालों को अच्छे से मिलाना।
पापा लेट्स स्पाइसी।
लाइफ हो या इन्वेस्टिंग, अपने गोल्स को पूरा करने के लिए डिसिप्लिन और फोकस जरूरी है। इन्वेस्ट इन म्यूचुअल फंड्स टू अचीव योर फाइनेंशियल गोल्स। Mutual fund investments are subject to market risk. Read all scheme related documents carefully.
फर्स्ट स्टेप मिस किया? चलिए कोई बात नहीं, लेकिन इसके फ्यूचर के हर बड़े कदम के लिए जरूर तैयार रहिएगा चिल्ड्रन ओरिएंटेड म्यूचुअल फंड्स के साथ।
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
So ladies and gentlemen, from a new age tech to now gold, something that has been a part of our social fabric for centuries, and in fact is now emerging as a critical asset class for portfolio diversification, inflation protection, and long-term wealth creation. To help us understand the changing role of gold in a portfolio, please welcome Mr. Sachin Jain, Regional CEO, World Gold Council. I also have the privilege of moderating this conversation. Now that's quite a change from my thoughts to gold. But gold consumption itself has been changing dramatically world over and also in India. So before we begin, can you give us a macro level view on how is that happening and what does it tell us about the world order?
Thanks, Sonal. Thanks for having me over. It's an honor and pleasure to be here at your very important platform. And I say important because this is really, I would say, a temple of importance of financial and smart money. So to your point, a few things have happened. And why, while you mentioned that gold has been a part of a social fabric, but go back millennia. It's been not just relevant but important through millennia, through kingdoms, through important central bank decisions. But what's changed, and I think it's interesting, let's go back 30 years, not very long back, just 30 years back, central banks were net sellers. The main consumption of gold was jewelry. Let's fast forward it to today. Today, there's a big diversification, both sectorially and geographically, on the consumption of gold. 74% of gold today is consumed by developing markets of China, India, Middle Eastern markets, and so on and so forth. And the big change that's happened is a sectoral change. So about 20% of gold annually is consumed by central banks, and they bought for strength for the nations and other reasons. About 30% gold is consumed for jewelry, and that's a very different number than what it used to be 30, 35 years ago. About 43% gold is currently consumed for financial reasons, and about 6 to 7% of gold is used for technology. I mean, ladies and gentlemen, all your phones will have gold. All the renewable energy systems will have gold. And I think there's only one number that I'd like to quote particularly. And last year was quite a phenomenal year for gold. The financial demand for gold last year crossed $6 trillion. And if you were to move that into what that means in INR terms, we had a gold trading of 18,70,000 crore worth of gold every single day. And that made gold the most liquid asset of planet Earth. So it's dramatically changed, and in the new world order that you said, the role of gold and the criticality of gold cannot be ignored, both as how countries decide, how geopolitics is forming a new world order, but also in diversification of portfolios.
Wow. So, I mean, you spoke about this whole diversification, and now 43% of gold is now used as an investment. So, and we know that last year gold had hit over 56 record highs, and in fact was one of the top performing asset classes. So do you think this rally is going to now continue with, I mean, the hike in import duty from 6 to 15%?
Well, actually, I mean, as World Gold Council, we can't indicate where the pricing of gold will happen, but you have to look at the pillars on which gold pricing is built on. And one is that there's a very diversified usage. Central banks, jewelry, which is emotional, in a market like India, the role of gold is heirloom. It moves from one generation to the other. It's a very important part of weddings, so that can't be ignored. But also sectorally, when you say central banks are going to be buying, financial markets are going to be buying. So I think it widens the perspective of consumption. And one of the key reasons why we've seen this phenomenal change over the last 2 years in gold, one is of course the geopolitics, right? Which of course wars have been happening and others, and sadly we live in a world where a new war emerges and we almost forgotten what happened last year, right? We used to just sort of move on. But I think the more important reason why it's happening and the criticality of gold is coming forward is the debt situation globally, and particularly in the United States. I mean, today the global debt has crossed $37 trillion, and hence the currency is getting printed left, right, and center, and the confidence on global reserves is moving towards gold. I think that's really the fundamental thing. And I think if you look at the trends on why gold is getting more and more strengthened, is this reason, then geopolitics.
All central banks buying gold.
Exactly. Central banks, reserves, hedge funds. I mean, the importance of gold cannot be ignored. And hence, I think if one was to look at the pillars on what's happening and why gold's where it is, I think it really has a lot of tailwinds in the coming years, and there is potential to get more strength.
But having said that, there has been a lot of conversation. In fact, policymakers have been trying to turn gold, to bring gold out of the lockers, turn it into a productive asset. But having said that, gold is also deeply rooted. You buy it in festivals. It is an integral part of marriages. So, how do I view these two trends? Aren't they at odds with each other?
I think there was recently on the 10th of May, we had a clarion call by our respectable Prime Minister around looking at consumption in a different manner.
Not to buy gold.
And not to buy gold. And I think we all as Indians have to acknowledge that. We all as the gold industry have to acknowledge as to why that's done. And the last decade of this phenomenal growth in India as a nation, and also the destination that he's laid out, which is the Viksit Bharat 2047, where we have the potential to grow or add perhaps 4 more Indias into the $4 trillion that was recently talked about. But I think we have to respond to it. And if the response in the current situation is around pressure on CAD, we all as responsible citizens and industries have to respond. Now, we at World Gold Council have been working on a very important project which we call Swarnim Udan 2047.
Sorry, can you repeat?
It's called Swarnim Udan 2047, which is an aligned view with the Viksit Bharat view. And the intent is that what's the role of the gold industry in 2047 has been very clearly articulated. We'll be unveiling the report very soon. But very important pillars of exactly the roadmap. And 4 or 5 very important themes have come around it. And one of the key themes, which is connected to what you asked me, is the massive or the biggest gold mine in the world is actually the gold sitting in our households. And the key is that it's not about giving it away. It's about how can this gold come to productive use? How can somebody who owns gold can give it to a system where perhaps an interest can be generated and so on and so forth. But we have to build these schemes with the contention of today's consumer. I mean, the fact is that we've had some GMS or gold monetization schemes that have come in, but they haven't performed well. But right now there's a lot of open discussion happening around what needs to be changed. And I think from World Gold Council's perspective, there are 2 or 3 things around it. Number one is it needs to be simple. It needs to be based on technology. Secondly, it has to be privatized, and the ownership and somebody who has to run this has to really run this as a rein de thought to exist, not as the 51st function of an organization where you don't give them impetus. And I think after the clarion call of the respectable Prime Minister, there's been a lot of amplification of these conversations, and I hope that over the next few weeks or months, we will have a clear articulation as to how this gold sitting in households can come out. And just last bit on that is that there's very different numbers that float, whether it's 25,000 tons or it's 32,000 tons, there are different numbers that come out. But we did an analysis as to, and we found out that about 1/3 of this, whatever this number is household gold, is sitting in the form of bars and coins and not in jewelry. See, you could say that I have a very emotional connect with the heirloom jewelry of my family, and I get it. But your relationship with a bar and coin is pretty much financial in nature. And if you were to articulate even just this segment, that's a very large segment that can help the productive usage of gold sitting inside to really get and the consumer wants to hold the ownership, so that if there's an upside in gold, which is the real reason that they have that upside, and also the liquidity that gold brings in.
So Sachin, how does that link to India's growth story? I mean, how can gold be a part of Viksit Bharat?
Great question. And I think when we look at 2047, gold, ladies and gentlemen, I think truly will be a very important pillar of this growth. And there are 2 reasons. One is what's going to happen in India, and I'll narrate a few elements around it, but also what's happening to gold. And we think gold will be the new gold. I mean, there's a lot of changes within gold and technology that are happening, and that'll be the reason. Now, on the first part, when you look at Viksit Bharat 2047, we think there are 5 or 6 key important elements. I've narrated the first one. Second one is, we think that if the right triggers are pressed over the next decade, about 30% of the gold that we consume will come from our own mines. So there's a lot of work happening in that area.
The coal mines that we...
Kolar mine is just one mine, but I think there has to be a sort of change in the policy framework of things and how we can get the real foreign direct investment around mining of gold, but we think there's a great potential there. Secondly, we think that India, we've done very well in diamonds as an exporter to the world, and almost India is today the nerve center of the global diamond business, but we've not been able to do that in gold. And there is great potential, and the clear next steps are set out how India becomes truly the jeweler to the world. And under that project, for example, we're setting up the first global gold innovation center 20 kilometers from here. So that's the second part. We think that gold will help amplify tourism in India, and there'll be gold tourism that'll happen in India.
What is gold tourism?
Well, we're thinking about how the great artisans' work can be brought out to people who are looking for art pieces. But more importantly, you would have heard that we've mapped about 16 important temples in India. And often it's said कि हमारे तहखानों में gold दबा हुआ है, right? We think that there's a potential to bring out the rich heritage of our nation, of our culture out there, and we are working on a blueprint to create museums, world-class museums outside the temples. And I think that if done well, can amplify tourism in India. The last bit, which is actually pretty important, is that while we are such an important consuming market of gold, India has almost no say or no influence in the price making of gold. So we think that over the next few years there will be important changes in the banking regulations, and banking industry and financial industry needs to work closely with the gold industry, that we truly get to a price making position, not just price taking position.
You raised a very interesting point about being jeweler to the world, and considering our love affair with gold is, so ever so lasting, right? And we are known for our artisans and handwork. But how come we do not export jewelry? And it is actually a lot of EU countries like Italy who are known for their fine jewelry, but we are not. And more so when, for diamonds, it is said that half of diamonds come to Surat for polishing. It's half, right?
I'll give you the number.
Yeah. So yeah.
Well, actually, from the diamond point of view, 14 out of 15 diamonds have to come to India.
15, okay.
So it's not half, it's actually all over 95% in volume, and about 68% in value that come to India, which is massive. And that got created over the last 2 or 3 decades. Now, why that's not happened in gold? I think the great entrepreneurship of India will make it happen. I'm certain in my mind that over the next 5 years, you see a very different picture. And why it's not happened is really the fact that of a few things. One is that when you look at the production of how we produce and the manufacturing setups, we still partly, I wouldn't say a cottage industry, but if I can put my hand on my heart and say that 20 kilometers from here is one of the largest manufacturing centers for gold jewelry in this part of the world, and we have massive centers in Calcutta, in Jaipur, in Delhi. But if you look at the working condition of the artisans, it's actually dismal. And the fact is that if we have to be an exporter to the world, we have to put our hand on the heart and make the changes and make the working conditions correct. That's one. Transparency is the other one. The design innovation that you mentioned, there are 2 parts of it. One is, if you have to promote Indian craftsmanship, we have to build Indian design form or the brand India. But more importantly, I'm right now even talking pure vanilla, where we have to be out there in the world and participating in important fairs and things, but be ready in terms of what even global markets are buying. But I think all that work is now initiated. Ministry of Commerce is doing great efforts around it. Gems Jewelry Export Promotion Council is doing great efforts, and I can assure you, next 5 years, I believe 100% that we'll have a very different picture on how we will be a very important part of the jeweler to the world, not just in diamond, but in gold and diamond and everything else.
Okay, so coming back to now, gold as asset class. So how do you see this trend evolving? Do you think that considering now there are SIPs, equities, bonds, do you think that gold will become a smaller part of household savings and investment portfolio, and can it be replaced? It can't be. That is something that you've mentioned.
See, actually, in India, about 40% of the gold consumption comes from rural India. right? That's a massive number. Now, the rural consumer generally is a very simple consumer. I mean, in Bombay and in NSE, you talk about allocations and returns and portfolios, and it's a little complicated conversation for a simple mind. But in the rural India, gold equates to not sort of investments. Gold is a saving. And if you have 10,000 rupees each, you save. So gold is treated like that. And it's regular saving that happens. And I can tell you, people who've been investing in gold over the years can only be very, very happy as to what it's become worth of, right? Now, when you look at the two, hence I say there are two parts of it. When you look at a portfolio scientifically, as Bollywood Council, we've always recommended that if your portfolio has between 10 to 15% gold, scientifically invested, and there's a why I say scientifically is that when you're in India, say, gold to hai hamare paas, it's always a feeling that I have gold, and it's not always in the same proportion as what you might want to believe.
But how do you scientifically invest in gold? Don't you just buy a...
So I'll come to that. So first is that, what is that 15% of your portfolio as a minimum is what a recommendation is. And I also encourage, all your audience to get on a website, and we have a model called GRAM, G-R-A-M, which you can, put your pricing of gold, put different notions of gold, and that gives you a very scientific output as to what that does to your portfolio and hence your wealth. Now, what are the tools to invest in gold, which is what you were asking me. So one is, of course, a traditional format of go to a jeweler and buy gold, right? It's simple. You can buy gold, you can buy coins, bars, and all of that. Of course, it comes with a bit of risk of storing it and other elements. And over the years, we've seen two tools in particular, which we have digital gold, we have ETFs that have come out. ETF is a great form of investment. It's regulated under the SEBI norms, and it's backed by physical gold, so it's no worries, you can trade it typically anytime. And in India, if you just see the growth that we've seen in ETFs, let me give some numbers. 1st of January 2025, we were at about 40 tons of AUM. 1st of January 2024, we were at about 40 tons of AUM of gold-backed ETFs in India. 1st of January 2025, we were at 57.5 tons. So you could say 17 tons is not a big deal, but 17 tons on 40 tons is a massive number. And where we ended last year, as in 1st of January 2026, we were at 98 tons. Now, that's hugely different, and I really believe that a product like ETF is at the cusp of growth. A simple investor on the street still doesn't know ETF. And if I have a magic wand, if I could go back in time, I will change the name ETF to maybe something more simple. ETF seems so dramatically, technical, so to say. And I think there's a lot of work that is happening right now to make ETFs simple. And it is an easy product, you can access it, you can enter gold with perhaps one unit at 200 rupees. So, it's democratic, it's easy. And I think ETF will do really well. So that's one part.
Okay, so two questions here. So one is, what is the science? I mean, because even ETFs are backed by physical gold, right? And also then where is this gold coming from, which banks are then buying when we buy a digital gold product? Because, I also know that a regulator has also been warning against a lot of...
Yeah, so there are two parts of it. We've seen a SEBI regulation, a SEBI warning that had come in December for digital gold. And digital gold is basically there on a lot of apps that you can own gold, and there's a promise that they're holding physical gold back. Today, with the lack of regulation, even with the lack of regulation, we have about 14 crore Indian consumers who bought into digital gold. And post the announcement or the warning that has come, that number has even gone up. So, it's ironic, but that's the reality. Now, should there be regulation? I think the digital gold industry in particular has been really asking for a regulation. They want to get regulated. There is no malified intent to run that business in a manner, but we really believe that with almost no entry barriers to that industry, right? There'll be some night by fly operator who's going to come and perhaps, and runs a risk that some people might get cheated. So there is a risk there for consumer protection, and there's a lot of conversation happening as to how there could be a regulation that comes for digital gold. But digital gold is different than ETF. ETF is a regulated product under the SEBI regulation, so it's a 100% secure product. And I think digital gold will, once it gets blessing, will be a great way by which consumers can invest into gold, and perhaps that gold can be used to productive use. So that's the way I see it.
So overall, in your view, where are we right now in our journey of this whole digitalization and technologicization of gold?
Great question.
And are
I
they
think,
different? Are
yeah.
these
Well, I think if you ask any asset manager over in the Western markets to a few years back, there was so much of reluctance in investing in gold. And even when I talk to a lot of asset managers in our country, there's reluctance because gold has a perception, it has a sort of a backlog of being opaque, not being available, not being accessible, what goes on, purity, all of those things. And I think we are stepping into a world, and there's a lot of work happening. We recently published a report, a paper called Gold as a Service, and I'll encourage you all to read it. There's great investment coming in. But I think what gold will be in the next coming years will be a completely different technological savvy asset. And there'll be three things, the three elements that gold will promise when you can, as an investor, you'll get a huge amount of comfort dealing in this asset class. Number one is that gold will become hugely fungible. It can move from A country to B, A organization to B with a matter of a click, and that'll be fully secured. Number two, it'll be accessible 24/7 like any other contemporary asset class. And the third very important element is that gold will become absolute authentic. It'll be what anybody will claim it to be, both from a caratage point of view, from a size point of view, and so on and so forth. But I think in the next phase of what gold is, it's going to be equitable compared to any contemporary asset class that exists.
So if you have to tell investors, how much of allocation should be made to gold, and also if you can talk to us a bit about silver, considering the returns from silver have actually in the last couple of years overtaken gold. So, and how should the allocation be between these two precious metals now?
Great. To your first question, 100% to gold. No, I'm just kidding. No, but I think, as I said the number before, as World Gold Council, we think a very scientific evaluation is that if your portfolio has about between 10 and 15%, and of course, depending on your personal view of your portfolio, you can up it or make it lower. But 10 to 15 is the bare minimum. If your portfolio is invested in gold, it'll bring a lot of health in your gold. And as I talked about, there are various models in our website that you can come play, put different elements around where you sit on your portfolio and where the risk is, and it does great health and is a great hedge for your portfolio in times that are up and also in times which are down. And we've particularly seen that in 24 to 26, as we go forward. And that's one part. So I think to answer your first question, 10 to 15% minimum will be our recommendation. And on the second part, I don't understand silver very well, and I'm not the spokesperson, but silver tends to be a little more riskier, and it moves fastly up and fastly down. And there was a lot of conversation that the usage of silver is going to move into renewable energy and the industrial usage of silver. But at that pricing of silver where it's gone to, I think that restricts. So I think you will have to get a silver expert to tell you where it's heading to. But I think from a gold perspective, a 10 to 15% is a great hedge and a great diversification.
And also, if you have to tell, so last question, as investors, while 10 to 15% has, you also earlier spoke about this whole investing scientifically. And we have also spoken about this whole digitalization of gold now that is happening. So if you have to give us a little bit of more nuances, because ETF is still, not very well understood. So if you could talk to us a bit more about ETFs, and also about, how should we look at between physical gold, digital gold, ETFs, and maybe some new products that are, I think there's also a new product, electronic gold receipts, that has very recently been launched. So if you can just, break down these products for us and,
No, great. So from a perspective of let's talk about ETF to begin with. The exchange traded funds is a great form of investment. Western markets largely invest only ETFs across globally, particularly the Western markets. And it's a great product. It sits on your demat account. You can see it online. It's completely transparent. It's tradable any stock market hours, and it's backed by physical gold. So I think the fact that it's democratic in the sense that as I said, 1 unit of the ETF could be as low as 200 rupees. So it's democratic from that sense that you can enter or exit the market. and you can earn every element of upside of gold and pay a very small fee to the provider and the banker who's providing it to you. As I said, it's been actually, even the ETFs have been around for long, but the awareness really has kicked off over the last few years. And I believe that ETF is really at the cusp of the growth. People are investing, it's become a part of the conversations of even wealth managers, and institutional investment is going on. There are two elements that have come up. Last year, the China government has opened up the insurance sector to put their assets under management into gold. That happened end of 2025. And we've been talking to the insurance sector here in India, insurance sector and the provident fund sector. The provident fund sector came out with a notification early this year. So they now allow the provident sector companies to invest in gold. And most of those conversations that I've been hearing are to invest not in physical gold but in ETF. Because regulated is digital in that sense. So I think ETF will grow not only because of individual retail investor but also institutional investment. That's going to come in play. And I would encourage your audience to read about it. And I again think that it's regulated, it's easy, it's very pragmatic. The second form, as you said, is digital gold, which happens in most of the apps like Paytm, the Safe Gold. It allows you to invest as low as 10 rupees, so it's extremely democratic. You can come, exit, entry and exit is very simple. However, it's not regulated yet, but it stands today on the promise of the brand. Right? So that's the second part. The most avid one that we see across the country is the physical, that you walk into a jeweler's place and you can buy as much gold you would like, right? The big step that's happened on that front is the great effort that's been done by the government of India. We were involved in that project. Is around the BIS's hallmarking on every jewelry piece. And I can tell you, dear friends, that we all have to be proud that ours is the only country in the world where by law every jewelry piece has to have a mandatory hallmark where you can go back, scan that thing, go online and see what the purity is. So it's great, and hence, an opaqueness of gold jewelry and gold jewelers 10 years back is completely away. I mean, it's transparent, it's there, it's by law. So that's the third form. And you talk about EGR, that's the electronic gold receipts. That actually got introduced a few years back under SEBI. It did not kick off because it has still an illuminati on the GST. So there's work happening to sort that out. But EGR, we believe, will be the understated way by which gold is stored. In the sense that we also believe that the household gold should be converted into EGR. The digital gold companies, because if I say I'm a digital gold company and I have your gold with me, which I'm theoretically buying, and I take a claim that I'm buying, if that's converted into EGR, then it's electronic. So there is no debate. I can press and enter and know whether you have a gold or not. So I think EGR as an ecosystem connected to the banking system and the gold system will be a great way to simplify and to really bring gold lying in different pockets into the real mainstream in the country.
So thank you. We'll end the conversation here. We can see the time's up, and extremely helpful conversation. We learned a lot, and it really helped us decode gold as an investment asset. So thanks a lot.
Thank you, Sonal. Very happy to be here. Thank you.
I would like to invite MG Arun, Managing Editor at... may I invite Anilesh Mahajan, Senior Deputy Editor at India Today, to come to the stage and do the honors, please.
Look, this investment guru's tips will double your money. Just claim the offer.
Double your money from any random group. Pay attention. Promising double returns, they'll lure you in tight. Unverified groups will send fake tips overnight, emptying your pockets before you can fight.
Well said, well said, well said.
SEBI and NSE advise consult only SEBI registered advisors and make payments only to verified accounts or UPI ID.
सोच कर, समझ कर, इन्वेस्ट कर।
NSE द्वारा निवेशकों के हित में जारी।
Wow, so you use this trading app too?
Yes, because it promises guaranteed returns.
Guaranteed returns. Your trading app is authentic, right? Here's the catch. First, they promise guaranteed high returns with a grin. Then trick you to download a fake app and pull you in.
Well said, well said.
SEBI and NSE advise. Download apps only from the verified apps list on SEBI's investor site.
सोच कर, समझ कर, इन्वेस्ट कर।
NSE द्वारा निवेशकों के हित में जारी।
Now we will hear them from those founders themselves who are leading this change. Please welcome Ketan Merchant, Interim CEO, Fino Payments Bank, and Priyesh Ranjan, CEO, Valura.ai. Welcome everyone, and also requesting Anilesh Mahajan, Senior Deputy Editor at India Today, to moderate this session.
Hello, good afternoon, ladies and gentlemen. During the day, we have already talked about the impact of technology impacting the stock markets. We have already discussed some of the issues related to the stability of the economy. Now we are getting into the real game, how monies flow to the end user, and that can be amplified by using the AI. And we all understand India is in a transition mode. Every industry is opening up to this animal called AI, looking for avenues, looking for opportunities, and also trying to capture newer interest areas. And only thing which is not happening is that we are not afraid of AI. Ketan, welcome. Ketan Merchant is Interim CEO of Fino Bank, one of India's largest small bank. And we also have with us Priyesh Ranjan. His Valura AI has already rocked many people in UAE, and now he is setting up his business in his motherland. Welcome, Priyesh.
Thank you very much.
Priyesh, may I start with you only? India is a country of a lot of capital controls. And we understand that, there is a level of trust which regulators and organizations have on the consumers. This is a long battle. So we see tariff barrier as well as non-tariff barrier. In that space, how do you think that, technology can play a role? And secondly, what we need to do right to get onto this vehicle of AI and don't miss the journey?
That's a very pertinent question. Good afternoon, everybody. So we do a lot of cross-border. We are based in UAE. We are setting up shop in India. So I can say that the difficulties that the customer faces in moving money either ways, whether inbound or outbound to India, from India, is tremendously difficult. And it becomes even more difficult when you involve a corporate instead of an individual. Now, I'll answer this in two parts. One is how can digitization work? And before that, I would like to say why is this a problem? The biggest problem that, the reason why this is extremely difficult is the digitization levels at the bank level where the processes have not been digitized properly yet. So if that has not been done and people still rely on manual forms to be filled and to be processed, it will continue to be very difficult, very expensive, and very time-taking to process cross-border transactions. That's first part. Now, how can technology, it will be done in two ways, and if we don't do this right, we will be left behind. The banks on the one hand will have to digitize the process. There is nothing can be built if it is not digitized. That's number one. The AI, on the other hand, will be able to solve this to a great extent because they will do fraud detection much better than any human ever can. They can follow compliances much better in real time, meaning you can have OCRs done, you will have agents who are trained on these kind of stuff. So while the customer is filling up forms, and these forms are very, very tedious, your agents will be able to prompt you what to fill, what mistakes are you making. Now this will reduce your TAT. A lot of times you would see, you try to send the money outside of India, you get stuck and you do not know what to fill here, and then you leave it open and then you never come back. So the TAT increases by many, many days. Imagine there is an AI agent which helps you right on the spot and tells you, hey, this is what you're doing wrong, this is what you should do, or this is a correction you should do. You can do that much, get the things digitized, and then you make the user experience good. So maybe in 3 buckets. First, digitize it. The KYC and the fraud detection gets corrected. Then you make the user experience good, and then optimize the forex rates, maybe have predictive models. So these are how the cross-border part can be solved using AI agents and the latest technologies.
Ketan, if I can broad base the question a bit, a decade ago when payment bank licenses were issued for the first time in India, people talked that this instrument will help in streamlining and positioning the digitalization of the payment system in the country. But now we are seeing that RBI is also tightening the norms, and RBI's scrutiny has increased. So is Ministry of Finance's security. Do you think payment banks need to now broad base a lot of things, and now they need to get into the cross-border mode, plus they deploy many other things which Prayesh is talking about, and since these will be the RBI regulated entities doing it, reforms would happen much quicker than many of us pushing for it.
So it's a very interesting question. I have been asked this question since 2017-18, since I am here. What is the relevance of or larger purpose of payment banks? And I can just say it's not only Fino. I think a couple of other banks, payment banks have also done, massive impact. What is the intent was, he was talking about cross-border. You're giving banking needs to every nook and corner of the country. There are 2 ways to do it off. One is just open a shop everywhere, which is not tenable for a country like India. And the other way, which I was telling Prayesh just before the session, was using the phygital model, wherein, as he was saying, in a relative new-aged banks, lot of processes, because there is no legacy of technology. There are 3 stages of AI in terms of digitization, lack of paper, etc. In some of these payment banks, which are very digitally and technology heavy, or most of it, we've achieved the first 2 stages. Now, just to put a perspective, we open somewhere around 9 to 10,000 new banking accounts on a daily basis, and this is the reach which we have. And I can say there are other payment banks who open even more accounts on a daily basis. Humanly, it is not possible to do that in a manual way, how much ever fragmented and how much ever it is. So my personal sense is there is a lot of scope. Broad basing, maybe cross-border, no, but doing larger part, or maybe doing both sides of the balance sheet, is something which is being contemplated, or which can be really good in terms of the payment bank. Anyway, for us, we are, we've got an in-principle approval from the Reserve Bank of India to go into a small finance bank, and where we intend to operate on a digital platform as opposed to the erstwhile or brick and mortar business. That's where we are attempting to going towards.
Thank you. And when we talk about India, the first story which comes to mind is the digital public infrastructure which India has created. The UPI story, and UPI now we are exporting to the different parts. Then there is another technology called Moja Loop, which is also another open architecture similar to UPI. And many of the countries who don't want to use India story, they are getting onto the Mochalo. But we are seeing that this integration is possible. But still making transaction is cumbersome. And before moving to AI, Ketan, if you can tell me that what needs to be done to fix it? And do you also feel the same way in the domestic market?
Yeah, so first things first. Sorry, is this a question to me?
But the question was
because
tossed upon
I think public infrastructure wise and local, I mean what you guys are doing is phenomenal. And honestly, public infrastructure wise, India has done a phenomenal job with UPI. I cannot speak more. It's crazy good. That's all I can say. The only problem is we need to solve, and UPI is being used in UAE also. There are a lot of other countries which are adapting, taking the technology that India has built and adopting in their respective countries. The only problem is the two infrastructures are not being connected. And if we can so much as solve this, and a digital bank such as what Fino is doing will go a long way in helping this cause, because it will set the foundation on which other things can be built. Now, just to give you a sense of how bad the problem is, Indians outside of India invest approximately $2 trillion anywhere across the globe. The percentage that comes to India is only 1%. Just 1%. That's it. That's around $20 billion, $25 billion that's your FDI. You increase it to 2%, your entire problem of FPI running away, your stock market falling, your rupee moving this way, that way, dollar up, down will be sorted if you can get the Indians to go from 1% investment in India to 2% investment in India. That's it. How can you do that? You don't have to sell the India story. It's already sold. 90% of the time, people do not do business, send money to India is not because they don't believe in the India story. That's not the case. It's extremely cumbersome.
Thank you, thank you. Ketan, my question is still there.
Yeah, and we are going to have very interesting dichotomy of answers out here. Priyesh rightly said, the challenges which are vis-a-vis the global payment outlook or the global this thing. I'll just go back to the Bharat, where we cater to, and Bharat is definitely not the room where all of us are. Bharat is in the real rural India, and let me tell you, and which is what he was also saying, UPI has completely revolutionized. For a bank of our size, we approximately do, in FY26, 1 crore digital transaction in a day. So I am just reversing the question. If a digital transaction was as difficult, for a bank of our size may not be doing a 1 crore transaction. So I think it's changing. It's about the mindset and the pace. India being Bharat being a self-consumed economy, if we get the genesis right at the root cause of Bharat, I think adoption of all of this will further aggravate in a positive manner.
Priyesh, if I can talk about positive things about the technology. AI is transforming in various geographies, how underwriting happens or how wealth management happens and how people, even for health matters, people take advice from AI and then try to deploy it. But in a structured way, do you think that wealth management type of, complex subjects can be democratized and people who may be, outside the ambit of the sophisticated wealth management and other, ambits can take, benefit out of it? What is your view on this?
Absolutely, yes. I think AI, will it revolutionize wealth management? Well, it already is revolutionizing wealth management. How? If you look at the wealth management journey or an investment journey of an individual, for simplification, let me put it in 3 buckets. One is the planning. The second is the execution. And the third and the most important and the most neglected part is the monitoring. So for the planning, I don't think any of us, and I'm guilty of the same, we do not do any planning whatsoever about what we want our money to do, what does it want to achieve, nothing. Well, guess what? You don't need to do that anymore. There is an AI agent, or there are AI agents, lovely AI agents who can do it for you. That's so much easier. You take their output, you do a quick review, you're good to go with the planning. Then investment side. Which human, let's say, how many parameters on a stock would you be analyzing? 5, 10 PE ratio, PB ratio, ROI, ROC, 5 ratios. Why can't you be studying 500 ratios? That's point number one. And AI can do that for you. Second, how many stocks can you study before you can invest? Maybe 10, 20? If you are very avid, 50 stocks? Why not 5,000? That's where this comes. How many years or quarters can you study? Maybe 5 quarters, 6 quarters? Why not 50 quarters? Now you look at 5,000 stocks, you look at 500 parameters across 50 years of 4 quarters, so 200 results. How can a human do that? It's not possible. So therefore, it's imperative, it's compulsory. If you don't do that, you'll be left behind. And last but not the least, let's say you have made the investment. And then what? That's not the end of it. Making the investment, it's like Abhimanyu going into the Chakravyuh. You still need to come out of it. That's when, wherever you are, your AI, there are AI agents, very well built. We have built also, which will monitor it for you. They may not be 100% accurate, but it's better than your human monitoring process. It's an improvement on what we are doing today.
You know, as a banker, Ketan, many of the things which he is telling us is very fascinating. But we also have to say that, you know, AI is also developing by days. Now we are getting into agentic AI zone as well. Do you fear that, you know, customers and stakeholders will start using many of these data sets and maybe, you know, start negotiating or start investing into certain things, which somebody who doesn't have the access to sophisticated methods may not be able to judge, and then, you know, end up in creating a, you know, huge gap?
This is very interesting. I'll just go back when some of us, when we were, you know, small kids, some of the financial investments were mostly taken by चाचा मामा का, you know, कोई पहचान वाला है, वो आके बताया ये अच्छा है ले लो, etc. My personal sense, I am completely pro what he was saying, you know, though I don't run AI like him, but it is going to improve not only the consumer experience, even the bank experience. I'll just draw a parallel out here from what he was saying it off. He said how we can dissect and bisect 5,000 companies instead of 50 companies, 50 quarters instead of 5 quarters. I'll just say that, and something which we put practical to use, or we are putting practical to use, is monitoring of frauds. Okay, there are some systems which we monitor. Now we are in the process of implementing the AI tools, and believe me, there is a very distinct difference in terms of TAT, in terms of identification, in terms of customer, you know, savings. The point which he alluded to, reduction of fraud. So I personally feel, rather than taking any wrong decisions, etc., it eventually will help. But are we there? I don't think so. We are there. Let us be very honest. In financial services, there is a huge need of adoption. First, financial services will adopt, you know, and the infrastructure within the institutions be set, and eventually it will go towards a positive thing for the institution as well as for the individual. That's my view.
And my, you know, supplementary question to you is that when you knew that Priyesh is your, you know, next door co-panelist, you must have Googled his profile and went through that, you know, what sort of work he does. What was the first thing which came to your mind, especially, you know, when you had a guy who is into AI, into a similar field? What was the first thing, you know, which came to your mind?
This is good. I personally feel, you know, that, and again, I have been a traditional banker earlier and now into a different kind of a banking. My personal sense is 5-10 years from now, every bank, okay, while some of the big boys, you know, they have the legacy of technologies and have some challenges, need to integrate, or maybe, you know, have a in-house AI champion, you know, may not be as high profile as Priyesh is, but someone who can drive it into everyday institutionalized process, etc. I think, according to me, and he rightly articulated it off, there is no second way. If banks and institutions who do not follow this will be left behind, and I don't think there will be anyone who will not follow. It's only about timing, how fast you follow, and some will follow with lag. So net, my first thing after saying is, and I asked him when we were sitting out there as well, what all they can do for us or something like that. So we do require, and currently I should confess,
So
we
tell
are
us
doing
what
something, but we do not have an in-house AI expert currently. We depend on people like him or entrepreneurs like him to
So
do that.
Ketan, tell us what all he can do for you.
That we will have more conversation as it comes. He is slightly in a broader picture of global, and I currently run absolutely for Bharat. And according to me, Bharat also has a very good scope of getting it done.
But actually, his main business is in UAE and around that area, in Abu Dhabi and Dubai. There's a lot of AI, fascinating entrepreneurs coming forward. Priyesh, tell us, many of your peers must be doing innovation, which you want to capture. That okay, I need to get into this technology, bring it, and build it up. And when you meet many of the CEOs like Ketan, what sort of ideas click your mind?
Okay, so I am from IIT Delhi, so I have the privilege of working with some of my friends who are doing phenomenal job in the field. I think one of the panelists before me was my senior from IIT Delhi as well, so I could understand why he was talking so fluently about the AI security aspects. That's one. But I'll tell you something, what Ketan is doing, I can never do. That's hardcore brass tacks serving the rural population, the underserved people in India. No, I can do that. But he's creating the foundation on which somebody like us, like what Valura is doing, will be able to build something. But if he doesn't do what he's doing, and like he said, if the banks don't digitize, well, it's garbage in, garbage out. I can't do jack. I mean, if I run a model, and this is what happens, right? वो phone आता है, we have to move 25 lakh rupees to UAE for a payment and say, branch आ जाओ. Why? What do you mean branch आ जाओ? You're 2026, man. What AI model will you run when you say branch aa jao? So there is a lot that can be done. I think in terms of what Ketan does, there are a lot of very advanced, and not us, there are good people who are doing it in India with Indian language based LLMs. There are SDR models. So if there are people who are not responding, so banks, a lot of banks have this problem of dormant customers. You can make phone calls through SDR AI agents.
Priyesh, I have a slight different opinion about this thing. See, there are good bankers, there are bad bankers. There are good boards, there are bad boards. There are certain banks who are very, very aggressive on digitalization. I can name Bank of Baroda. I can name little bit of State Bank of India as well. These corporations are very aggressive and trying to do digitalization. Obviously, they are a big elephant, and making an elephant move requires a lot of effort. But if you can help us in technologies, to understand technologies, the innovation which is happening in those geographies which I have already mentioned, which can seed in the ideas into their mind. So I wanted to grab those.
Okay, I understand, and you are very right, because a lot of these banks, just because of the legacy systems that they run, they're not able to digitize that fast. I 100% agree. But there are things that they can pick up immediately. There are some very tedious processes around fraud detection, which takes a lot of time in a bank and delays the process a lot. Well, you know what? There are agents, and we run one of them, which can give you alerts on possibility of fraud. So it will boil it down to maybe 5% of the total number of cases. So you don't have to scrutinize every single case coming to you. You just scrutinize 5% on a scoring system. Then you have KYC and compliance. You will be amazed at the amount of time and effort that goes into people filling up forms and people reviewing those filled up forms. So if I have to move money cross-border, I have to fill 6 forms in India. It takes me 7 days to fill those forms because those are very difficult forms. Can an AI agent help? Absolutely yes. So I fill up the form, AI agent is helping, it is correcting live. Now it's going to the bank. What happens in a bank today? A manual guy sits, takes a printout, has a checklist, runs it. Can an AI agent do it? Absolutely yes. It's already doing it in UAE. We are helping people do that. You do this much, you would have improved 40-50%. In the meantime, you digitize your data, you're good to go. You don't need to do everything at one go.
Ketan, if I can add to this a bit, he's talking about the experience as a consumer, if I may ask you. If I tell you my recent conversation with people in BIS, which creates norm for all the central banks. They were telling me that they had done a research with FATF and others. You don't even require many of these KYCs, as per their norms. But RBI is using perhaps the older, norms and situations. In fact, the photo KYC, even if you have a one document, it's good for BI. They just want to detect that somebody should not misuse it. Do you also encounter, many of these compliances? Do you also report back to RBI that, okay, boss, we need to modernize the things?
So there are two things. I think both of you guys are saying the two spectrums of the banking. I'll just say we claim when I said that we open around 10,000 accounts on a daily basis with these kind of processes, it is humanly impossible. So, I have been a hardcore banker not only in India but across. I have very high regards the way Reserve Bank of India is also progressing in terms of making this simple at the same time advanced as well. We are a 140 crore plus this thing. We have he will know that he mentioned about fraud, cyber challenges, etc. coming, the larger population. So I think the answer lies in both. Okay, there are various options of VKYC and other options as well, where you can start your accounts. As I said, we provide a perspective where VKYC is instantly done and a green pin is generated and someone can start using a debit card within a 20-minute on the spot. I mean, and this does not essentially happens in Mumbai, it happens in one of the villages, as well. So there are tools which are available, and will it completely change? Will it, lead to as much, the example which you are giving may not be now, but I think gradually with sophistication of tools coming in detection, we will go towards that, and that will be a process. I don't see it happening overnight.
Thank you, gentlemen. Actually, we ran out of the time, but I completely enjoyed the conversation, and I strongly believe that AI is the future, and the way India is moving is very encouraging, and a lot of new opportunities to not only do business but also to learn are emerging. Thank you, gentlemen. Thank you very much.
I also believe Priyesh is the future. All the bankers have to get people like him coming towards for the AI.
Best of luck to you, Priyesh.
Thank you very much. Thanks, everyone.
Thank you, gentlemen, for this discussion on the future of tech-led financial services. May I request India Today's managing editor, MG Arun, to please come to the stage and do the honors and present token of appreciation to our panelists.
एक चम्मच
मसालों को अच्छे से मिलाना।
पापा लेट्स स्पाइसी।
लाइफ हो या इन्वेस्टिंग, अपने गोल्स को पूरा करने के लिए डिसिप्लिन और फोकस जरूरी है। इन्वेस्ट इन म्यूचुअल फंड्स टू अचीव योर फाइनेंशियल गोल्स। Mutual fund investments are subject to market risk. Read all scheme related documents carefully.
A lot has a lot has been said about how domestic investors have emerged as a stabilizing force for Indian markets. But the big question is, can local capital continue to offset foreign outflows? To have a nuanced perspective on this very critical topic, please welcome Mr. Imran Jafar, co-founder and managing partner, Gaja Capital. Welcome, Mr. Jafar. Mr. Harendra Kumar, MD, Elara Capital. And Mr. Kaustubh Belapurkar, Director, Research, Morningstar Investment Research, Avendus. Welcome, everyone. I would also like to invite Anilesh Mahajan, Senior Deputy Editor at India Today, to come to the stage and moderate the session. Over to you, Anilesh.
Welcome, gentlemen. Welcome to this discussion around now the domestic capital. A very exciting story which is happening and unfolding in front of us. That domestic capital is actually now capturing a lot of the space which foreign investors are leaving. This could be a good story, and now we are seeing that because of the external issues, many of this story is, exposing the fault lines. Maybe we can start with you, Imran. This story of FIIs moving out and net negative value continuously happening for more than 2 to 3 years now. How bad is the situation? And secondly, the good part that domestic capital is taking a lot of this space. How healthy is this situation and how far we can go, or we have already touched the correction point?
Yeah, so first of all, we invest in private markets, but let me comment on what you're saying. You tend to see this mostly in public markets. See, foreign capital is not fleeing India because they don't, believe in India. They are moving back to, the US largely because US currently is delivering exceptional returns in public markets as well as private markets. So first of all, you have to see this as, more about other markets doing better, than India. Secondly, if you look at private markets, where we've spent 20 years as Gaja Capital, there the story is completely different. So private markets continue to be dominant by foreign capital. So essentially what's happening is that short-term capital, will come and go. I think it's great that you have, resilience propped up by domestic smart money and domestic capital. But in private markets, which is essentially about long-term capital, the story continues to be, reasonably attractive. In fact, today is a good day because one of our portfolio companies, RBL Bank, has announced a $3 billion investment of FDI, since that is so topical, by NBD Emirates. This is the largest FDI check in banking history. So we're doing this panel at a time when, yes, on the screens you start seeing FPI and FII flows exiting, with domestic capital propping it up. But in private markets, you're seeing very large record-breaking checks coming in.
Emirates NBD putting in money in the RBL Bank.
Yeah, so that was a proposed investment and now it's approved. And this is one example. But in private markets, for instance, in private equity.
And if I get into a little bit of details into this, is it more like a G2G deal which has happened, or this is more like a B2B, business evaluating the other business and then putting, and government just playing the role of felicitator?
I wish that governments could attract $3 billion by just saying invest, right? If that was the case, you would not see the foreign outflows you're seeing in public markets. This is clearly capital that is seeking returns. This is risk capital. And I think this capital has, come to India because they're believers in the long-term story of India. And the corridor between the Middle East and India, which is a thriving corridor because of remittance income and so many Indians living and working and contributing to the economy.
Kaustubh, if I can come to you, many of the foreign investors took their money out. You have analyzed, some of this data. Where all they had taken the money? Is it what, the proposition which he has shown us, or there are propositions which have become actually much better than keeping the money into Indian markets. So what has happened, and which all markets these guys have gone to?
Sure. So Anlesh, firstly, good afternoon everyone, and pleasure to be here. So I think a couple of things happened, right? And I think what Imran referred to was very, very important, because it's been a relative trade in the sense in the public markets when you think about it. And India's position, right? If I go back 5-6 years in time, around that COVID time, if I look at any of the broader indices, like if I look at the emerging markets MSCI or the FTSE emerging market index, we were sitting at about 10-15% depending on the index as an India allocation. India's allocation crept up over a period of time because of relative outperformance of our market versus some of the others, be it the likes of China, Korea, Taiwan, when I think about from the EM context, right? And that allowed obviously additional fresh money. It could be through passive funds or even active managers who do look at the benchmark very closely, taking relative weights, did add extra allocation to India, obviously, and the India growth story continues. But as this reversed, right, India is relatively, obviously, not being doing that well from that context of, all global markets, including the other EM pack, especially when I think about the context of the way the Korean and the Taiwanese market have done, right, which have now actually taken a lion's share of all the fresh money that's been going in from an EM market fund perspective. So a lot of the money that's actually been moving out, or fresh money that's coming into these strategies, is getting allocated to this and moving out of India. So I think that is, sort of a cyclical change that's happened, and that's one of the things that we see. But the other thing that we're also looking at is, which is probably a smaller quantum, but also important when you think about the color of the money, is, you have India dedicated funds, index funds or ETFs or active Indian funds. We're seeing investors also pull out. So last quarter we saw about $5 billion being pulled out of that. So there's a little bit of that relative play that's happening, but it's all at the backdrop of, because relatively India, the last couple of years has underperformed some of these, other markets. A lot of the EM pack, and obviously markets like the US that continue to do exceedingly well. So it's a little bit of that relative trade rather than purely what I would say, India not being, a resilient or a market which is starting to lose its sheen on an absolute basis.
Rajendra Chief, now, I'll put many of these situations in front of you. In last 20 years, a lot of things has happened. Japan has increased the rates. Europe has increased rates. Fed last evening held this decision that they will not increase for now, but maybe in the next cycle they may also have to alter if the inflation doesn't come down. Similarly, China is also holding things up, and in these situations, India decided to open a window to bring in the foreign capital through the FCNR route. How do you evaluate this step? Secondly, what sort of impact do you see that it will have on the foreign investors' confidence, that whether they want to put in money now in India or take the money out, or take to the geographies like Japan, which will give them decent returns but not exponential as the emerging markets would go, or America would continue to be going through that madness which the markets there are going through. So what is your thinking into this?
Yeah, so first and foremost, emerging markets are growth markets. I think that is something that everybody has to put in context. So what global investors are chasing is growth. So if India is disappointed, it's because of the growth. So 6.5% growth is a no-go area for foreign investors. With respect to, so if India has to attract foreign capital, it has to generate higher return on equity, higher return on capital invested, and that's when the global capital will come to India. With respect to FCNRB, that's a stabilization move, is given that what you're seeing with respect to the fund flow going out. So that's like a bond investment, right? Global yields going up to 6.5%. There's stability. But with respect to equity markets, I think what is missing is the growth option. I think India has to correct that. We cannot do without FI outflows, without FI inflows. Number one is savings is equal to investments. At the current rate of savings rate, we can grow at only 6.5%. That means there will be more outflows. We have to get 3 percentage points more of FI flows / FDI into the country, which is around $100 billion every year for us to grow at 8%. So without FI inflows, India is not growing at 8%, and the FI outflows will continue. So the answer here is growth, 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 and nothing else. Whatever may happen to the yields, as long as we deliver higher return over the interest rates, we can attract flows. That's the panacea to the problem.
But we have seen that in last 2 years, despite a lot of issues domestically as well as internationally, India maintained a decent growth rate, and perhaps we are one of the fastest growing emerging economies and decent size economy. But why do you think that 6.5% growth rate is not good enough? Do you think we need to get into some other sectors or in other segments so that global capital can be attracted? What needs to be done, because growth is decent?
No, so 6.5% is a growth that is not satisfactory for global investors, because if other economies are growing at 3.5-4%, which are far more stable, so the growth differential is not enough. Second is, if India doesn't grow at 8%, there's a very classic economic problem that will hit the middle income trap. So India will not be a rich country, but it will remain like this and go flat down. So the terminal value of India's prospects keeps getting reduced. So the PE multiple starts coming back. And that is taken into cognizance by global investors. Right? So that's one area, and that is something I think the economic thinkers, policymakers have to resolve very immediately. That's one. And number two is, the question is, even if China gets $80 billion, US today also gets $120 billion in inflows even today. That is because of the AI trade, right? So India cannot be a developed market without FI inflows. And why is this trade happening? Is because people understand the disruptive impact of AI, right? So there's a huge capex cycle in the world, because of which they're getting global money going in. So first it went to the US, then it went to Korea and Taiwan. It's flowing into India in the power space, because power will be a provider for our data centers. So this is currently an AI trade that's underway, and the market is again chasing growth assets. So what, like Imran says, it's a flow of wherever growth is available, is the money will flow. Money is a constant, it will chase wherever the returns are higher. And currently, with respect to the global framework, India doesn't have that proposition. Korea has 100% Y-on-Y growth in earnings. India has 4% on the Nifty level. So clearly that's not enough.
So similar experience do you also have, Imran, when you deal with your clients and your peer group in the private markets? They also say that this growth chart is not giving us enough, so we have to look at some other propositions. You have just talked about Emirates NBD, but what about the others?
So so we invest at the growth stage, right? And we do management buyouts. RBL Bank, by the way, is a portfolio company of ours. We invested in 2010. See, the workhorse of the Indian economy is India's mid-market, right? Even today, if you look at the indices, which is just one rough proxy, I mean, the small cap and the mid caps are really the workhorses of the indices. Behind the headline underperformance that you see in markets, underlying it in small cap and mid cap, the performance is better, right? In private markets also, if you look at India's mid-market companies, they account for, let's say, 35 to 40% of GDP, but they are severely underrepresented in public markets. And so, for investors like us in private markets that are investing in the innovation economy, what is our bet? Our bet is that if you had capital, where would you get the biggest bang for that buck? In our opinion, that capital should be in the hands of talent. The one resource that India has the most of in the world is talented people, right? These are entrepreneurial, talented, educated people. We've got a very large number of them. The entire IT industry was built on that thesis. Today, that population is looking for capital. Talent is seeking capital. And if you build the pipes from risk capital into the hands of these entrepreneurs, you will get the biggest ROI on capital. More than encouraging the large conglomerates to invest in capex, more than reducing taxes so that all of us have more money in our hands for consumption. I mean, it is frankly the biggest ROI that you can get, even if it's a self-serving argument because we are in private markets, right? So I think that for India to grow from, and I agree with Harendra, that for us to, our destiny is a 9-10% GDP growth. But for us, how do you get there is actually the billion-dollar question, isn't it? Like we are one of the world's biggest savings factories, over $1 trillion a year of savings. But more than half of that savings is stuck in physical assets. You've got 230 lakh crores sitting in bank deposits, earning, you know, everyone knows what we're earning there. But 15 lakh crores in AIFs. So, you know, I think the question from private markets lenses, there is no dearth of growth. We don't look at the headline GDP growth number and feel that there's no growth. I mean, in our portfolio, for instance, our median revenue of our portfolio companies are 180 crores, growing at 35 to 40%. So there is no evidence of a sluggish environment from the lens of our portfolio. Consumers are looking for innovative products. Businesses are looking for innovative products and services. We've got a very large savings factory. To my mind is just, you know, I think we should stop worrying too much about global capital and so on and start focusing on what we have. We've got talent. That talent needs capital, and talent plus capital will create the innovation that this country needs.
But when you talk about, you know, the savings, we have seen in the last 5 years that Indians decided to shift from the low risk investments like FDs and saving accounts and all that to highest of risk, you know, proponents like F&Os. And then, you know, government had to intervene, and, you know, they had to bring in a lot of restrictions and a lot of innovation. Do you think that this is a plumbing problem rather than the availability problem? And we need to actually devise newer products where we can move the needle slowly rather than expecting the consumer or customer to, you know, put in the money into you know, higher risk capital, seeing, you know, the dividend is higher, and then, you know, somebody like Jane Street comes and drop them off. So what is your take?
You're absolutely right. It is a plumbing problem. We are not at a stage where, you know, we should do away with regulation. In fact, I would argue for even greater scrutiny, greater regulation. But to set this in context, we've got 230 lakh crores sitting in safe assets and bank deposits. You've got roughly half of that in equities and mutual funds. 80 lakh crores, I'm just rounding it up, in mutual funds, half of that in direct equities. And AIFs are 15 lakh crores, and you've got, you know, a few things in the middle. So even in equities, let's say people are putting small amounts in F&O and so on, right? But compared to the 230 lakh crores, I think we're still underinvested in equities. And I would argue we're still, despite a 40-50x growth in a decade in mutual funds, I think there's significant headroom for people to allocate amongst, you know, allocate their savings, part of their savings in a very disciplined way to well-managed mutual funds. And then eventually in AIFs. The problem with AIFs is the accredited investor norms. So, you know, until you have a certain net worth, you can't invest in AIFs. But hopefully, you know, the plumbing, you know, will be set up in such a way that you have pension funds and other custodians of public capital under an institutional framework which will then flow into AIFs, and indirectly, you know, people will get access to more products, like you said, in the entire risk-reward spectrum. I mean, that's what drives the US economy, isn't it? It's, you know, people work hard, but their savings are in good hands, earning a pretty good yield.
Harendraji, if you can, you know, take this thing forward, you know, in last 2 years since restriction came in, many of these investors returned towards SIPs and mutual funds and those type of institutions. But suddenly we saw this war coming forth, and that growth had plateaued. Do you think that Indian, you know, Indian middle class or Indian middle class investors or investors from tier 2, tier 3 towns still have the appetite to put in more savings into these instruments? Or India now need to think that how we can attract, maybe 5% more of the savings. From 18 to, we can come down to 13% by devising products which, suffice their needs rather than, catering to the market's needs. What's your take?
So 2-3 aspects here. So the SIP revolution started after demonetization. Good or bad, the trigger came off after that, and you saw the jump up. So 2018 to 21, there was a dip, and then subsequently the reinvestment cycle started in the mutual fund industry. So we run our analytics. So the average price at which the people have come in is at 23,000 index. And you'll see multiple supports right at that price point where people will up their investments. So the market's holding that level. Unless it breaks that level, you're not going to get an outflow of SIPs. Right? So that's one level that the people can look at from the market. What you've seen is that there is slowdown in inflows but never a withdrawal. So the trend is structural till this level is not broken. Right? Now, other point to note is the way it's been marketed. What is the danger is 12% is the new FD rate, which is the nominal GDP of the country which the mutual funds will deliver. Now, even the mutual funds are not committing more than 12%. Now, year on year, presentations will start showing lower performance because the history is not going to be repeated. That cycle is gone. I think investors are okay with 12%. That's still a good number. Eventually go down to 10%. But along with that, the cost of fixed capital should also go down, right? So the differential is enough for investors to make money. So as of now, we are okay, right? So if these true support levels of 23,000 index or annualized return for the investors fall below a particular level is when you can see the disruption in this trend. Till that time, you're okay.
So, Kaustubh, you must have also, read many of these trends. So, what do you think India is doing right in, bringing this savings money into the higher risk proposition? And do you see also a trend that, India is trying also to get deeper and get more savings into the markets? What is your understanding?
Sure. So I think a couple of things. One is, like my co-panelist very rightly pointed out, that we still, despite all the good work that's been done, in terms of investor awareness, education, running these mass campaigns, we're still very, very under-penetrated, right? I was looking at this survey data which said that less than 5% of assets are actually in equities from an Indian household. Still, 50+% interest, including 15% gold. We love gold, yes, but how do we move away from that cycle, right? There's still so much money, like Imran said, in bank deposits, insurance, some of those traditional sort of products. So a lot is being done, right? And I think the one thing they've done really well is, one is creating the awareness and also incentivizing, coming down to, we had a lot of mutual fund assets coming from, the metros, some of the bigger cities. But now when you look at what they call the Beyond Top 30 Cities data, which AMFI publishes, you can clearly see there is more and more money that's coming in from investors in that region. And a lot of that money is actually equity money, right? They're actually probably being much more long-termish, aggressive in, as you may want to call it, in terms of their allocation to sort of in their portfolio. So I think all of that is obviously boding well, but this needs to continue at an accelerated pace for years, decades, for us to even breach to where markets like the US are, right? I think SEBI's own investor survey said that 2/3 of families know about this product called mutual funds of households, but only less than 10% actually invest in mutual funds as of now, right? In the US, it's north of 60% of households that have exposure to capital markets. So you see the journey, it's a long way to go. We already spoke about it, it's only 5% in the US that, a typical household will own about 45% of their assets in equity, if not more. The other thing I think which is interesting and we can think about is, the whole architecture of, almost forced savings into equities, right? We have some ways of doing that through now the NPS and things like that, but a large part of this journey for investors in the US started through 401k plans. In fact, data showed that almost 75% of first-time investments into mutual funds happen through sort of this forced savings, as you may call it, through the 401k plans. Similarly, several other countries now, enhancing those platforms to allow investors to invest in the long term and save for retirement, and funds become a very strong or integral part of the way you can do that, right? So I think those are some of the measures that we'd like to see continue to be enhanced, which can structurally continue to grow sort of money moving from, as Imran said, we're great savers, but not necessarily the best of investors traditionally.
But, when we see the North American pattern, so a lot of pension money can also come in. So pension is also a lower risk and type of a saving, money. India is gradually opening up, but still, we are in a very, very nascent stage. Secondly, we haven't even unlocked our insurance capital. And we have opened up the FDI for insurance sector. Do you guys think that, these are the two elements where India needs to put, a tap very, very quickly that, okay, we are unlocking this. LIC itself is like, the CEO is here, so I'm sure my colleague will be asking many of these questions. So LIC, they came up with the IPO, one of the very successful IPOs. Do you think that India's insurance industry is opening up and they can put in, a lot of money into the India story? So pension funds and insurance sector. So all three of you, give us your views. Then otherwise, we are running out of time. Maybe you can start, Imran.
Yeah, just the short answer is absolutely. And we've got right here in our backyard pretty much State Bank of India, Life Insurance Corporation. I mean, the kind of capital and balance sheet strength our Indian institutions have can make a phenomenal difference to the pipe that you spoke about, connecting the savings factory to other assets. And they have a reputation and credibility and the competence to be able to allocate capital, just like you see in the Western markets. So the short answer is absolutely. And from the narrow perspective of AIFs, I think we believe that the 15 lakh crore AUM in AIFs can go to 100 lakh crore. And the only way that's going to happen is if pension, insurance, capital like that gets unlocked and allocates whatever they're allowed to allocate meaningfully to AIFs, we'll get to 100 lakh crores. And talent will get capital to create the innovation and growth we need.
Indraji, the same question is tossed upon you, but my supplementary is that we have already seen one cycle of renewable energy projects, coming into profits and making money. And we are seeing that World Bank is also coming up with their product to take a lot of, these balance sheets issues, resolving balance sheet of the banks. Do you think that, insurance money and these pension funds need to tap many of these yield costs where, they can actually have deployment, plus they can also make money and take load out of, the higher risk capital deployment?
That's a different conversation with respect to having development financial institutions or having our own sovereign fund to fund long-term growth capital. But to circle back to what our initial conversation was, even if insurance and PPF and EPF money goes into equity, it's part of the same savings pool. It moves away from a different debt asset class to an equity asset class as it becomes slightly more productive. But I think for us, fundamentally to grow higher, we will require foreign capital. I think that's that underscores everything else.
This was not about the development finance, I'm forgetting the name, the product which World Bank has devised. So they have bought a lot of assets from the book of State Bank of India and ICICI Bank, which were already making, profits. So that, their capital can be deployed and this is the same play where, pension funds and insurance companies, they generally try to develop. Otherwise, higher risk capital, why would, these pension funds would put, where, many of the government employees' money is stuck. So that context I was asking.
Yeah, so what you're saying, refinancing, it unlocks whatever they're holding on. That's one of the products that will help capital go to productive assets.
So my last question is to you only. You have heard both these gentlemen. Any caution notes, any proposals you want to float in before we conclude the conversation?
I think I completely, on the same page that we need to have more institutional money flow into equity capital markets. we're probably too conservative, when it comes to some of these. So yeah, I mean, completely on the same page here with the gentleman.
Thank you, gentlemen. It was a wonderful conversation and very insightful one. Thank you very much for joining us.
Thank you, gentlemen. And Anilesh, I would like you to please present a token of appreciation to our esteemed panelists.
Look, this investment guru's tips will double your money. Just claim the offer.
Double your money from any random group. Pay attention. Promising double returns, they'll lure you in tight. Unverified groups will send fake tips overnight, emptying your pockets before you can fight.
Well said! Well said! Well said!
SEBI and NSE advise consult only SEBI registered advisors and make payments only to verified accounts or UPI ID.
सोच कर, समझ कर, इन्वेस्ट कर।
NSE द्वारा निवेशकों के हित में जारी।
Wow, so you use this trading app too?
Yes, because it promises guaranteed returns.
Guaranteed returns. Your trading app is authentic, right? Here's the catch. First, they promise guaranteed high returns with a grin. Then trick you to download a fake app and pull you in.
Well said! Well said!
SEBI and NSE advise. Download apps only from the verified apps list on SEBI's investor site.
सोच कर, समझ कर, इन्वेस्ट कर।
NSE द्वारा निवेशकों के हित में जारी।
Expanding coverage is critical not only for financial security but also for long-term economic resilience. Please welcome none other than Mr. Ratnakar Patnaik, Managing Director, Life Insurance Corporation of India. Everyone, let's give him a warm round of applause. Moderating this session is MG Arun, Managing Editor at India Today. Over to you, MG. And welcome, sir.
Thank you so much, Mr. Ratnakar Patnaik, who is the Managing Director of Life Insurance Corporation of India. And I think if you look at some of the most credible and some of the most iconic brands, I'm sure that LIC would be one of the prime among those. And for no small reason, because LIC has got over 300 million policy holders. It is the largest institutional investor. It controls 71% of total life insurance industry assets. It has an assets under management of some 47 lakh crore. I mean, these are some of the numbers that came up. But sir, to you, the first question would be is, LIC has completed 70 years and its story has been inseparable from India's growth story. So, as you look at the new generation, you need new ways of attracting maybe the younger force, women, others. So, I'd like to know from you, what are the new measures you are taking, the new modernization drive that you are, planning, the drive towards innovation. Maybe you could start there.
Thank you, Mr. Arun.
Thank you for having invited me to this talk. And I would like to thank you for telling good words about LIC. And we are here for last 70 years. Come for September, we are going to complete 7 decades of meaningful existence in nation building. And I would like to correct, we manage around 58 lakh crores of AUM as on 31st March 2026. And you are right, India has, by a very back of envelope calculation, I can say the number of people insurable at this point of time will be around 98 crores. But we are having around 27 crores of policies, but if you take the policy holders and all sectors put together, we have around little over 30 crores of policy holders being covered. But coming to your question of what we are doing for the young generation, and a recent survey says around 100 million youngsters who are below 35, tech savvy, they know how to calculate IRR, and they know the investment details of a company where the company is investing. They are waiting eagerly to be insured. Either they don't have insurance or they are not adequately insured. So that way, 100 million, it is 10 crores of youngsters are waiting to be insured. Being a LIC, life insurer for last 35 years, having worked across the country in different parts of the country, I am sure we have to necessarily bring these youngsters to our fold. And there is a misconception that youngsters are not getting alienated from LIC, but our data shows most of the youngsters, it not be 100%, but at least 50% of our youngsters are with us today. And we are aware of the fact they will not come to us just because we are 70 years old. They will come to us if I can provide them the ease of doing business and the speed of doing business. I know at home, 2 grown-up children, I see how, when I ask a question about their preference for any life insurance company, they don't say immediately LIC. They say we shall think and let you know where we shall be going. So to cover this section of the society around the youngsters, the generation millennials, we are necessarily, you'll agree with me, we are coming with digital innovation and value enhancement. There is a project our former chairman had taken and that we are pursuing, DIE project. It will help us to reach to the unreached. And we are having a customer app called My LIC app. I would request all of you present here must be a policyholder with us. Please download the app and you will see the latest features we have added. Secondly, coming to the intermediaries, LIC has around 15 lakhs of agents working today across the length and breadth of the country. And we have having a beautiful app for them that is called Super Sales Sathi app. And their agent, he may be at Jorhat, he may be at Kanyakumari, he may be at Rajkot, but the way it connects with the insurance, their company and the customers, it is really unique to be seen, to be believed.
Was it developed in-house or?
It is, we had some consultants, but some are partly from outside vendors, and many of the features, many of the projects are developed from in-house assets, in-house knowledge.
Great. I mean, that was a lot of, the big eye-opener with all the numbers that you have talked about. Now coming to some bare facts, in the sense that despite India being the 10th largest in the world, we significantly are underinsured. And the penetration is just, some 3.8% of the GDP. So, if you could let me know as to why, we are unable to get into a larger, penetration. What is holding us back? Because, if you look at insurance, I mean, there is no doubt that that is something which really needs to be taken care of. I mean, nobody would have any second thoughts that, be it life insurance or health insurance, but, the penetration remains low. So maybe we would like to know from you what are the reasons for that and what are the solutions also?
Yeah, very rightly asked. Maybe one thing immediately what crosses my mind is sometimes the GDP grows faster than the insurance premium growth rate. That's how the penetration levels and it is 3.8, Mr. Arun, it is life, non-life put together. If you see alone life insurance, it's only 2.8% of the GDP. And I would, as a life insurer for 3.5 decades, I have got a different view of these things like penetration, protection gap, and the density. Penetration is something, a function to the GDP, upon GDP. And as far as the density is concerned, it is per capita premium someone pays. But as a life insurer, I am more worried about the protection gap. I was just going through the data, published data of 2024-25 of IRDA. The average death claim paid during that year per policy is only 3,30,000 rupees. If you come to my company alone, for the year 2025-26, the per policy death claim settled is only 2,40,000 rupees. So that way, penetration is fine. It is sometimes you are having different types of policies. Annuities are there, ULIPs are there, single premium policies are there. They are most welcome. We will take care of penetration, and I will come how we are going to do that. And as far as density is concerned, it is around $90 per person. It is also low. But as far as the protection gap is concerned, some recent survey, if I remember correct, the protection gap in India today is around 83%. We're putting in very simple words, someone needs 1 lakh of insurance, it hardly has got 17,000 rupees of insurance. So that way, I strongly believe innovative products, a life insurance, in quite a few seminars it is being argued, debated, कि we should have very simple products. But I have got a question here, I have got a suggestion कि a insurance product cannot be feature rich as well as simple at the same time. If you want more features, we have to reach to the customers, and for that I need to train my agency force that way, so that the products have to be innovative. It cannot be plain vanilla products. We had enough of products and other companies too have. So I need to have some products which are innovative. They will appeal to the youngsters. Like recently last year we had a policy called Bima Lakshmi. It is only for women, and we brought in a lot of new features into that. To just mention one feature, ki this every 2 years the lady insured will be getting some payouts from LIC. So this is what the innovation is called. We are having an online product where the minimum sum assured to cater to the millennials of the big cities. It is called Bima Kavach, and the minimum sum assured is 2 crores. And it is completed totally online, paperless onboarding of a term insurance of 2 crores. From any corner of the country, anyone can onboard, and it will be completed hassle-free. So my coming to your point, as far as penetration is concerned, we have to have good products, innovative products. Similarly, we have to have very good training programs for our field force. We are very proud of the 14,50,000 agents we have. Come what may, whatever they are, wherever they are, however educated more or less they are, but they have seen this mighty corporation for last 70 years. Even today, a large chunk of the business is procured by the tight channels. Having said that, we have got necessary emphasis on other alternate channels, cost-effective channels. But coming to that, agents, training, products, and we should have those kind of intermediaries. Agency is a career. All said and done, even today in India, people don't accept life insurance agency as a profession. Slowly things have changed, and today we are going to reach to a situation where people, youngsters, will voluntarily come and accept life insurance agency as a career. So these are the few things: training, good recruitment, good products is going to give the necessary fillip for the gap, protection gap, as well as the low penetration levels.
Great. Mr. Patnaik, there is a lot of interest around investing. I mean, we have this whole session, in fact, there were so many speakers who, and so many topics that were discussed, from mutual funds to gold, to real estate, etc., etc. Now, when it comes to insurance-linked, investment products also, there has been interest as well as there are concerns on this front. Do you think the kind of progress that has been made on that front is satisfactory? Is there something more? How do you address some of the concerns that are there? What is your view on that?
Yeah, Mr. Arun, as far as investment-related insurance products, I can put it safely as ULIPs. Yeah, ULIP market is around, last updated, it's around 7.5 lakh crores in India. And LIC has also had a very good run in ULIP policies. But today, as far as ULIP policies are concerned, we are very, very cautious about mis-sellings. So we are very careful and we are promising what is possible. It's not that a ULIP product will always fetch you. For example, the markets, the choppy markets now. So that has brought down the NAVs sizably. But our customers, we have brought in the concept, the regulator has brought in the minimum lock-in period. Earlier, it used to be a lot of bleeding of the fund because there was no lock-in period of the investments. Today, there is a lock-in period, there are regulations, it is regulated properly. So as far as ULIPs are concerned, and I see one trend, the youngsters are more interested in investment plus insurance. So somewhere we call it like tulips. It is term as well as ULIPs put together. So that gives investment returns as well as the required coverage to the youngsters. Mostly youngsters are interested, and ULIPs we are having some good products, and we are thinking of bringing a few more ULIP products which will be with many fund options so that the young generation are attracted to ULIP policies again.
Okay, so that part is also showing a lot of promise according to you. I'd like to come to the technology part because nothing of this kind of scale is possible without leveraging technology, and now we have so many technological advancements, including the advances in AI. We just had a session on AI before this, and deliberately so because without including the kind of steps, I mean the progress in AI, you can't really talk about anything. So maybe in the insurance sector, and especially with regard to LIC, if you could throw some light on the technology developments that are happening and how it is reshaping the way you reach out to your customers.
Yeah, as far as technology is concerned, we have started with this DIE project, as I was mentioned in the beginning, and online paperless onboarding. I'm happy to inform you last year around more than 23 lakhs of policies, it was onboarded paperless. And this year we have taken a very ambitious target of around 1 crore policies to be onboarded paperless. 1 crore policies. Our target is more than 2 crore policies for the current year, and we are planning around 1 crore policies. For this we need the technology in place. And the DIE project and the My LIC customer app, Super Sales Sathi app for the agents, all this put together, it is being coordinated, and I can foresee very easily within 5 to 6 minutes a customer can onboard and get the e-policy within 10 minutes. And we are trying for some other AI technologies, some other technologies in place, like optical character recognition. The manuscripted proposal form can be automatically scanned and it can be converted into editable data at one scan and upload. So that kind of technology we are looking into, and that will help us to save lot of time in keying in the details of the customer. A proposal will be simple, it will be scanned and it will be uploaded, and it will convert this manuscripted proposal form into editable data text formats. So that is going to ease of doing business and ease of onboarding.
So it will be a very mammoth task, because considering the scale that LIC has, I mean the kind of progress that you're making. Another question I wanted to ask you is about the 100% FDI in insurance under the automatic route that has now been allowed. We have seen how different measures taken by the government has sort of energized the segment. We have also seen the listing of LIC, which was a very historic event in itself. Maybe if you could just give us some idea of one, of course, the listing, the post-listing scenario, and number two, how this kind of a measure would impact the segment and what we need to look forward to.
Yeah, as far as FDI is concerned, we welcome the decision of Government of India, and we are eagerly waiting because it's not the first time. Initially it started with 26%, 49%, 74%, now 100% FDI. So direct route. So we are waiting, and once these big players of life insurance come to this country, and we will be benefited by the technology they will bring in, the awareness they will bring in, the underwriting legacy, the underwriting expertise they will bring in, that is really going to help us. Being a big insurance company, we are eagerly waiting, and we welcome, and whatever funds will come, that is also will help for the capital building of this country. But as far as the IPO, we are now almost 4 years, 2 months old, post-listing, 17th May 2022. And you might have seen the ups and downs, and recently we had bonus issue too. And I am hopeful the way we have started current year, the core business performance of our corporation as on 31st March has shown more than the budgeted growth in many important parameters. So that is going to change up the perception of an average investor towards the long-term investment he has contemplated in a company called LIC.
Excellent. There are going to be so many youngsters, especially on the digital front, who are going to view this, and if there would be a message of advice that you would give them, to get them into insurance, what would it be?
Yeah, I would say one experience I've seen, many of the youngsters, they onboard to a good policy, but the persistency levels are not good. Today they onboard from a particular company, next year they change the company, they treat life insurance as vehicle insurance, because term insurance, only an annual contract. I would request the youngsters watching this program, please stay with a good company, preferably the choice of the nation, that is LIC of India. Stay with them, keep your policy up to date. Let God forbid, for a bad day, your family should not be deprived of any insurance benefits that we have been promising for the last 70 years.
Okay, on that note, thank you so much, sir, for being with us.
Thank you. Thank you.
Sonal, back to you.
Thank you, Mr. Patnaik, for sharing your insights on strengthening insurance coverage and also your advice, and I'm sure we'll consider that. MG, I'll request you to please do the honors and present Mr. Patnaik with token of appreciation.
एक चम्मच
मसालों को अच्छे से मिलाना।
पापा लेट्स स्पाइसी।
लाइफ हो या इन्वेस्टिंग, अपने गोल्स को पूरा करने के लिए डिसिप्लिन और फोकस जरूरी है। इन्वेस्ट इन म्यूचुअल फंड्स टू अचीव योर फाइनेंशियल गोल्स। Mutual fund investments are subject to market risk. Read all scheme related.
On deepening insurance coverage, we have another session. Ladies and gentlemen, please welcome Mr. Srinivas Rao Ravuri, Chief Investment Officer at Bajaj Allianz Life Insurance. Welcome, sir. And I'd like to request India Today's Managing Editor, MG Arun, to please come back to the stage.
So, welcome all of you again. We are continuing the conversation, as Sonal said. This time we have Mr. Srinivas Rao Ravuri. He's the Chief Investment Officer of Bajaj Life Insurance. And just as we have LIC in the public sector, in the private sector, this is a name that is synonymous with, the building of the nation. Bajaj is a name which, of course, is a part of nation building. And insurance is something that is getting a lot of attention nowadays. And like we had discussed with the previous speaker, Mr. Ravuri, what do you think of the penetration levels being so low in the industry? And maybe that's where we can start with, just give a macro picture. And what can be done to address this particular issue? Because India is a country with tremendous opportunity, and the insurable number of people are quite huge. So what is holding us back?
Yeah, sure. Thank you. Thank you for having me here. Arun, thank you for this opportunity. Mr. Patnaik has just touched upon this point. I think India is a classic case of huge potential and low penetration. I think insurance is also a classic case in that aspect. I don't think affordability is the only issue. Of course, affordability is a big issue. We are a developing economy. Per capita income is still at fairly low level. But I think incrementally reach and technology will play a bigger role. Of course, as income levels go up, people will realize the importance of having protection plan. Right now, I think most of the people are looking at investing in gold, fixed income as a way, whereas I think this need to create the awareness and also use reach and technology, I think will play a big role in increasing this penetration levels. As Mr. Patnaik said, actually life it's only 2.8. So I think we have a long way, but in India there are many other sectors also where the opportunity seems to be huge, but somehow today we are very small. But I'm sure this will change as India becomes more developed, as income levels keep going up.
And you think that technology is going to make a big difference in this? Is there something innovative that you're doing on that front, which, because he has talked about the My app, My LIC app,
Sure. So, they are industry pioneers and leaders. Bajaj is just completing 25 years. But when it comes to technology, we've been doing a lot on technology. The other point that I would like to say is it's not just the technology, but also making sure that it is simple. We have live examples that technology will make a big difference. For example, number of debit cards that are there today, number of bank accounts that are there today, because of technology, is unimaginable 10 years back, 10, 12 years back. So I think if you have right technology, simple product, another important point is it can't be feature rich and so simple, but we have to find a via medium. But making sure that it is simple to understand, and also that's where using vernacular, not just English speaking, will also make a big difference.
Absolutely, and I think even when it comes to UPI, this is going to be a major step. We have heard about how UPI is going to be in the vernacular. That is what they are working on, and I think it could even be voice controlled, which will be a big step. It will help a lot of people in the rural areas. Another thing I would like to know from you, Mr. Ravuri, is that there are so many investors who are looking to participate in the equity markets. But they need to create a lot of awareness, among them, because managing these investments is not an easy thing. So, how do you think that the ULIPs and insurance-linked investment solutions will help bridge this gap?
See, the insurance industry, I would say, the moment you include these products, so we have three offerings. One is protection, second is income, and third is wealth creation. So these are the three different aspects that we are catering to. And I think when I'm talking to my prospective customers, so we need to keep in mind what are the financial goals that he has in mind. I would say protection is essential. But unfortunately, protection, when you're doing, it is not for you. When something happens, your loved ones will get the money, not you. You will not get any money. So many youngsters are in this camp that, okay, protection is not for me. What is in it for me? So that's where we have this product, some people call it tulip. We are including, okay, there is savings come protection. And the third aspect is, especially when you are investing very early, tulips, wherein you get investment kind of returns along with protection makes an immense sense. I think we have protection, but also the fact that there is a discipline, compelled discipline. There is a compulsory lock-in in ULIPs. In market, the way they are behaving, we are seeing people getting carried away or become emotional, looking at what all is happening. Trump is saying something today, something else happens tomorrow. People are afraid and taking out money. Whereas when you are putting money in insurance product, you are automatically being disciplined to be invested, stay longer. I think that also, if you see Indian markets, if you stay invested for longer, that is, let's say more than 5 years, you have made comfortable double-digit return, because the economy itself, and I'm seeing at the nominal growth and corporate earnings, last 20 years, corporate India has delivered 15% compounding returns. And the same is reflected in returns from equity market. So I think, there is a compelling case for using insurance investments also for wealth, building your wealth. So I think all this will matter, and this is where media need to focus on.
Absolutely. As a life insurer managing long-term policyholder funds, could you tell us, how your investment approach differs from that of a mutual fund or a PMS?
Yeah, I think I covered part of it. So we are long-term orientation insurance industry. Within that, stability is more important. So that's where if you see insurance companies, our predominant investment is in fixed income instruments. That's also because of the nature of the industry and regulation. The third part is on the equities. So versus competition that you took name PMS, mutual funds, I would say more long-term orientation is what we have, and there is a definite advantage we have when we have that approach to investing. I'm not getting carried away by what is going to happen in 1 month, 1 quarter. Similarly, I don't need to be worried also. I'm saying, to be fair, the money that I get, I know that there is no redemption in the near term. So accordingly, I can actually plan my investment with that long-term orientation in mind. So I think that is the one big advantage that we have, insurance industry has over MF, where I think they have been compelled to look at short-term performance and accordingly sometimes to take decisions which are short-term in nature, which may not be necessarily beneficial to the investors.
Great. We just even talked about, you described some products that you have made to attract the young. But just to elaborate a bit on this, young investors, first-time earners, even women investors, we have in the earlier part of the session, we talked about that in detail. Some of the specific measures that, you are taking, and what would be your advice be to, freshers who are coming into the market and who would like to have a long-term view of investment?
Yeah, first, we at Bajaj also have women-specific policies. So I think it is important. If I remember correctly, of the total insurance protection, the share of women is about 20% plus. This number should be much higher than where it is today. So we are also playing a role to make sure that that percentage goes up. Coming to the second part, which is the young investor. So I think if you start early, I think the youngster has a huge advantage in insurance industry. If you take policies when you are in 20s, the protection policy, the premium is very, very attractive, very, very competitive because you're starting so early. So I think use that opportunity to build that protection kitty if you start early, but for much lower amount. And second aspect is again, financial goals. What do you want to do going forward? And using a financial planner, whether it is digital, whether it is physical, to see that, okay, what do you want to achieve over the next 5-10 years, and accordingly plan in terms of what percentage of my savings should go to wealth creation, income stability and protection. I think starting early has a huge advantage, definitely.
Okay, I want to also ask you about the regulators' emphasis, on protecting customer interest and the problem of mis-selling. This is something that has been widely reported in the media also. So how do you address some of these concerns, and could you share some of the measures you are taking on this front?
See, the first is we need to have trust of the customer. And the trust will come from when there is a transparency. So we are making a lot of effort to make sure whatever we are doing, there is a lot more transparency to customers. That's one part. Second is insurance is a complex product. Let's accept it is a complex product given the features that it offers. At the same time, within that, what can we do to simplify some part of that? Is what we are also working on, and also using simple language. I think the product is simple, but many a time the language is not simple that a common man can understand. So I think also working on this communication part is something that is important. I think a lot is being done. Regulator is also talking about how do we make sure that insurance becomes more affordable. And also, how do we reduce the cost? So one part of that cost is in terms of getting the policy, so upfront commission that we give. I think it's not there is no one solution to this, but I think multiple things are being done to see that it becomes a lot more easier than where it is today. And also, I think directionally, as we have more people taking policies, I think that scale benefit also will come to us in terms of reducing the cost, and automatically then this concept, people saying that mis-selling part will go away when you see lower cost.
Okay, so lower cost is key to preventing a lot of mis-selling. When we talked about the penetration, and how to improve your reach, one thing that comes to the fore is the penetration in the rural areas, women, etc., etc. Could you throw some light on, as a private insurer, what measures you are using to attract more from the rural area?
Yeah, I think it's a huge opportunity in terms of number of people. If I'm seeing the overall economy, last 2 years, the rural India has done much better than urban India. Rural economy was more buoyant than urban India. We have seen many companies saying that our rural sales are better. And we are also in the insurance industry, we are also seeing higher traction in the rural areas. But how do we make sure that this continues or this accelerates? I would say 2 things. One is the ticket size has to go down further. I think the sachets in the consumer made a big difference. We can't do that much, but at the same time, how do we reduce the ticket size is one. And second aspect I would say is local language. Vernacular language will also make a big difference in terms of making deeper penetration in the hinter world.
Great. And finally, Mr. Patnaik, had said when we asked him this question that when you have more FDI coming into the segment, the kind of impact it could have, it is welcome. I mean, that was what he said, because it also helps us gain a lot of technological expertise because of the kind of competition that comes in. How do the sector view this?
The allowing 100% is a bold move, but it also shows the confidence that the government has on the sector and the maturity that we are as an industry right now. So more players, foreign players are welcome. They will bring in more capital. We are talking about how do we increase the penetration. So more capital, more products, better processes. All of them will definitely play a role in seeing that industry grows faster, we have better penetration. So I think good to have more players. I think the most important thing for us to industry player is to make sure that the industry grows faster. In that, foreign players will definitely play a good role.
And hope companies keep very ambitious targets like what we just heard from LIC.
Absolutely. So, but Bajaj, we have gone the other way. We were a JV. Now we are a 100% Indian company.
Absolutely. So, thank you so much, Mr. Ravuri, for enlightening us on a whole lot of topics. A big round of applause to Mr. Srinivas Rao Ravuri for coming and sharing his thoughts with us. Sonal.
Thank you, Mr. Ravuri, for sharing your perspective and taking time out to be a part of the session. Long-term capital is increasingly becoming a cornerstone of market stability. Pension funds can play a critical role in supporting sustainable growth and wealth creation. Please welcome the session speakers to the stage, Mr. Pranay Ranjan Dwivedi, MD and CEO, SBI Pension Funds. Mr. Dwivedi. And Mr. Sumit Shukla, MD and CEO, Axis Pension Fund. Welcome, sir. And also requesting Anilesh Mahajan, Senior Deputy Editor at India Today, to please moderate this session. Welcome, everyone.
So we are getting closer to the penultimate session where we will be talking about the most patient capital. When we see Canada, when we see Australia Super, we suddenly start evaluating what all pension funds can do. India is sitting on roughly around 60 billion worth dollar of the assets manned by the pension funds. State Bank of India is one of the largest. 1/3 is being handled by you. Sir, but we still see that this is just, 12%, 15% of our GDP. And when we see the map of, the developed countries, they are doing assets worth, double their GDP or 1.5 times of their GDP. Where are we going, wrong, or where are we going slow? Is it largely because of the asset class is weaker? Or is it that we are still very conservative in approach and we are not deploying, the pension funds into the assets? Or third, we have actually not reached that cycle where pension funds can come in and, start playing the role. Maybe we can start with Pranayji, you.
Good evening. First of all, I thank India Today to bring pension, especially NPS, into the mainstream financial discussion. Generally, in such kind of program, we discuss banking, insurance, mutual funds, capital market. So, but this time I've seen that NPS and pension fund have been included. Thank you. So you rightly said that if you talk about pension corpus, which is around 50 to 60 trillion rupees, and which is around 15% of GDP, our GDP. And when we talk about the developed countries, it is much more. Even in case of OECD countries, the ratio is around 100% of GDP. But I can say that NPS and pension fund industry in India is in nascent stage. This is not the real picture. It is growing at a very faster rate. So last 5 years we have witnessed that NPS industry has grown by 28-29% CAGR. And the kind of awareness is being created, the kind of NPS ecosystem has been developed, and the broader pension framework is increasing. We are sure that it will again increase by 25% CAGR for next 5 to 10 years. So certainly it is going to be very important. Nothing is related to scheme or asset allocation. The main issue is awareness, because whenever you talk to anybody, a young person, pension is not very one thing that everybody will talk about. Like a young person who is 30, he will not talk about, would not like to talk about pension. When somebody is already 45, 50, he says that he doesn't have time to invest. But in India, we can see that longevity is increasing, inflation is going up, and people are living for 20 to 30 years, and their faith in financial system has grown. So we think that there's inclination towards pension assets, and in the next 5-10 years, you will witness substantial growth in pension sector, especially NPS sector.
If I can come to you, maybe to take the conversation forward. We are still a young country. I might be on the other side, so would you be, but there is younger population which is in majority right now. But we are seeing that they are venturing into forward investments, F&Os, other products of markets they are still exploring. But they don't have pension planning in their mind. Do you think there has to be a different conversation which we need to do with the younger generation so that this can be solidified? Or do you think that we are getting into that trajectory but perhaps slower in the approach?
First of all, thanks to India Today for organizing this. As Pranayji rightly said, very rarely pension gets a chance to talk to people who matter in the industry. When you come to younger generation, I think largely what we are trying to do now is becoming more accessible to the customer. Earlier we were not available on different platforms for customers to buy. There was myth, it is difficult to buy pension. Now we are becoming more digital, more savvy, more easier for them to get a pension account to open. India doesn't have a problem of, first, awareness is a big problem, which we have already talked about. Another problem that we have is allocation. People don't understand that they are going to live for a long life and they need to allocate some money towards their retirement. So awareness and allocation both is a problem in India, which we are grappling with, but the things are changing for the better. I think younger people are also realizing that some money they have to set aside, and they want to retire young also. That is also a good thing. So they want to retire at 40, don't want to work longer, so they have to save in the earlier part of their life only so that they can retire at 40. So we are trying to do all of that to attract them. Also additionally, we are now, we have learned from other industries, particularly from mutual fund industry, so we are going to get a brand ambassador now very shortly. You will see top Bollywood star talking to you about NPS Zaruri Hai. So that is also going to attract a lot of people. So some things which we have also not done right, we are correcting in the times to come, which is making awareness, making it more jazzier to talk about NPS and not talk about pension per se and look at 35, 40. So those things are the things which are going to improve the sector and get more younger people to come and join.
Pranaji, if I can ask you, you know, when SBI handles roughly 6 lakh crore worth of assets, how do you see yourself just as a fund manager that who has sourced money from the pension accounts and now they are deploying in various of these assets? Or do you think that, you know, you also have to, as an institution, have to broaden, you know, the risk profile, broaden, you know, the asset evaluation, broaden the thinking that, okay, how we can deploy many of this money into building the stacks which India needs. AI stack India needs, India needs energy stack, India needs clean tech manufacturing. How pension funds can play a role in getting into these, you know, high value, you know, propositions?
So the primary role we see for NPS industry is to achieve the goal of the subscriber, that is retire with a corpus which gives them financial dignity. If they achieve their role, certainly the business AUM will follow. As regards your question of providing finance, so basically in case of pension fund, we always suggest a disciplined and diversified asset classes. Equity is one, GSEC, government bonds, REITs and WITs. So we are investing in all the other classes, and certainly this money will go to support the infrastructure and other requirement of the country. India is a growing country, it requires a lot of money, and NPS and pension industry is certainly going to serve that purpose also. So we will be serving both purposes for our subscriber and for the nation.
Sumiji, you know, State Bank of India is a big giant in itself. You know, they have 6 lakh crore worth of asset. You have 40,000 worth the assets. What is your thinking and how it is different from State Bank of India? Are you okay in taking, you know, expanding your risk profile, or as Axis Bank's pension fund, you are also looking at the lower risk options?
So pension per se is a very, you know, it's a long-term business. None of us are going to make money for the 10, 15, 20 years. It will take some time for it to fructify. So as Axis, we are not in a hurry to accumulate assets. It is more to get more and more customers to come and subscribe and become an NPS subscriber. As they become our subscribers, they will contribute. Some of their salaries will go up and more money will come to us. So as pension fund managers today, we are more focused on getting more subscribers to join than to worry about how much assets we have. So more and more customers joining, we are taking care of that our investments are perfect. We are not taking any undue risk. We are completely compliant, and that's what we are trying to do. So majority of the time today for any pension fund manager is doing more of sales, more of awareness, more of activity. And happy to share, you talk about, you know, how we are trying to innovate. Very shortly we're going to come with buying a NPS through different TPAPs, which is Bheem, Google Pay and Phone Pay. So in about 10 to 12 seconds you will be able to open an NPS account. If you have a bank account, like the way you open your payments account today in Google Pay, the same time you will take to open an NPS account. And you will be immediately able to start an SIP and transfer your money through that same app of Google Pay, Phone Pay, and your money will start getting invested. So we are trying to make life easier. We are trying to make life easier for the customer to onboard, and that is the focus area today at this point of time.
Pranayji, like Sumiji was saying that your cycle is different investments. In normal institution, people look at quarterly growths. You guys may be taking a decade-long growth. That how in a decade things would take shape. India has a long planning of becoming maybe a $10 trillion economy by 2035, and a $30 trillion economy by 2047. As a pension fund trained professional, where will you invest in India's growth story?
First of all, you talked about develop India by 2047. So India cannot be called a truly developed country unless we take care of our elderly people. Today, our 10% population is above 60, which is going to be 20% by 2047 or 2050. So plus longevity is going up. Again, 85 plus people, number will be 3 times. So first of all, we'll have to take care of them. And regarding your second question was that?
Largely about, that which sectors you would, put
Yeah.
in this?
As a pension fund, SBI pension fund, we are looking towards India growth story. We firmly believe in India growth story, and consumption and all these sectors are very, very important, and our investment is anchored towards that ocean.
Sumiji, when you assess, the projects, what sort of things you look at, where you want to put in money? Obviously, you will also not, hedge your things with higher risk propositions, but how do you evaluate, the projects where money needs to be deployed?
So first, just to bring you for the audience, we are very tightly regulated by PFRDA plus NPS Trust, and we have very strong investment guidelines under which we operate, which give us guardrails in making sure that we are not taking undue risk with the subscriber's money, which is saving for his retirement. We are allowed a certain number of stocks, a certain number of, even if you go in debt, we have to have AAA, AA is allowed with some conditions. So all of that is taken care of. Our investment teams are very clearly told that we are not looking at quarterly returns or half-yearly returns or yearly returns. We are looking for the long term. We are not selling to our customers anything showing our past track record of 1 year of fund performance. Please come and subscribe to us. We are not guaranteeing them that we will be performing well for the next 3 to 5 years. So that is where it is. Primarily, we are investing in sectors which are growth oriented, which are long term, long gestation. That's the way internationally the pension industry has evolved, because that is where we have patient money. We have stable money. We have money for 10 years, 20 years, 30 years. If you look at our customer profile, we can predict when are they going to retire. And there is no way to withdraw the money from NPS, very difficult to get out of the scheme. So that gives us a long runway to look at investment, get invested, and be there for ups and downs, and make sure that our subscribers make money. So that is where our product is very, very strong from that perspective.
Mr. Pranay, when we started the conversation, we talked about how various economies have seen the growth of their pension funds. India is roughly around 12 to 15%. Chinese are roughly around 20%. And then we can talk about the other developed economies which are double India's their respective GDPs. If India has to evolve and get to the Chinese number of 20% of the GDP, what immediate things India need to fix, maybe on the policy side or regulatory side?
First of all, we have a regulator which is proactive. In the last 1.5 years, the regulator has taken a lot of initiatives to increase penetration. Like if you talk about pension, only around 20% of the working population has some kind of pension, and that is, we are not talking about discussing the adequacy. They are having at least 20%. 80% population, they don't have any kind of pension. Like gig workers, they were not included anywhere. So the regulator has included, we have come up with a scheme for the gig worker, platform workers, MSME people, farmers, for everything. Now we talk about NPS from 0 age, Vatsalya. So that the pension related discussion starts in the family since beginning. So all these policy level efforts, and Sumitji talked about use of technology platforms. All these platforms are ready, and the ecosystem is very much ready to deliver, and the pension growth is going to happen.
But even for many of the households, gold and real estate and equities are still the preferred choices. He has already told that they are bringing in some movie stars and all to create more awareness. But you might have also done the assessment that what is holding the younger population not opting for the pension funds, but going for higher risk and very difficult assets like real estate.
So traditionally, India has been investing and investing well. Saving and saving well. One of the strongest savers. But as you told that the investment has been real estate, gold or fixed deposit kind of things. So people basically invested the product which was familiar with, which was tangible and which has low risk. But in the last 1 and 2 decades, we have seen there is change in the behavioral pattern. People are investing in financial assets also. So the trend is there. We have seen the growth in mutual fund, growth in gold ETF. So the people they are understanding the product as well as their risk appetite is also increasing. So that way, pension is another option, and because of awareness, they are inclined towards the pension also. That's why the industry is witnessing more than 25% growth. As regards younger generation, certainly they wanted some change because the young generation is fascinated with equities. Many of them, they have not seen the cycles where the equity has given was corrected badly. So we have launched MSF, multiple scheme framework, where we are offering different kind of person suitable to the young generation and to the generation which understands this and can take longer risk. So we have all kind of products for all category of customers, and the attraction towards NPS is increasing day by day with awareness.
Sir, I'm staying back with you. I know S. Raman, the regulator, very well. He had been with SIDBI and later on, to KAG and all, but his focus always remained that, money needs to flow into MSMEs, money needs to flow into newer sectors. And he was when he was in KAG, he was telling me that clean tech should be the focus area where many of the funds needs to go. So is he redefining some of the rules? Is regulator working on opening up newer avenues where pension funds can go in? Or still, they are, in a conservative mode? Has Mr. Raman's entry into PFRDI eased out some of the things, or is still the status quo?
I would say that the pension industry, since Mr. Raman has joined, and NPS industry especially, has seen a turnaround. We have been requesting for many things. Now, as I told that the regulator is proactive. He has been working in all the areas and taking the beauty is that he is taking all the stakeholders along with him. Everything, every scheme is launched, every discussion is held. All the stakeholders are properly concerned. The pros and cons are discussed properly. There's a committee, pension advisory committee. Incidentally, we both are members of the committee. So all these things are discussed, and we are going in the right direction. And I can say that the subscriber and the nation are going to be benefited out of it.
Sumitji, State Bank of India is a monopoly. You are a younger guy in the lot. What sort of new areas you want, Raman, to open up, and where Axis Bank can play a role, your fund can actually turn around things much faster, but regulator is holding it up.
So first on Mr. Raman and his becoming chairman, I think that is the best thing that could happen to the pension industry. I have never come across a leader who has got such clarity of thought and commitment to make the pension industry better. Whatever we have seen, he's not even done 1 year, but contribution is immense to the growth of the industry. And I can assure you he's going to change the way pension is sold in India. Some of the new things that he has done, which are completely going to change the game and which are in the pipeline. One, he has launched a product called NPS Swasthya. For the first time, we are integrating health insurance with retirement, because there are people retire, but they don't have the right kind of insurance. And most of the retirement earning goes if, God forbid, some illness comes in. So that is a great product which we have already done testing into different markets, and we're going to launch in a big way. So these are some initiatives which he is taking. Plus, on your question on investments, he has created a committee which is looking at absolutely new areas of investment. I think the tenure of the committee is about 6 months. So early or end of this year, they will be coming out with a report which will open up all new sectors to us. And he has ironed out all the problems we had on REITs. Do
you have a wish list?
My wish list with him is completely done. He's actually now
wish list for investment sectors.
So that's what I'm saying. From the perspective of investment, I don't think I have a wish list that I want sector. From a tax perspective, we used to have 50,000 rupees ironed out in under 80C in the old tax regime. That is not there in the new tax regime. We have a 14% of basic salary for NPS. Maybe that is the one thing that we have to change for pension industry to do well, because there is no tax saving at all for NPS. If that comes back to the new tax regime, it will do wonders.
Pranayji, if you have the wish list, because time is going out, so maybe the last word is yours.
Only wish list is that automatic enrollment of all the new workers who are entering the workforce under NPS.
Thank you, gentlemen. Thanks for being patient with us. Thank you.
Thank you, gentlemen, for highlighting the importance of pension capital. May I request India Today's managing editor, MG Arun, to please to the stage and do the honors. Ladies and gentlemen, we have our last session of the day, but it is also on a very interesting topic that impacts all of us. Disposable incomes are increasing, wealth creation is accelerating. Conversations around succession planning are becoming increasingly important. Preserving wealth is not just about creating assets, but also ensuring their smooth transfer across generations. To have this discussion, please welcome Rajat Datta, founder, Inheritance Needs Services, Mr. Jatin Popat, founder of Viljini, and Mr. Vivek Sadle, co-founder, Legal Logic. Welcome everyone. I will also be moderating this conversation, but before we move forward, how many of you have created a will? Anyone? Okay, no one, 0%. How many of you have thought that you should create a will? Okay. How many of you think only rich people should create a will? How many of you think that only old people should create a will? Okay, so at least we are sorted there. Okay, so now let's see what the experts have to say. So I think the audience that is there has already told us that what is the first most important question. Why we need a will and why we need it in today's time. So Mr. Jatin, yes.
Thank you so much for having me here. So probably we all have some wealth. We have life ahead, we know. But what happens if we don't tell our family what we have? We have been writing will for many families, and we observe that people have got more than 29 assets. Bank accounts, demat account, flats, the lockers, so many things. So if they don't tell the family, they will run around for a treasure hunt where the money is. If something is missed, it will go to the government. Today, the government of India has got around 3 lakh crore. 3 lakh crore of unclaimed wealth sitting in the government for many, many years. And that too without interest. Without interest, then just see how much money they have got. Because people have not told to the family where the wealth is. The second one, the wishes. It is your money, it is your wish whom you want to give. If you don't mention your wishes in the will, then possibly the law of the inheritance which is prevailing in India for Hindu, for Parsi, for Christian, for Muslim, those things will come up. So do you want to allow the law to take decision, or you want to decide yourself whom to give wealth? So this is where we are saying that anybody having some wealth should write a will.
So thank you, Jatin. That brings me to, I'll just move in the order of the way speakers are sitting. Vivek sir, hard 3 lakh crore of hard-earned money sitting with the government, right? So what does that tell us? And there's also this perception that only the rich make wills and only the older people should make will, right? Why that perception needs to change?
I think we've all grown seeing the Bollywood movies where someone is dying and, at that time someone's coming in, some crooked fellow who's taking the signatures and so on and so forth. So that's kind of etched in our memory, Sonal. So that's what unfortunately translates into a situation where the will needs to get created only by certain sect of people. Only when you have, 2 bungalows, then you create a will and all of that. The COVID was a turning point, honestly, in terms of people realizing that the age does not matter. If you have assets, that's what matters, and if you have a responsibility, that's what matters. So when people come to us, we only look at whether they have, or when we go to people, I must say, is that do they have a responsibility? we say that when you get married, while you're doing everything, Naach, Gana, and the big fat wedding, think about creating a will as well. And looking at when you create a home, while the banks talk about doing a term loan, which is now become the norm, that you go to an HDFC and SBI and what have you, they will say that, go and do a term loan aligned to the loan. We are saying that do a will as well, so that it passes on to the right set of people. So it's a myth that only old age or only a certain sect of people need to create a will. Our view is that everyone who has a responsibility and who has financial asset or a real estate asset must create a will.
Thank you. So while everyone should create a will, another very important thing is family structures are changing. Marriage today means many things. So, Rajat sir, as you work with a lot of clients, at inheritance needs, what is it that you see? Why will is becoming so important as family structures become complex? Relationships are not the traditional relationships that were there earlier. So, how is will actually leverage that can be used on these fronts?
Yeah, so it's very clear that when I am alive, I make money, I create wealth, and post my demise, who after me should be addressed, so that the next of my beneficiaries gets it seamlessly. And I think, as Mr. Jatin Popat rightly mentioned, more important is that they should have no pains while they inherit the wealth. When they have no pains, I need to decide what after me. And that's precisely the point where either a will or any other structure is entered into. So I will put it in a broad category known as a testamentary document, because as you know that if you don't give something in writing, then the succession laws applicable to you on the religion of birth will get triggered. And that process is time consuming and cost gulping. So if you have made the wealth for the people who want to enjoy the wealth after you, that's your family,
Rajat,
then why not also make it?
Succession law. Can you talk a bit about succession laws for the audience?
Oh, succession laws. Fine.
Fine.
So I'll just complete this point. So they might as well be guided to navigate how to achieve the wealth. To talk of succession laws, Hindu Succession Act talks of Jains, Hindus and Buddhists, while Indian succession talks of Parsis, Jews, Christians and any other under the Special Marriage Act. That's where Indian Succession Act. And for the Muslim, you have the Muslim personal laws. So if you don't decide whom to give the wealth, either through a testimony document, which is a will or a trust, the laws are in place and which are pretty stringent and followed in totality. And not like the earlier days, there is no question of interpretation. There are n number of court cases in High Court and Supreme Court to enable you to guide, and hence it's imperative that you make a will or a trust deed.
Can you share that through an example, please?
Sure, let's talk. You also mentioned about change in social fabric. India's social fabric is changing. Today we are talking of children being married into different religions across territories, countries. You may have your son getting married to a Danish lady. You can have your daughter get married to somebody in Japan. In such a scenario, the wealth is in India. You might as well put a testament document to put that in place. To talk of the question that she mentioned, the tolerance level among couples is on the decline. You have made wealth, you want to give it to your son, but you're afraid if the son or the daughter's marriage is not going to last long, then the partner of the son or the daughter is going to take a lot of the wealth out of the divorce decree. And hence, why not plan and conserve your wealth for your family? That's one of the direct examples.
Vivek sir, would you, and I would also open this question to you, Jatin sir, about we now have people, LGBTQ, we have gay marriages, we have people who do not want to have children. So what is the role that will plays? I mean, that is the reality of today. So what is the role that will plays there?
Yeah, I mean, you can do also a couple of other ones like disability. So recently we went to a home which is serving the disabled child, and we were talking about what happens beyond the parents to those children. And now we are trying to create a mechanism where there is a will, there is a trust, and there are multiple other ways in which we are trying to see. And this problem, just extrapolate this problem into the whole of India, and each of the things that Sonal mentioned, and if you extrapolate, the problem is so deep and so the easiest way is to create a will. We always say that, you're making a lawyer rich if you don't create a will. That's unfortunate part. Anyone who has a home in a city like Mumbai, Pune, or any metro would end up paying 75,000 rupees just the stamp duty onto the court as to get a succession certificate. And then you have 6 to 9 months of wait, and so on and so forth. So there is a lot of that deserves an attention from someone to say that why you can't create something which doesn't need a stamp paper, can be done on a plain paper, can be done in your own handwriting, can be done in your own language. It needs just 4 or 5 checkpoints. Having done so much, the last mile left to chance creates and makes lawyers rich soon.
Mr. Popat, I would like you to address this question about why it is so inherently important for women. I mean, like we are talking about people with disabilities, LGBTQ, gay couples, but why women especially?
Sure. So first I will just add something on what Vivek said. So we had a couple of cases around. Many couples, they decide not to marry and they do a live-in relationship. There are cases now going up. There are cases people are separated. The cases, divorce cases going for years and years, and they start living some other partner. And those cases are also there in India. LGBTQ, we had a couple of cases attended. People had married into Switzerland or London, but they have wealth here in India. How to do it? So live-in relationship and those type of family, definitely there is a stress or a concern, because when they write a will and they want to bequeath to them, there is a problem that legal heir might object. So that is a hurdle for that inheritance. Sometimes we do family trust so that they at least get a wealth. However, there are taxation issues there. So it is not such a straight here. In India, some of the laws are yet to evolve to the international level. Secondly, for the women that you mentioned, like in India, like unlike other global countries, most of the asset in the family, they are kept in joint name, a bank account, demat account, flat, so many things. The husband and wife, they try and keep in joint. That's I would say the tradition or the way of life that India has got. Now, the joint name could be that a woman has earned and it is kept in her name with the husband, or husband has earned and the name of the wife is added to the asset as a convenience purpose. But legally, one has already given a gift. So if I add my wife to my flat, if she has not earned or put contribution, I would say I have gifted her 50%. That's the normal legal stand I would like to tell you. Now, women who has earned and kept somebody, or they have not write a will, it may happen that the asset which she has earned, it might go to husband's siblings. So in the case where they don't have kids, then in that case, if there is no will of the woman, then the asset will go to the husband's siblings, not to her parents or something. So this is a very important thing that women, whether they've earned or not earned, they should make their will for the wishes what they want to give it to, whether their parents, whether their whoever they want to give. And so it is very, very important, and which is really lacking in India.
So thank you. Mr. Datta, would you like to take up this point about women and in general also about...
So let me talk about women folk. We have made wills for workers in regional language. And why did the CEO want that to be done? Because he said my worker is illiterate, but because he's working in a MNC, he actually knows what the laws are. But when he dies, his wife is illiterate. The children just put the lady on the phone, onto the train, say we are going on for pilgrimage, and they get down in the next station, and that's she lands up somewhere in a place of religious location without losing everything, and she's too illiterate to come back. To secure them, the CEO asked us to make wills in the regional language. So will is an extremely strong woman empowerment tool, which you must understand. And according to me, the women is the people who will drive their men or their husbands to make wills, because when a husband dies, the woman does not know where the assets are, who the assets are, where the documents are. If she knows all the three, she does not know whether the documents are in a position that it will go to her. And if she knows all the three, she does not know how to do it. So that's important that both women and men both make a will.
Thank you. Vivek sir.
Can I just add one point? What we are recommending is that the husband and wife should make separate but simultaneous wills. We are suggesting that if the woman is making, the men in the family should make, and if the husband is making, the wife should also make. Because, like Jatin Bhai said, it is a joint, most of the assets are held jointly. Unfortunately, unlike income tax, the succession law says that it's a 50-50 if it's jointly owned. And then what you pass on through your will is only your part of your share. And you have no idea whether you are going to go first, or she is going to go first, or he is going to go first. So therefore, not a joint will. We don't like joint will. We don't have time, but at some point in time, it's also a good idea to explain why joint wills are not recommended. You make wills separate but simultaneous, same time.
There's also this concept of living will. In fact, Maharashtra is the first state that has now created a framework for a living will. So how is that different from a financial will, so to say? Jatin sir.
So living will is something where if somebody is sick and the person is on life-saving equipment in the hospital, ventilator and all. So at that moment, there are cases that some people have been alive in that condition, coma type of condition for months, and the hospital bill goes on and on and on. So what happens to those type of cases? Family are not allowed. The medical council doesn't allow them to stop the treatment or take out the ventilator. So that is why the living will concept is come, that I can write my living will that something happens in those situations within a week. Mr. So-and-so, my family member, they will go to doctor and they will say, please take out all the treatment, they let them peacefully die. And the doctor will have the panel, they will decide, they will go to the government panel, and then they will allow to remove. So to avoid those, the long-term medical treatments or maybe hospital bills, some people can have raised this issue, and it has become a fact now. Since 2018, this is there in India, it is allowed, and 2023 there is improvement has come. It is becoming slowly flexible. Maharashtra is the first state in India which has allowed this living will to be deposited in a portal. So there is a soft copy they can put. Earlier, this was supposed to, you have to go to the BMC office, you have to sit with them, you have to submit. So there was hassle in implementing those type of things. Now it is they are slowly easing out the thing. but it is not completely fully done. So we are happy that they have done something like this, and it will improve further so that even these type of issues can be sorted out by writing a living will. It's a separate document than the normal will. Normal will is after death. Living will is to decide the death in case of such situations.
So essentially, you get to decide how you want to die, at home or in the hospital, and that's what the living will is for. And because families sometimes, because of so many other cultural reasons, emotional reasons, it gets extremely difficult for them to make certain calls. So this concept of living will gives the person that authority, that on how they want to essentially die, so to say, right?
I just want to add one thing here. Dr. Datar is a gynecologist in Mumbai. He is doing a big campaign for last 5-6 years. He's been fighting with the government of Maharashtra to ease out the process. He has gone to High Court many number of times. So luckily it is now becoming the reality, and things are getting really moving in the right direction.
So from here I would want to move on to this now concept of trusts, because that's another very important area now that's coming up as inheritance. The asset class itself has now become so diversified. Vivek, would you like to take this up on the range of assets now with crypto, bitcoins that are there? Touch upon that issue and maybe start with introduce the concept of wills and trusts.
So the trust is like HUF. We have all graduated under the Hindu, so the HUF as a concept, which is slowly dying, but that was one tax planning instrument or an entity that people used to create. Now people are moving to look at a private trust to ring fence what Mr. Datta was talking about. When your child is getting married or your daughter is getting married, you're looking at ring fencing those assets by creating a situation where it's not your personal asset, but it's sitting into a legal entity which has its own different existence. The trust is also being created while there has been lot of conversation about there will be an inheritance tax that might come, and people are saying that, it is not my asset, it is a trust asset that we are looking at. People also look at creating this private trust when, you want to have, you possibly have a disabled child, you want beyond you, someone to take care of it. Or you have shares in a company, you are looking at creating a mechanism where you want to pass it on. You don't want one person to sell the shares, and you can write, unlike a will where there are limitations, you can write the rules of the games in terms of how that asset beyond you or during your lifetime as well can be moved in a particular way. And we have seen this happen as we speak with multiple families, and people are actually creating, this is the place where the wealth gets created. This is the real place where you see so many people are now creating wealth, and that's where the trust comes into being. Remember that the will comes into the force only after the demise of the creator, whereas the trust can be a testamentary, which is like, created through will, or can get created at the time when the person is alive, and you can push your certain assets. Also, remember that, lot of children today in the family are going abroad. The trust mechanism is not always suitable in all situations. The way we look at is that, we would first look at the objectives and make sure those objectives meet the smell test of why the trust is to be created. When you create a trust, you need to manage it, you need to file a different income tax, you need to keep the accounts. So it's not a, what we call zero maintenance, unlike will, where there is no maintenance. Once you create a will, there's no maintenance at all. It's a document that's kept, executor looks at it and, comes into being. Unlike that, the trust has its own nuances of maintenance. So before you enter into trust, understand what you are getting into and what would be the maintenance cost, and will the beneficiaries in the trust understand the mechanism And is that what we call as a perpetual trust? Can that be dismantled? What are the rules of the game? That becomes very critical. Also, the cost of creating a will and the trust. So if it's like 1 rupee to trust, you will have, say, at least 10 rupee to, so it's a 10x cost of creating a trust. So those are some nuances looking at that.
Thank you. Thank you, Vivek.
So as far the trust is concerned, just 2 points, which I think most of them is covered by Vivek ji. One is that if you have a child who needs a little additional support than the other child who is all okay, you may want to give him more bequeath and not jeopardize the interest, which could, if you do through a will, could be contested. So you make the trust deed to enable increased bequeath to one of the beneficiaries as compared to the other. Second, you want to share your wealth intermittently over a period of time, as you mentioned, over 10 years, 15 years, 25 years. A will is like a toilet paper. You use it as soon as you die, implement it, and that's gone. But a trust would remain as a structure with eternity, as you rightly mentioned, which can be used for intermittent bequeath over a period of time. So I think, as you rightly mentioned about the cost, let me tell you, the cost of not making a testamentary document is enormous. Please understand that. Hence, it is cheaper to make a testamentary document or whatever you choose, depending upon your profile of investment and beneficiaries or family configuration, it needs to be done. Thank you.
So while we are speaking a lot on the importance and we have spoken a lot of quantitative aspects, I would want to highlight some qualitative aspects. So for example, there was this one gentleman I spoke to who wanted to create a trust because his idea was that in case something happens to him and his wife, the son of course will inherit the money, but he wanted to create certain conditions. There was no court case against him. The son finishes the education on time, is a good student, a good citizen. So he had a set of these 5-6 conditions. So even on certain qualitative aspects, a trust as a feature becomes more effective. Another couple did not want to have children, but they had 10 pets. They were cat lovers. They ran an NGO for cats, and their biggest concern was who would take care of their pets, their NGO. And that's where they created a trust where they appointed a guardian who would come, feed the cats, and ensure their requirements are met. So I would like Mr. Datta to take this point forward and also talk to us about how, in today's setup of nuclear families, where the people you're dependent on, there's just one person, caretaking responsibilities are so much. So how does trust factor there?
Yeah, so this comes under special situations wherein you have, after you die at the age of 85, 89, we just heard that the longevity is going up. Your wife is also going to be 80 plus, and probably she'll be very vulnerable at that point of time when one of her kids or daughter or son comes and says, "Ma, ye sign kar dijiye," and out of mamta ki ubhar aane se she will sign, and she will lose all the wealth. So the trust is a good structure to cap that vulnerability, because now one signature won't come, there will be 2 or 3 signatures. We have a trust formed with only one asset, which is about gold. And why did the father create a trust for the gold? Because the daughter-in-law said that looking at the value of the gold, it seems that your son doesn't want to now go to do business and he wants you to sell it and us to enjoy. I have 2 daughters and I'm worried you better put it in a trust so that even after you die, he cannot sell it. So there is a trust which is formed only with one asset, which is gold. I am not giving the value of the gold, but that's how it is. There are cases, as you rightly mentioned, of special situations wherein the child doesn't want to marry. And if he marries, the trust is going to give him an incentive. If he has the first child, the trust is going to incentivize that the child marries and have a... So these are special situations which cannot be handled through a will, but can only be handled through a trust.
Okay, so this brings me to My question, because everyone's afraid of lawyers. Let's be very realistic. Everyone thinks they're expensive and they are somewhere. It's better that they're somewhere far away, right? So, in this context, how easy is it to create a will? Or how difficult it is?
Creating a will is not difficult at all. It's a simple process. You can write your will on a plain paper, no stamp paper required. You can write in own handwriting or by a computer. You can make it in your language or in regional language or English. So these are the simplest thing. You have to mention who are you, your family, your assets. You don't mention the value and to whom you want to give. These are the very basic thing you can mention in the will. You have to sign in front of two witnesses and that becomes the legal will. So this is the simplest way which I have taken for you to at least understand. It's not that complication. It's a declaration. My money, this is my money. I want to give in this fashion to these people in this ratio. This declaration is enough for the Indian law to accept it and allow those distribution. One can go to the legal professional for some more clauses around for the future asset or maybe for some legal language. But it is not compulsory that you have to go to the legal professional. You can make your will. However, it is just a hygiene purpose. People are going there because we are spending 5,000 to 50,000 rupees every year on vehicle insurance. And here you have 5 crore, 10 crore wealth. You can spend 5,000-10,000 rupees for proper will. Otherwise, your will is there. But if something is contradictory there could be a fight. So the purpose will not serve.
He's asking, does it need to be probated?
So probate comes only after the death. So, yeah, registration of a will is something people are asking a lot. Registration means you also add government as one of the witness, which is not mandatory. If you wish, you can go to the registrar office and very small amount they take and you can get registered. The probate is only after the death when the family says we don't accept this, or when you go to your flat people or the bank people, they say we don't know this will is final or correct. Go and let the court say this was the final will and there is no dispute. So the court will do a probate and they will give a certificate, this is the final will, let's distribute the asset now. So that's a probate which happens. That happens also very few cases. I would say not more than 5%. Not mandatory.
Okay.
It is deed based only.
Can you talk about what is probate and what is registration and
Yeah. So registration is something where you are visiting to the register, sub-registrar of the nearest to your house. Normally we give to property matters, the flat and all. So you have to go there. You have to produce your original will that I have come here. These are my two witnesses who have signed. Please you become the witness. So they register the document, they scan the document and give you the original copy. And that copy remains with the government. So somebody should not say this was a fake. There is something is genuine, authentic. However, nobody can say this was the final. Because even after registration, might have done new will. So for that, this probate is required.
Thank you. So, Mr. Sathe, but what are the reasons why does a will get contested? We see so many, news is full of such cases. So, but if it's this simple, why does it get contested and why are family members fighting amongst themselves?
So, Sonal, if someone has to fight, they will. It's human to fight, and when it's money, people fight. That's a given. There are certain technicalities which can get contested. There are wills where intent is contested. There are wills which talk. There are so many lot of those situations that happen. We are right now in the midst of a very celebrated one in Delhi, as we all know. And, it's great gossip and it's great. The only good part that we talk about is that, it's giving a publicity that you must create a will, right? That's the only thing. But then the will has got contested of the biggest politician of Maharashtra who expired a decade back, their children, contested that particular will. So you can imagine those who have all the wherewithal, right? We are talking about 30,000 crore worth of assets being contested with a will, proper will, which means that people with all the wherewithal also can get into these situations. Therefore, our view is that when you do not have any issues, you must definitely create a will. If there is some issues in the family, whether you create a will or not, those will anyways happen. Even there, you are looking at making sure that, like Jatin Bhai rightly said, you have to make sure that you have witnesses. The beneficiaries are not witnesses. So there are some checkpoints that you must make sure that happens. On larger wills, Sonal, what we are advising is get a video done. We are talking about, get the RFID done. So we are, using technology to establish the fact that this is the genuine and a final will. And obviously we are recommending, though it is not legally required, to go and register the will. Because, you go to your society, the chairman will say, "Are ye registered nahi hai, I won't accept it." So then you are again going and getting a probate, even though you have taken all the hassle of creating a will. Therefore, we are suggesting that be practical, look at what are the checks and balances, and therefore, going to a professional at the last minute to make sure that he does all the checks and balances for you is also recommended. While, this means business to us, all three of us are in that particular profession, but I mean, you go to a tax advisor to file your tax return is the same thing, that your last mile check from a professional helps your beneficiaries so much of hassle. That's an important one. And registration, though not compulsory, we are recommending that please go and register at a certain age when, your asset building is stopped. You're not adding assets and your family is fairly well settled. The son is married, the daughter is married, or what have you. And therefore, you are not adding any other beneficiaries or asset class, but you are clear in terms of how you will distribute. We are saying then go and register.
Thank you. Mr. Datta, there are also certain ways in which you write or create a will which ensure that it is not contested. And you have given examples of how first you have to create a basic list of your assets and also your liabilities and a lot of such other things. So can you please talk to us about that?
So we have actually divided the will into two parts, which is known as the subject clause and the object clause. According to us, the object clause is all the assets that you have, will own from the date of signing the will to the date you die. And the subject clause is actually the beneficiaries. When we make wills, we cover three lineages. So I will say, someone dies before me, then his daughter or their family with children. If he dies without getting married, divorced, or having no children, then to whom? When I cover three lineages, and I also cover three types of assets, covering from my date of signing my will to the date I die through a residual clause, I do not see any reason why this will cannot be robust enough to take it forward. Where I think one important thing is missed out, while I think both my co-panelists have rightly said that there are checkpoints, but in most cases, people when they write a will, they say this is my house, this is what I own. But when you look at the document diligence and hygiene, you find out that the land belongs to the father. Father has died and he built the house, presuming that it is his house, but actually it's only the structure which is his. Now that cannot be willed, because the land underlying belongs to his house, his father. The father died, he has brothers who have not claimed any mutation, so the land does not, so that cannot be willed. But that is written in the will. There are people who write, my share in the HUF should go to so and so. Shares in HUF cannot be willed. So there are time in such cases, and which when you write, this gives enough opportunity to the aggrieved beneficiary to file a case. And I think what my colleagues here and the panel rightly said, that don't look at not employing a professional, because the cost of employing a professional is peanuts as against the pain and the cost that we'll have to bear later on.
Thank you. So I'll just put one number to put all of this in perspective. 100 lakh crore. That is the number that will be transferred from the current generation to the next in India in the next 10 years. And that is where all of this will come into the fore. Because there will be cases, the money lying with the government probably will increase, decrease. All of that is hard-earned money. And then it's up to us of whether how we want to transfer it to the next generation. My last question to all of you. If you have to, since none of us, me included, have thought of or created a will, what is the first step? Because there's also this whole fear that no one wants to think that they're going to die or will die, right? So what is that? What is the first step towards making a will? It's all three of you.
Sorry. So, first thing is awareness. What we are doing is right thing. India Today, thank you so much for this awareness. And this is a very basic thing which is needed by all. One is to understand. Please go back to 20 years back when you have a Mediclaim came into India. Nobody was aware what is Mediclaim. People have started taking it. Now it is almost many households has got. Today when somebody asks you, the insurance agent, we have a renewal for Mediclaim. You don't ask questions. You immediately pay the renewal fees and complete. So initial period when there is a product is new, people want to know more. So please note that moving the thing is important and then taking action. Nobody has a date of expiry, that we all know. So we can't say that I will do it later. So even that is a mistake, that one should not wait. If you are 40 plus, family is there, some assets is there, one should immediately take action, make a will and go on changing every day. It's not a problem. But keep it. You have a medical policy, you have got a vehicle policy, you have got a insurance policy, so many things you have got. So why not one piece of paper which will cover lot many assets and peace for your family?
Thank you.
I think I would suggest that the biggest time that it takes is to create inventory of assets. The object clause, as Mr. Datta said, I think that's the key. We recommend people to look at what are your assets. Don't miss out, because you miss one and then you still have the same situation for that asset as if you didn't create a will. Therefore, that asset creation and making sure that that asset ties up with what the legal title to that asset is, that's the most critical part. That's where the miss is, and that's what takes the most time. So the recommendation is that get everything in order, and then creating will becomes very easy.
So before we move on to Mr. Datta, one thing, one of you gave me this example of bitcoins from the Singapore. Would you want to share?
Sure.
That's a
so this COVID taught us so many things, and each of us lost someone near or dear, friends, family. We had a client who was a CFO, very interesting personality. Unfortunately, we lost him at a very young age, in his mid-40s. He had, when the wife came, she was a chartered accountant as well. She came back. They were living in Singapore. Singapore has a different law in terms of, they require you to create a document which is like what we have a nomination. They force you to create one. Otherwise, you lose your assets to the government after the death. So most of the people would create a will. He created a will as well, though he owned $2 million of crypto. $2 million. Now the way the crypto works, it's you have a password, and those who have dealt with, those who have not dealt are more happier than those who have dealt with it. But then when you look at this particular situation, he missed that whole thing. He had whispered to her saying that we own crypto, and when she came to us, she said that I lost 2 million that I know on the crypto, but I don't know what else I have lost, because now it gives me jitters. If he didn't write the crypto in his will, what else did he miss out? So therefore that creating inventory, Sonal, is a critical thing from my perspective.
Thank you. Mr. Datta.
If I can take the privilege of the last word, I will say procrastination is a cheap hobby and an expensive proposition.
So So thank you. Thanks a lot. This is a subject that is most often overlooked. A lot of us don't want to talk about it, but it's so critical, for preserving family wealth. So thanks a lot, and I would like to invite Mr. Sire Ranjit, Managing Editor at India Today, to please come to the stage to do the honors.
Look, this investment Guru's tips will double your money. Just claim the offer.
Double your money from any random group. Pay attention. Promising double returns, they'll lure you in tight. Unverified groups will send fake tips overnight, emptying your pockets before you can fight.
Well said! Well said! Well said!
SEBI and NSE advise consult only SEBI registered advisors and make payments only to verified accounts or UPI ID.
सोच कर, समझ कर, इन्वेस्ट कर।
NSE द्वारा निवेशकों के हित में जारी।
Wow, so you use this trading app too?
Yes, because it promises guaranteed returns.
Guaranteed returns. Your trading app is authentic, right? Here's the catch. First, they promise guaranteed high returns with a grin. Then trick you to download a fake app and pull you in.
Well said! Well said!
SEBI and NSE advice. Download apps only from the verified apps list on SEBI's investor site.
सोच कर, समझ कर, इन्वेस्ट कर।
NSE द्वारा निवेशकों के हित में जारी।
एक चम्मच।
मसालों को अच्छे से मिलाना।
पापा लेट्स स्पाइसी।
लाइफ हो या इन्वेस्टिंग, अपने गोल्स को पूरा करने के लिए डिसिप्लिन और फोकस जरूरी है। इन्वेस्ट इन म्यूचुअल फंड्स टू अचीव योर फाइनेंशियल गोल्स। Mutual fund investments are subject to market risk. Read all scheme related documents carefully.
फर्स्ट स्टेप मिस किया? चलिए कोई बात नहीं, लेकिन इसके फ्यूचर के हर बड़े कदम के लिए जरूर तैयार रहिएगा चिल्ड्रन ओरिएंटेड म्यूचुअल फंड्स के साथ।
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.